approaching it towards the end. That is what I mean. Okay. All right. So let's move on. So I will also emphasize that you need to allow your calculator to work very well for you, because the calculator is for this CFA exam, the calculator should be your friend. So you spend so much money buying the calculator. I always emphasize that if you spend money, do an investment, make sure you get the return from your investment. When I bought the calculator, it was one of the strong investments that I had. So up to now, I'm still using it. I'm making sure that I get a heavy return from the investment. The good thing about this, my calculator, is I have not changed the battery. So I'm still going without any cost of maintenance. So please make sure the calculator is used to do whatever it can do for you. Now, I already explained that we have 2 study sessions. So the first study session is the one that has 4 readings, and that is the one we're starting. So the way I will approach this is when I come to a reading, we look at the learning outcome statement. We do some kind of brief description of what is required on the learning outcome statement to make sure that we have a general understanding of that. And then after that, we solve questions. And when we start solving questions, please, you are participating alongside. So I'll give you opportunity to answer the questions before we come in to look at it. So you can see the learning outcome statement is saying what is the basic, is for us to talk about the basic feature here, content of a bond indenture in terms of regulatory. This is all content of the bond indenture. These are the regulatory issues that we need to look at. And then we talk about the cash flows of a bond. And then we end it by looking at the bonds with contingency provisions. So those are the things that we'll look at. And then afterwards, we'll start solving questions. So let's just take a screen and then have a summary of this particular study. So for this, I would just say that when you ask me of fixed income elements, I would just say there are 5 elements in a fixed income portfolio. And so the elements are 1 issuer, and then the issuer, we said, is the borrower, the person who borrows the money. That is the issuer. And then another, so if you say issuer, that would be fine. Now, the issuer can be sovereign. So we say if it's sovereign that is borrowing, it's sovereign. So it can be non-sovereign. So sovereign is the government or to governmental authority. Non-sovereign is the one that is a government, but it's not a sovereign government. So, for example, a state government will be referred to as non-sovereign. We have a quasi-sovereign or quasi-government rather. So, for a quasi-government, you talk about something that is not actually a government, but it's a government entity. So, it's created by an act. And so, quasi-government can be like agencies that we have. We can also have supranational. Supra will be like the World Bank having an issue, the African Finance Corporation having an issue. Those will be called supranational because they have global presence and their issues, their entities are owned by several nations. And then we also have the corporates, which are issues by companies. And then another classification would just be like some can be corporate or can be otherwise. They are SPEs. So bond issues are issues by special purpose entities. Now, the importance of the issuer is just the fact that the issuer determines whether the bond is an investment grade or not investment grade. All those things around the issuer is just about all those things around the quality of an instrument is actually mostly centered around the issuer. Now, in terms of the maturity of the bond, maturity is about how long the bond will exist. When you say time to maturity after issuance, when you say time to maturity, it's just saying how long will the bond, so from today that we are now, how long will it take before the bond matures? And then the importance of this maturity is the fact that it determines whether an instrument is a money market instrument or a capital market instrument. A money market instrument is an instrument that is issued from the beginning, from the original date of issue, it has less than 1 year, 1 year or less, 1 year or less, and that would be a 1 year or less will be a money market instrument. A capital market instrument is an instrument that will have more than 1 year, lifetime, or more than 1 year maturity. So if you are named as a capital market instrument, you remain in the capital market instrument. You remain in the capital market and exist in the capital market to the end of life. If you are named in the money market, you remain in the money market and exist to the end of life. So that is how this is done. Another element that we are supposed to also look at is the par value. The par value is what the amount that has been borrowed from the beginning or the amount that will be paid later. Sometimes the par value, and usually the par value determines what the basis for the interest rate. So if you say a coupon is 5%, we are saying it is 5% of the par. So that is the significance of the par value. But then we will see the par value later, because the par value has another significance with the price. If a bond is priced at par, we say it is par. If a bond is priced at above par, we say it is trading at premium. If a bond is priced below par, we say it is trading at discount. So above, so if it is equal, it is par. If it is above, if it's trading above, then above the par, then it is premium. If it's trading below the par, then it is discount. Then that is important, but we'll see again that another element that we need to look at is the coupon, and the coupon is the coupon rate and then the coupon amount. The coupon amount is the amount that is paid to the borrower to the investor for using that fund. So you pay, if you say a coupon is 5%, for example, then it means that it is 5% of the par value. If the par value is 1,000, then the coupon is 5% of 1,000. That is how this thing operates. And if in that case, coupon can be paid, semi-annually. So if you say it's 5% of the par, it means that I will pay 2.5% in 6 months and another 2.5% in 6 months. Coupon can be fixed. It means that I have, like this 5% is fixed. Coupon can also be floating, for example, with a floating rate note, where the rate is based on another market rate, or what we call the reference rate. And then coupon can also be zero. So if it's zero, it means that there's no coupon that will be paid regularly, but the bond usually trades at discount. And then if we say at discount, what it means is that the price of the bond is less, it trades less than the par value. That is what we mean. I hope we are going together. And then the last part that I want to talk about in terms of the element is the currency. Now, the currency is important because it determines so every issue must have a currency. So if a Nigerian government is issuing a Naira FGM bonds, it will be a Naira currency. It can also issue in dollars. It can issue in any other currency. But then the significance of this currency is the fact that the currency of issue determines the interest rate that affects the bond value. You know, remember in letter, when you say when interest rate goes up, the price of the bond will go down. Now, that relationship is influenced by the interest rate of the currency of issue. So if a Nigerian government, for example, issues a USD bond, now the interest rate that will be responded. So if interest rate in Nigeria goes up, the price of that USD bond will not go up, will not go down. What will be affecting that bond is when the US government decide to increase, or US Fed decide to increase interest rate or reduce interest rate. That will affect the bond. So the currency of issue, the interest rate of the currency of issue is the rate that affects the bond, not the rate of the domiciliation of the issuer. Now, so if we know that, then we can say that we have two types of currency bonds. We have the dual currency bond, and then we have the currency option bond. The dual currency just means that you'll be getting one payment. So, for example, coupon will be paid in one currency, and the par value or the redemption value will be paid in another currency. So you have an option. You have not an option this time. It is just two currencies. One will be a Naira, for example, and the other one will be USD. You can pay Naira, coupons in Naira, and then pay USD at the end. But then with the next one, which I said is currency option bond, here the investor has two options, has option within two currencies. Either I use one, so when it's time for coupon, you can decide to say you want Naira or you can make a decision between Naira or USD in terms of this example. So you need those things to function. Now, all those things that we mentioned, so all those things will be in details later, but then all those things that we mentioned are all encompassed in the regulatory framework. And in the regulation, what we have is the major regulation that these things are sitting on, because all these things are described in that document. It's what we call the trust deed. It's a document called the trust deed. Now, this trust deed is also called the bond indenture. It's also called the bond indenture. The bond indenture is significant because it is the contract that defines this relationship. The relationship between the investor, who is the person giving out the money, and then the issuer, who is the person taking the money. So that relationship is defined by the trust deed. The trust deed will contain I call them the 3 C's of the trust deed. So the first one is credit. It will have something called credit enhancement. The trust deed will also have something called collateral. And then the trust deed will also have something called the covenant. So we have the credit enhancement, we have covenant, and then we have the collateral. These things are contained in remember the trust deed will contain all those things that we mentioned earlier. So the 5 elements, and then we'll also include the 3 C's, the credit enhancement, covenant, and collateral. Now, in terms of the credit enhancement, we have 2 types of credit. And what is actual credit enhancement? When you say you credit enhance an issue, what you are doing is that you are making the credit quality of the issue to be high, meaning that you are enforcing the issue. And if you enforce that issue, you are reducing, because credit quality is high, the cost of issuance is low. Cost of issuance in this sense is the yield that you pay. The yield will be low. And that is what credit enhancement means. For credit enhancement, we have 3 types. We have 2 types. It could be internal credit enhancement, or it can be external credit enhancement. If it's internal, it is within the structure of the issue itself. And so for internal credit enhancement, I say I have my S or E. So when I say internal credit enhancement, I will say I have my SOE for the internal credit enhancement. The S is for subordination. Subordination is part of the credit enhancement, meaning in terms of credit subordination, this one ranks before this, or this one ranks after that. Then the next one is over collateralization, meaning that I have more collateral backing the issue. That will be an internal credit enhancement. And the last one is the excess spread. I'm getting, say, for example, 10% on the collateral side, and the issue has, I'm issuing for 8%. So the spread, the difference between them, is actually an excess spread, which is good for the issue, and it reduces the cost of issuance. So those are the internal credit enhancements, and you have the external credit enhancements, and is my LBS, right? LBS. So the first one is letter of credit. Letter of credit is just a letter guaranteeing or an issue from a bank that is saying that, yes, there's no problem with this. There is a fund already provided. I can take care of this payment. So it's a letter of credit. So if the bond is due, this person has this sufficient, the bank is saying this person has sufficient fund to pay. The bank is taking that the bank will pay, and that bank issues the letter of credit. We also have the bank guarantee. This is the bank now giving a guarantee of payment. It's not as if you have a fund with the bank. The bank will just give a guarantee of payment that if this entity does not pay, coming in to say I provide a guarantee. It's also called, if that is provided by the insurance company, is a surety bond. So this is an insurance entity giving the guarantee that yes, we're here and we'll take care of all that. So if you have a cash collateral, you know, the thing about collateral is just that it is, the external guarantee is just as good as the person providing the guarantee. So sometimes it's the best way to do this is, instead of doing letter of credit or doing a bond guarantee, we'll just say, okay, give me cash. The entity collects the cash and invests the cash. So at least they invest the cash. The borrower is sure that the cash is ready. It's not as if it's something that will come later. That way, we don't mind about the credit guarantee or the credit rating of the entity that provides that guarantee. We have already taken the cash, so that will be a better way of providing guarantee. But again, I say that guarantee is as best as a guarantor. If an instrument is rated, if, for example, before the external enhancement, the instrument would have been rated single A. But now the guarantor has a double A rating, and the guarantor comes in to guarantee that instrument. That instrument can have a rating of double A. That's what guarantee does. That's what external enhancement can do to it. It provides it with that second level. So instead of looking at the credit of the first entity, we are looking at the credit quality of the second entity, which provides the guarantee. But again, the guarantor has to be there to satisfy, or if the guarantor is not there, all this guarantee will just go. Now, for the covenant, we have two types of the covenants. We have one that we say it is affirmative, and the other one, it is called negative. The affirmative covenant is the administrative covenant, the covenant that we just, entity is just saying, I agree to do this, to do that, to do. So for example, I agree to pay my creditors as at when due. I will service my asset as it's required. Though those ones are not restrictive. A negative covenant will be restrictive in nature, meaning that it restricts the entity from carrying out some functions. So for example, you cannot, if you say the debt to equity ratio should not be more than this, then you are restricting the entity. You can say you cannot borrow you cannot issue any bond above above the quality of this one that is already an issue. That will also be a negative covenant. A negative covenant, just the point that you need to take from here is that it's restrictive. Restrictive just means it restricts the ability of the issuer to take position. And then the last part that I want to talk about is the collateral. So let me, before that, a question, sorry, not a question, just something to say that a negative covenant, if we say the entity cannot sell its asset, that please just know that it is a negative covenant. So in terms of collateral, we have the names. The collateral serves to improve the quality also of the issue. So the trust deeds, we have to describe what the collateral is. What are those things that are contained in the collateral for better understanding? Now, the collateral will be based on the names, and I'm going to be asking you a question now. If the collateral is a pool of, if the collateral is financial assets, if the collateral of the issue is financial asset, what do we call that collateral? What do we call that bond? What's the name that we give to the bond? You can type in your answers. I think I missed some chat. You can type in your questions, or you can type in. Is the audio still skipping? Please confirm if you are with me, so that I will not finish the lecture alone. You know what it means when you finish a lecture alone. At the end, okay, thank you. Because at the end, I'll just say, okay, no question, I'm gone, I'm back. So if just type the answer, beautiful, I've seen the answer and I will stop. So collateral trust bond, that is the name. If it is backed by pool or by financial asset, it is collateral trust fund. Where has it gone? We have to do it again. It's collateral trust bond. If it is backed, I can do another one. If it is backed by, let's say it is now backed by specific assets, backed by specific assets. What do you call it? If it's backed by specific assets, fast finger. If the issue is backed by specific asset, yeah, beautiful. Equipment trust bond. So let me just do something else. If it's backed by pool of mortgages, everybody will get this. Pool of mortgages, everybody will get this. Yes. Pool of mortgages, yes. Yes, pool of mortgages. Someone say is mortgage trust fund. Yes, of course it's mortgage trust, but it is mortgage-backed securities. Correct, mortgage-backed securities. So depending. So if it's, I will explain a covered bond, and we're going to be talking about a covered bond later. A covered bond has a pool of assets, and then it's also issued by a financial institution. A covered bond will have a pool of assets. Will have a pool of assets and will also be issued by a financial institution. With a covered bond, the difference between a covered bond and some of those asset-backed securities is the fact that for a covered bond, there are two recourse. One is the recourse to the assets, the collateral that is backing the issue, but then there's also another recourse to the issuer. That is why we talk about the issuer when we talk about covered bond. But when you're talking about the asset-backed security, you don't talk about, when you say the issuer is an SPV usually. So that does not cover. Beautiful. So let's move on. From there, I don't think we missed anything there. So let's move on. Now, if I'm saying that, so this is just to explain what we have under as controlling the bond. So you have those documents that are also controlling what the issue is all about. Now, I want to talk, before I move on to cash flow, or just to even provide a good summary and then move to questions, because we need to move faster. I have something to talk about in terms of the bond. You know, bond, we have different kinds of bond. We have the national bond market. National bond market is actually made of a combination of two markets. Now, there is one market. One is called, so national bond market. We say we have a domestic bond, and then we say we have a foreign bond. Now, when you say a bond is a domestic bond, what it means is that the bond is issued in a certain jurisdiction, domestic jurisdiction, is issued in Nigeria, in the currency of that jurisdiction. So a bond, the issuer is domiciled in Nigeria, right? And the bond is issued in the currency of that domiciliation. So in this case, the currency is in Naira. And then the issuer, remember the issuer is Nigerian. The issuer is domiciled in Nigeria, issued the bond in Nigeria, in Naira. And also the market, the bond is registered in Nigeria. This bond, it will be said to be a domestic bond. In terms of the foreign bond, the domiciliation, there's no domiciliation. Sorry, I have to do this. The bond, the issuer is not domiciled in the country, but it is issued in Naira, and it is also required to be registered in Nigeria. So I'll give you an example. MTN Nigeria, if MTN Nigeria issues a bond, that bond will be said to be MTN Nigeria, that bond will be said to be a domestic bond because the issuer is domiciled in Nigeria, the issue is in Naira, and then it's registered in Nigeria. The foreign bond will be that the issuer is not a Nigerian. So MTN South Africa is not Nigeria, it's from South Africa, but it comes to Nigeria to issue in Naira and then in the Nigerian market. So registered in Nigeria. You have to register with SEC to do that issuance. This kind of bond is called a foreign bond, right? So if you move on again, we have another bond called the Euro bond. A Euro bond now is a bond, is a bearer bond. When we say bearer, it does not need registration. Usually, that is how it started. It's just a bearer bond, though now most bonds are required to have registration. But it's a bearer bond, meaning that it doesn't require registration. It is issued the country. So the way we distinguish it, and is for the exam also, is to make sure that everything about it is canceling out. So a company in Nigeria, say MTN Nigeria, goes to London and issued a bond in US dollar, and issues a bond in US dollar in London, and issues a bond in US dollar. This bond is a euro dollar bond. It's a euro dollar bond. MTN Nigeria, a Nigerian entity, so the entity is foreign, going to London, another foreign entity issuing. Actually, the market for euro bond is a euro bond market. It's different from the local bond market. It's called a euro bond market. So it's issued not in one jurisdiction. It's actually issued in a general jurisdiction. As you are issuing, everybody has access to the bond. That's what it means. So if you have this is a euro bond. You have a Japanese entity coming to Nigeria. I'm just giving an example. A Japanese entity coming to Nigeria to issue a bond in euro. This will be euro or euro denominated euro bond. Or a Japanese entity coming to Paris, for example, and then issuing a sterling bond. So those kind of euro pound, those kind of issue are euro bond. A combination of all these markets, a combination of the domestic, the foreign and the euro, a combination of all these bonds will give you a global bond. So a global bond is a bond that is issued to everybody, is issued internationally, but is also registered in one country. So it has a place. It's issued in Nigeria as well as in the international bond market. I just hope this is clear because it will be coming clearer later. Let's move on. I think we should just move on to do questions before the time will go and leave us. Let's just move to some questions. Do we have a question here? No question. I'll move on. If we have a question, I take. Then there are areas that we need to also look at. Bonds with, I think bonds with embedded options. Just type your question if you have, please. I think it's easier. Yemi or Frank, what do you do? What's the rule?
My game, sir.
Okay, so please just type in the questions and we move on. All right. So maybe by the time we see some questions, we'll get those things clearer. All right. So here again, we have some questions. Please, you can I will give you some time to answer and then I will move on. So first of all is for me to allow you What's the answer? I didn't discuss callable, putable, convertible, contingent, convertible, warrants. We'll talk about it later. Floating rate is coming here. Floating rate, spread plus reference rate. Floating rate will have. So let's answer. What's the answer? If you don't have answer, I will just answer it and move. This is a floating rate note. We know that a floating rate note pays in arrears, right? It pays coupon in arrears. And so where the coupon rate is equal to the 6-month LIBOR plus 50 basis points, coupon payments are made semi-annually on the 30th June and 31st December. You know, on that 31st, the payment that will be made on 31st December will be reliant on the coupon of the reference rate of 30th June, and payment on June will be reliant of the reference rate on 31st December of the previous period. So on 30th June and 31st, 6-month LIBOR is given to us as 1.6 and 1.8. What is the coupon of this bond to be paid on 31st December of a particular year? That is what the question is all about. Is there any answer? Not yet. Okay, so no problem. I will provide it if you don't have it. Yeah, good. No, so yes, so the question is whether Eurobond is denominated in only stable currencies. By stable currencies, I think maybe you're talking about convertible currencies. Then I would say it's not a regulation that it must be in those currencies, but what it means is because of market acceptance. It's usually you need to have a currency that is strong, a currency that will have a wide range of investors coming for that issuance. Otherwise, what is the point of issuing when people will not buy? So that is the thing with that. That is the issue with it. So the answer is correct. It's 1.6 plus 0.5, which is equal to 2.1%. Correct. A is the answer. Again, like we said, it is based on the reference rate at the previous period. What of this is another one for you. This is another one for you. When it's for you, just use it and shine. Just keep it coming. Let it come. What's the answer? This type of questions, when they come, please don't waste time on them. Just give the answer and you're fine. Yeah. So what is the best description for this statement? A contract between an issuer and the investor. I think we mentioned this. This document is called the bond indenture, and that is the document that we talked about that time. It's a bond indenture, and this is where this is what the analyst is explaining. I'll just move a little. Which of the following embedded options most likely provide a benefit for the issuer? Which of these bonds provide a benefit for the issuer? Which of these embedded options provide a benefit for the issuer? What's the answer? Yeah. A call feature will benefit the issuer. This is correct. The call feature will benefit the issuer. The way this is done is that the call feature will benefit the issuer. Now the way this is seen, the way you look at these things is that when you have a call feature, what it means is that the option to call that bond is with the issuer. And if the issuer has the option to call the bond, then the issuer is the person that will be benefiting, and he will likely call this bond when interest rate is going what? When interest rate goes, beautiful. So when interest rate goes low, so look at what the issuer will do. The issuer will call, because it's paying you high interest rate on this bond, the issuer will call back this bond and issue another bond. So, you know, or he issues another bond at the minimum rate, take that money and pay you back. So that is how the issuer takes advantage. In terms of yield, my people, which one will have a greater yield? So I have a putable bond, option-free bond, and a callable bond. Which one will have a greater yield? Which one will have a higher yield? A putable bond, an option-free bond, a plain vanilla bond, and a callable bond. Which one will have a higher yield? We are together, we are talking together. Just say your own. Is it callable, putable? Which one will have a higher yield? Yeah. So a putable bond will have a higher yield. A putable bond will have a higher yield. A putable bond, the reason why a putable bond will have a higher yield, sorry, did I say putable? A callable bond will have a higher yield. And the reason why a callable bond will have a higher yield is because the callable bond the issuer needs to pay the callable bond for buying that option of calling the bond before maturity. And that is why a callable bond will have a higher yield. For a putable bond, it is the investor that is enjoying that benefit, and therefore the investor will have to pay for that. Let me just look at something to ask a question on. This one, first, can you just give me an answer? And then we move on. Which one is likely to be preferred by investors in a falling interest rate environment? Interest rate is falling. Which one would the investor prefer? Which one would the investor prefer? Is it a floating? Which one would the investor prefer? A floating rate, a cap floating rate, yeah, a floating rate note with no cap and no floor. So for this one, the answer is a floating rate note. This is what the investor, because it's a falling interest rate environment, a floor will provide a kind of a floor where interest rate will not go. Even if interest rate go below a certain point, the person will still take his 6%. So this is what you prefer. If you have a cap, it's a different thing, right? A cap is just to say that if interest rate goes above a certain area, say for example is 7%, and if our cap is 7%, even if interest rate goes more than 7%, we'll still be taking 7%. That's what this means. Again, let me just explain something about the floating rate, so that you know that an FRN, which is a floating rate note, just know that floating rate note will have an inbuilt flows. Floating rate notes have inbuilt floors. So you know the definition for floating rate note, it is something plus the reference rate, right? You have a spread plus the reference rate. So it can't go below. So usually with this kind of thing, there will be a zero mark so that it can't go below that. So it has a floor. Inverse floater, which we are going to be seeing later, has an inbuilt cap. Inverse floater has an inbuilt cap. Just something to note and put it in your diary somewhere. Let's move on. Which one of these is least likely? So in CFA exam, you'll be seeing this least likely, most likely. Sometimes when I see least likely, I will just say it is not, and then forget the issue and then move on with that. Yeah. So which one is least likely, please? Least likely an internal credit enhancement. Least likely an internal credit enhancement. You remember for our internal credit enhancement, we said it is this. For our external credit enhancement, we say it is this. So it's if you are not in the Lagos Business School, then you cannot be internal. You cannot, if you are in the Lagos Business School, you cannot be an internal credit enhancement. All right. Again, yes, beautiful. So one of the following is least likely an example of a Eurobond. So least likely an example of a Eurobond. What will this be? What would it be? So I will from here. What's the answer? Please. Which one of the following is least likely to be an example of a Eurobond? Yes, Mohammed, Amina, Benga, Mariam, I can see all of you, Gloria, fine. So least likely, right? Least likely. A UK-based company issuing Japanese yen-denominated bond into investors domiciled in Japan. What is the name of this bond? What is the name of this bond? What is the name of this bond? Yes, I mean, that is correct. That is a foreign bond. Beautiful, beautiful, beautiful. You are all correct. You are all correct. Because you are all correct, I will just, there are some yield measures I did not discuss, but I want us to answer this question. The current yield to maturity is the internal rate of return of a bond. Meaning if I hold a bond to maturity and there's no default and then I'm reinvesting the coupon at the yield to maturity, I will get at the original yield to maturity, I will get the yield to maturity. That is the yield to maturity. Then you have the current yield, and this is the current yield. Can somebody give me an answer to the current yield? It is annual coupon divided by the price. Annual coupon divided by the price. And it's important to remember that it's annual coupon you are using for the current yield. Simple yield we say annual coupon plus or minus amortization of principal or discount and divided by the price. Is that okay? So I'm just saying, answering the question for me, and then, but I will just take it that yes, you have all seen it, you have all used your calculator, and then you have gotten the answer correct. Let me just take this. I think I can do this. This type of corporate bond is most likely classified as what? This one is most likely classified as what? This kind of note. Olumide, are you doing AA and AA and AA and B? Which one is okay? Yeah, so which one? Yes. So the answer is yes, the answer is B, and this is an example of an inverse floater. Now, with an inverse floater that has a factor greater than 1, what do we call this inverse floater? The multiplier is greater than 1. What do we call this inverse floater? What's the name that we give to this inverse floater? Because the multiplier is greater than 1, we call it, nobody is helping me, leveraged inverse floater. Leveraged inverse floater. If it's less than 1, it is called deleverage. Deleverage inverse floater. Beautiful. Adeinka, this is correct. So I think we basically answered most of the questions. So let's just, this would have been a very good question for you to answer, but I'll just leave it because we are just behind schedule. And then with this part of the reading, I would just want to just explain some few things about this part of the reading, and then I want us to just move on and do some questions quickly to explain some of the concepts that will be seen. So in this reading, you need to talk about the market. This is about the market, and for the market, we have primary market, and then we have secondary market. We have primary market and secondary market. Primary market is the market for the original issuance. So when you originally, from the beginning, come to the market to buy, to sell your issue, it will be at the primary market. And this primary market, the relationship between the investor and the issuer, the relation between the investor and the borrower, who is the issuer, is actually determined at this primary market. That's the first thing. So it is at the primary market that the money comes to the issuer. All those things happening at the secondary market, it is between investors. So that doesn't come back to the issuer. In the primary market, I'm saying we have two types of offering in the primary market. We have the public offering, and then we have the private placement. Public offering and private placement. In terms of public offering, the one that is important for us to know in this one is the underwriting offering. And then for the underwriting offering, what you have a firm commitment from an underwriter to an investment bank to say that if you are issuing 5 million for 5 million naira, we are committed. We are saying that we'll give you will get 5 million naira. So it's like insurance. They're saying no problem, you will get the whole 5 million naira. And so that goes to the issuer. But the next one is to say best effort. With best effort, what they are saying is that I'll go and try. I'll try my best to do it. Whatever it is that I sell, good and fine. If I sell, you give me my commission. If I don't sell, that goes back to you. So this is called best effort, and you just pay commission for this, for the part that has been sold. The last one is the next one is auction, which is usually used by entities to just to sell out, especially the governmental entities, and so mostly like central banks, they use those to auction to sell out the money market instruments. And then you also have the shelf registration, which uses the one big prospectus for the whole issue. And you know, it's like the name shelf just means that I can put it in a compartment, you know, and wait and just be taking it out from time to time. And that is generally what that means. It's just shelf. On shelf just means that the shelf registration, I register everything as a whole, but then I'll be issuing it gradually from time to time. In terms of private placement, this is where you don't go public, you go to private individuals, usually well-to-do individuals to invest. But then in terms of secondary, we have only two types here. We have the OTC, over-the-counter market, and then we have the exchanges, organized exchanges. So for over-the-counter, it's just a market. It's electronic actually, but it's a market between individuals. So two parties can just do a transaction over the counter. But then with organized exchange, it has to happen in the exchange, following the rules of the exchange. So the exchange is in between the parties that are doing the transaction. The last part that I want you to note in this reading is about repo. Repo is a collateralized transaction between parties, and then two parties are doing repo. When you do repo, what you are doing is you are saying you are giving out a security to collect money. And then when you collect money, you are promising at that same stage, when you are doing that transaction, that you are going to be buying back your security at a certain time in the future. And that is a repo. When you need money, you give out you sell your security. Basically, it's a sale transaction. You sell your security with a promise to buy it back at a certain time in the future. The price will be known today, and that is a repo. Now, if one party is doing repo, the other party is doing a reverse repo. So the way it is looked at is, I receive your money, I will do repo. The person who is receiving money is doing repo. The person who is receiving security is doing reverse repo. That's just how you hold this thing. If I'm looking for money, I will do repo. That's how this thing is. If I'm looking for money, I will do repo. Now, for repo, what I want you to also get is about what affects the repo rate. The repo rate. Repo rate, what would make the repo rate to go high? And let me just say what affects the repo rate and what affects the repo margin. Repo margin. I should have explained this. If I take the selling price and I subtract the call value, that is what, the repo, the selling price, I subtract the repo price, selling price minus the repo price. This will give me the repo rate. This is the repo rate. And then I can, if I take out the call value, I will have if it's a collateral value I'm taking out, the difference between that and the collateral value is what we call the margin. The margin is the haircut. It's also called the haircut as well. So repo rate and repo margin. What affects the repo margin? Now, for me, for the example, please just take this, that anything that increase the risk of the transaction will increase the repo rate. Anything that reduces the risk of the transaction will reduce the repo rate. So let's look at it, repo rate. If repo rate is, so let's take one factor, and the factor that I'm going to take is collateral quality. Collateral quality. If the collateral quality is low, what happens to the repo rate? Remember, I said anything that increases the risk of the transaction will increase the repo rate. Anything that reduces the risk of the transaction will reduce the repo rate. So now I'm saying, if the collateral quality is low, what happens to the repo rate? Yeah, correct. Repo rate will increase. This is generally how you answer it. What happens if the collateral quality is low? What happens to the repo margin? What happens to the repo margin now? What happens to the repo margin? I'm changing it, not the repo rate now, to the repo margin. What happens to the repo margin? Yeah, what happens to the repo margin now? Yeah, the repo margin, no. What happens to the repo margin? The repo margin will be high as well. The repo margin will be high as well. If the collateral quality is low, both the repo rate and the repo margin will be high. So just for a summary for you all, both repo margin and repo rate are inversely related with the quality of the collateral. This is a general statement, right? Both the repo rate and the repo margin are inversely, these two, repo rate and repo margin, are inversely related with the collateral quality. The higher the collateral quality, the lower the repo rate and the lower the repo margin. The lower the collateral quality, the higher the repo rate and the higher the repo margin. And you take this for the others. If we say it is high demand, if the collateral is in high demand, you know that then the thing will be low. If it's in low demand, the thing will be high. If it requires delivery, the delivery reduces risks. So it should reduce the repo rate and repo margin. That way is summary. For me, the summary for you is just to know that anything that increases the risk of a transaction will increase the repo rate and the repo margin. So for collateral, I mean, it's inversely related both. I think those are the significant things that I significantly want to cover. So all you need to do is to be answering these questions as we move. A fixed income security issued with a maturity at issuance of 9 months is most likely classified as what? As money market. Beautiful. Money market. Yes, money market. Now let me ask this question. A security that has been issued 15 years ago, was issued 15 years ago, but now that's 15 years ago. It was issued. No, it was issued. It's a 15-year. It's a 15-year instrument that was issued 14 and a half years ago. That was issued 14 and a half years ago, meaning that it has now only 6 months to maturity. Is this instrument now money market or secondary market? Or capital market, sorry. Money or capital market? Money or capital market, okay? Money or capital market. Only 6 months. Remember, this security has only 6 months to maturity. Is it a money market or a capital market? Remember our definition. I've got it someone. Yeah, I was waiting for someone to come in and I have a friend. So I have another friend again, Ibrahim Bello, So if they put the name, if they name the person, my name is Musa Bagudu now. So when they give me the name, whether it remains 1 year to, okay, for the person to permit or it's the same Musa Bagudu now. Okay, that's what I mean. So it doesn't matter the years, it doesn't matter how many months remaining to maturity. Definition of the capital and money market is related to the issuance from the beginning. All right. What of this question? The price of a bond issued in the US by this company and denominated, this is most likely to respond to which interest rate? I think we have discussed this fully, and then I know you are not going to disappoint. What's the answer? Price of a bond issued in the in the United States by a British company and is denominated in US dollar will most likely be responding to a change, likely to change as US interest rate change. It's like, yeah, everybody got this, and that is beautiful. That is beautiful. What of this? I think we are making good head. Everything is going so far, so good. So far, so good. Yeah. This Australian company. This is an Australian company that has financed a joint venture project in Singapore using a 15-year fixed bond, paying semi-annual bonds, coupon that are denominated in Singaporean dollar. The bonds par value to be paid at maturity in US dollar. So this will be a dual currency bond. You all got it. So I didn't get you here. I didn't get you here. I didn't get you here. Didn't get you here. What's the answer to this one? Didn't get you there. Which of the following product provides protection from inflation? I thought you say floating, and then you would have been okay. You would have been okay as well. Which type of security is this one that we are putting here? Yeah. Which type of security? So a 10-year bond is issued 1st January 2020. Its contract requires that its coupon rate change over time as shown in this table. So in this period, specific periods, coupon rate is increasing based on specific period. This security is most likely described as a step-up coupon bond. So sometimes when everybody is getting it, you just be happy that nobody is saying floating rate, and so we are good. All right. So the level of repo margin, what is the answer? This is just to test what we just did at the last stage. So good, beautiful. So anything that increases the risk of the transaction will increase the repo margin and will increase the repo rate if it's at the repo rate. Is that okay? Then remember also that the repo margin can also be called a haircut. Beautiful. So I will just leave this. Let me see. What's this? Yeah. All right. This is beautiful. So this is zero bond. Yes. Correct. Please, are we together? Let me know that we are together, because I saw that some major clicks are taking it over. So let's go on. And now this reading is very important and very heavy. I will just take some time to talk about this reading, but please, it's very important for us to understand this reading. This is introduction to fixed income valuation. But most of the things you have in this reading are actually things that the calculator can do for you. And usually I say when the calculator can do anything for you, allow the calculator to do it for you. There is the relationship between coupon and required return, price versus par value. So between coupon is a very straightforward. If coupon is, let me just say, if coupon is greater than the required rate of return, is the bond required return? Is the bond going to be trading at a discount, premium, or par? I want to know the relationship now. Coupon is greater than the required return. The coupon you are paying is greater than what the investor should normally require, so the bond will trade at a premium. Beautiful. Beautiful. My people are actually ready for the exam. This is to say that as these questions are coming, you are ready. And that is what is making me happy now. As I'm here now, I'm happy. Happy because I've seen the questions and the answer that are coming. I know that you are prepared. What of in terms of the relationship? Okay, I think this has covered. This will cover for us so that we'll not waste so much time. I think we are good in that area. Yield to maturity assumptions is important. We have 3 assumptions for the yield to maturity: that you are holding the bond to maturity, that you are investing the coupon at the yield to maturity, and also that there is no no default, no issue of credit risk. Those are important. In terms of the relationship between yield, we have the inverse effect. Inverse effect is the inverse relationship between price and market discount rate. If market discount rate goes up, the price of the bond will go down. That is what that relationship is talking about. We have convexity effect that will say that the percentage change of the percentage change in price for an increase in rate is different from the percent in absolute terms. The different is so the percentage change in price for a decrease in yield is higher in absolute terms than the percentage change in price for an increase in yield. So that is the convexity effect, and the coupon effect is just saying that the higher the bond, the coupon, the higher the coupon, the less the sensitivity of the bond. The lower the coupon, the higher the sensitivity of the bond. Then the maturity effect is just saying that the longer the maturity, the higher the sensitivity of the bond. The shorter the maturity, the shorter the maturity, the lower the sensitivity of the bond. And then you also look at the pricing. We'll look at different ways of pricing the bond. You can price a bond using the spot rate. You can also price the bond using yield to maturity. You can price the bond using the forward rate. All those things are supposed to be in our kitty. And then we'll also be able to do calculation of the flat price of a bond, accrued interest, and full price. The good thing is that the calculator is ready to do for you. Periodicity of compounding calculator will do it for you. In terms of yield, you need to do some different kind of yield measures. And then you also need to look at metrics pricing. In metrics pricing, what you see, something I want to bring your attention to, which usually escape us, is the fact that what they want us to know about metrics pricing is just about describing metrics pricing and not calculating metrics pricing. So most likely what you get in metrics pricing is not about calculation, it's about describing metric pricing. What is it used for? We use metric pricing when the bond that we want to value is thinly traded or is not even trading at all. So you need to have some bonds that are trading that are similar, that you need to now deduct the price of this bond from the yields of the other bond. We also talk about periodicity and credit conventions. You should be able to talk about yield convention, street convention, which is the usual what you usually use, and you have the true yield and you have the simple yield, and then we already saw the current yield calculation. Then you also have the callable bond, how to value callable bond. You have yield to first call, yield to second call, yield to worst. Be able to call to do this. Yield to worst is actually the lowest of the yield to maturity and the yield to calls. So the same thing you do for the par value. Know how to do it for floating rate notes valuation and the rest. So let's look at questions. Maybe they will help us to solve. Now is the time to be ready with your calculator. Like I said, I'm using mine. I've been using it for a very long time. You see, I qualified in 2014, so I've been using it since then. Remember, it's not just that I qualified in 2014. There are stories. I can't tell you how long I've been writing the exam, but what it means, what is important now is I've qualified, and so it doesn't matter. You see, when I wrote the level 1, let me tell you a story so that your time will go. Sorry about that. When I wrote level 1, I got it at, as I'm talking, you are solving. When I wrote level 1, I got it at the first attempt. So I did level 2. The first time I failed the level 2, I did the second one and I passed. That is not where the story is ending. So when I came to when I came to level 3, I did the first one once. When I came to the second one, my mind started skipping because I said, this one that I did level 1 once, and I did level 2 twice. Let this level 3 not come somehow. So luckily for me, I passed the level 3 at the second attempt. So it shouldn't be like you did level 1 once, you did level 2 twice, and then you did level 3 3 times. So the answer here is, what is the answer? When I saw B, I was saying, why would that be? Please be able to master this. You have payment. I will just set up the calculation. You have payment of 150, right? Payment of 150. Somebody will say, how did you get 150? You know how we got 150? There is 10,000 value. Annual required rate of return is 10%, but this is the bond makes quarterly coupon payment. IY is 10 over 4. I think I need to do this so that somebody will not tell me 6% of 10,000. 6% of 10,000 divided by 4 is quarterly. And then IY, I gave you IY, then N is equals to 2 times 4, which is 8. Feature value is equals to 10,000. All you need to do is to calculate your PV, right? Calculate your PV, and if you do that correctly, yes. So if you do that correctly, you have 9,282.986. All right. C is correct. Be able to know how to do this. This is another one. What's the answer? Here you use, make sure you use your iConvert function. Let's use our iConvert to do it. You know, you have a 10% 10-year 6% semi-annual coupon bond that is priced at this. The yield to maturity of the bond on a semi-annual bond basis is already given to us at 6.23. The yield to maturity of the bond, assuming monthly periodicity, is closest to. So for monthly periodicity, we have to convert this. So we take our calculator. I convert, I think it's second function, what now? Second function 2. I convert, that is second function 2. And if you do that, you will see norm. For the norm, put the stated rate that is given to you as 6.23. 6.23 and enter. Norm 6.23 and enter. Then if you do arrow up, you will see CY. This is semi-annual, so the CY will be 2. 2, enter. CY will be 2, so do 2 and enter. What you have done, you will now see arrow up, you see EFF, effective yield. So you compute, tell the computer to compute effective yield and to give you the effective yield. Effective yield, 6.32703. Now, all you need to do from here now is just to change the periodicity to monthly. CY will be 12. Enter. CY. Change your CY to 12. Enter. CY to 12. Enter, and then compute your nominal. And your nominal is 6.150606. Are we together? I don't know if you are together with me. If you are not together, do a shout out, and then let's hear you. Some of you might not have known that you can use the calculator to do this. You just get confused, and then, or you have been using the almighty formula, and then you see that the almighty formula is not as fast as what you have done with your computer. What we have done is that we only simply set the periodicity. Rate is given to us in the question as the stated rate. We just change it and change the periodicity to 2 so that it will give us the effective rate. And when we get the effective rate, what we need to do is we now go back from the effective rate, we change the periodicity again to 12 and get our nominal rate. And that is the rate that we can compare. This rate of 6.15 can be compared with the 6.23. So 6.23 is on semi-annual basis. 6.15 is on the monthly basis. So please, guys, please, where can I get the calculator from? Where can I get the calculator from? Okay, I will allow them to answer where you can get a calculator, but you can also ask the internet. I'm sure that you'll find it around your area. Usually the calculator is, this is mine. You can get the calculator on Konga, any of those places, or you order it from if it's not here. But you can order from Jumia, yeah, so fine. Are we good with iConvert? So let's move on. Which one? Let me see. I want to. This 12-month spot rate is 4%. The 4-year spot rate is 6%. So I just what I did was just to select some things that will just give us some small time so that we'll be able to solve. Given the rate stated on the semi-annual bond basis, the rates to be converted, you have to convert this because this rate are stated in semi-annual bond basis, but then they are all the same, no problem with this. So what it's saying is that 1.03, you see the rate, 12-month rate is spot rate is 4%. The 4-year spot rate is 6%. So you have 12 months, that is 1 year, and you have the 6-year spot rate. Which of the following is the closest to 3-year forward rate starting in 12 months? You know, see what you have. 1-year spot rate is given to you as 4%. 4-year spot rate. 4-year spot rate is given to you as 4-year. Is it 3? 4-year spot rate is given to you as 6%. This is 1 year. This is 4 year. What they want you to calculate is a 3-year rate that is starting from here. So this is what you are going to be calculating. What is that rate here? What is the rate here? That is what you are calculating. From the end of 1 year to the end of the year 4. So what you usually do here is to say, okay, I will just take the longest distance, 0. Actually, is if I say I will do it correctly, it is 6%. Let me just say 1 plus 6% divided by 2, because we are going to be taking the semi-annual period. 6% divided by 2 is 3. I'll just set this up and then leave it to you to calculate. But this 6%, please remember that you have to raise it. You have to raise it to the power of 8. That is 2. The 8 there is the period, the 4 period. Let me take off this. The 4 times the 2. That is why it is 8. 4 is, it's 4, but then this periodicity of 2. And then you also have 1 point, I won't say 1.02, I will say 4. I will say 1 plus, so that you do the calculation yourself. 1 plus 4%, divide this by 2. This one will also be raised to the power of 2 times 1. It's a 1, or rather, let me just say 1 times 2 so that it will rhyme with the time period. 1 times 2, and this plus 1 plus f. 1 plus f. This 1 plus f will be also, remember, if you have your f in 2, then if you are dividing by 2, you have to do it this way. But then at the end, you have to multiply by 2 again. So here, this f will also be raised to a certain power, because at the end, this 2 and this will be giving you the 8. So 1 times 2 is 2. Here, you will be having, because the period here that you need is from the period 1 at end of year 1 to this. So here you will have 3. The period is 3 times 2. So which is 6. 3 times 2. So I'm leaving this equation so that you solve it you solve it at the end. But I've set up the equation for you. I've set up the equation for you. Just collect light and solve that, and then give me the answer. You can post the answer later. Because of time again, I'll just move on. I want to be sure that I reach the duration side before the time will tell me that it is time. Some people, that is where they want us to take the time off. Yeah, I think we can also do this. What is it? You want me to give you some time to do this, or we just go ahead and start solving? So for this, you go to you use the second function in your calculator. Second function bond, where is it again? You know, the eye is going, even with the glasses, you have to look at it again. Second function is bond is 9. Second function 9. As we are solving, if you are solving your own, just don't worry about us. You can go faster than us. You will see, if you have my same type of calculator, you see settlement date. For settlement date, as settlement date is given to us as 20th to 30th June 2013. So to put this in the calculator, I will just do 6 dot. 6 is the June. I will say 6 dot. Then I will say 30 for the day. So 30, and then 13 for the year. 13, I enter. And I enter. Then I do arrow down. Arrow down. You see, then I do arrow down. I see coupon. Yeah, I see. If I do arrow down, I get to the coupon. For the coupon, I will put, it says 6% coupon. So I'll put 6 on the coupon size, and I do arrow down. If you do arrow down, you will see redemption date. And for redemption date, we have, that's the payment date. The bond matures on the 30th September. So it's September, it's 30th September. So it is 9.30, sorry, 9.3018. And enter. 9.3018 and enter. Right? If you have done that, you do arrow down again. You will see, so arrow down, you will see RV. You will see RV. RV is 100. RV is 100. It's just a par value, whatever you use, but you 100 of par value, and enter. And then you will see 360, because it said they are on 3360. So if you do arrow down, you see 360, that is fine. If you don't see 360, do second function set. Second function set will change it to actual. So second function set will change it to actual, and then second function set will change it to 360. So whichever one you have, make sure you have 360, please, because that's what is given to us here. And then if you do your arrow down after the 350, you do your arrow down, you see the yield is 2y. 2 over y is saying semi-annual, and we are giving this as semi-annual, so I will leave my old. But if you don't have semi-annual, please. Hello? So if you don't have semi-annual, please do second function enter or second function set, and it will change it for you. You get the semi-annual. Then afterwards, your arrow down, you will see yield. Yield is given to us here as 5%. So the yield is 5%. Yield is 5%. So I will enter 5%. And then when you do arrow down, you see price. I will say compute. So this is the price. Compute. And it gave me the price of 104.5 It's actually 558. When I move down, I'll see accrued interest. Accrued interest, they gave me as 1.5. So with this, I can answer this question. Calculate the full price. So you can actually see that we already have our full price. What is the full price? Full price is the flat price plus the accrued interest. Full price is flat plus accrued interest. And in this case, we have the flat here, and then we have the accrued interest here. All we need to do is to add them up, and they will give us that. So if you are used to doing this by using the formula way and then getting present values, please, I will advise that find a way of leaving that one since we have moved to a new age. Please leave that one. Use your calculator and be conversant with the calculator. You have paid money to buy the calculator. Allow the calculator to do that for you. I'm tempted to say I will allow you to do this, but because I know we are speeding against time, I will just leave this. But you can take a picture and then attempt that on your own. It's just the same procedure that we followed. Please, even though we have not solved some of these questions, make sure you'll be able to solve a question using the interest. When we say if interest rate is high, what does that mean to the yield? Sorry, what does that mean to the price? All those relationships, you should be able to say it. Sorry, I just need to. This A is for which one now? I think it's for this question, right? 32. Olumide is for 32. Okay, I'm told I have some few minutes to finish, so let me just move on. I will just take the last periods. I wanted to do calculations on some areas, but so let's move on. Sometimes I think we need to have a more detailed period to do some of these things properly. This side is just for you to know, to look at what is time tranching, what is credit tranching. When you say you are protecting against prepayment, what does that mean? Those are the things that you have here. But since I have just some few minutes to go, let me talk about this area of duration and convexity. The source of return, for the source of return of a bond, I don't know whether it is okay to just mention, but for the source of return of a bond, we have three main sources of return for the bond. We have the coupon plus the coupon reinvestment income for the bond. Sometimes when I start, the time will just be moving as if I have source of return. We have coupon plus the par value. We have the reinvestment. This is one. There are three sources, right? Two is the coupon reinvestment income. Coupon reinvestment income. And then the third one is the capital gain or loss. But this only happens when there is a sell. When there is a sell, when the interest rates are changed and there is a sell, that is when you get this. But if you are holding to maturity, this is what you have. But when you sell and you are selling at a price below or above the carrying value, if you are selling below or above the carrying value, you get this part of the return. Now, another thing I want to add, another thing you want to look at is the duration. I want to do something about the return calculation, but we don't have time. I think we're okay. Let's talk about the return. When you want to do a total return calculation, it is just to take the coupon plus coupon reinvestment, which the calculator can calculate for you, and you have the par value, or you add or the sell amount, the sell price, depending on where you are selling, and this will give you the total return. Then if you need to have the realized return, you have to calculate the realized return, differently, and it's just because of time, but we can use the calculator to calculate the realized return. But then let me quickly talk about the duration for people to just have a view of what duration means. Duration actually is the price. When you say duration in the bond market generally, what you are talking about is the sensitivity of the bond to change in the price. So there are different ways. When you said when interest rate goes up, the price of the bond will go down. When interest rate goes down, the price of the bond will go up. We say by how much. That by how much is what duration is all about. It's telling you by how much. So if interest rate goes up by 5, so if duration is 5, what this is saying is that if interest rate goes up by 100 basis points, so by 100 basis points or 1%, then it means that the price of the bond will go down by 5 times the value of the bond. 5 times. So the duration is a multiplier. The duration is just multiplying that value and say the price of the bond will go down by 5 times. That is what duration is all about. And then we have 3 types of duration measures in this case. We have 2 major types of duration measures: yield duration measure and curve duration measure. For yield duration measures, they measure the sensitivity of the rate to the change in the yield to maturity, while the curve duration measures measure the sensitivity of the bond to change in the benchmark yield curve. Now, for this level, it is only the one duration measure called effective duration, since we don't have time. It's one measure called effective duration that is used, that has a benchmark that looks at is a curve duration measure. And so the effective duration is used in this way. Macaulay duration, modified duration are all in this category. Macaulay duration measures the bond sensitivity. It measures the weighted average of the time it takes to recoup or to get the principal and all the cash flows of the bond. That is what Macaulay duration measures. Well, and you can actually use, we don't have time, but you can use the calculator, that bond calculation site. You can use it the same way to calculate the duration, but the duration you are going to be getting is modified duration. So please, if you have a modified duration, multiply the modified duration. The calculation is Macaulay duration is equals to modified duration divided by 1 plus R. Sorry. Modified duration is equal to Macaulay duration, because Macaulay is bigger. Macaulay duration divided by 1 plus R. So don't worry, I'm following the time. Modified duration is Macaulay duration divided by 1 plus R. What it means is that Macaulay duration, if I get my modified duration using that calculator, I will have to get Macaulay duration will be equal to the modified duration times 1 plus R. So that is what you get using that calculation, that calculator that we have. It will give you the same, just follow the bond calculation. So another point I want to make here is that both modified duration and Macaulay duration are yield measures. So they don't give you duration when the bond has embedded option. If a bond has embedded option, it's only effective duration that you can use. Effective duration can be used for all the bonds. It can use for all the bonds, but it's only effective duration that can be used for bond with embedded option. That's a point that I should make before I leave this area. There's an area about duration gap that you need, and duration. There's a formula for duration that is a straightforward thing that you need to just use to calculate duration. The thing about duration is also the fact that the higher the duration, the higher the sensitivity of the bond to the change in price. So factors that affect duration will include maturity. The longer the maturity, the higher the sensitivity. This is usually so for a par bond and a premium bond. But for a bond that is trading at a discount and has a long maturity, then that bond we say is usual. For this one, it is usual for those bonds, but then some of those bonds at a certain time, it will just tend towards perpetuity. But yes, a longer maturity, more sensitivity, low coupon, higher sensitivity, Low yield to maturity. Low yield to maturity, higher sensitivity. If a bond has embedded option, this I'm just giving you as a summary, then that would be low sensitivity. If the bond has, this is a floating rate bond, low sensitivity. So I think this will summarize some of those things. A zero coupon bond, because we say low coupon, lower coupon, higher sensitivity. Therefore, a zero coupon bond will have a duration that will equal to its maturity, and so it will have the lowest sensitivity. To have the lowest sensitivity. The highest sensitivity, because it has the lowest of the coupon. The coupon is 0. So if a coupon is 0, it has the highest sensitivity. The maturity for a zero coupon bond, the maturity is equal. The duration of the zero coupon bond is equal to the maturity of the bond. Duration of a zero coupon bond is equal to the maturity of the bond. All right, for a zero coupon bond. All right. Just so that we don't leave this things empty, just yeah, I said this, you can use a calculator to calculate. This is an example in end of chapter question. So use the calculator, the bond calculator side. Please, if you have any issue, you can get back to me. Just want to make sure you cover areas that you're supposed to cover. Yeah, you can do this also with the calculator. Then the duration gap. The discussion around the duration gap. What is the duration gap? The duration gap is just the difference between Macaulay duration, and the bond's investment horizon. If Macaulay duration is greater than the investment horizon, if Macaulay duration is greater than the investment horizon, we will say that Macaulay duration greater than the investment horizon, we said it is positive, right? And if it is positive, you have a price risk. Because I'm just trying to summarize. Price risk just means that it is the risk of interest rate going up. If Macaulay duration is less than the investment horizon, it means what you are facing is the reinvestment risk. And the reinvestment risk is the risk of interest rate going down. So what I'm saying here is that we have two types of investors. One is a long-term investor, and the other one is a short-term investor. I will take 5 minutes to explain this to round up, please. We have two types of investor. One is a long-term investor. The other one is a short-term investor. For a long-term investor, what the investor is interested in is if the long-term investor is represented as the investor who buys security and hold to maturity. If you buy a security and you hold it to maturity, what your concern will be, what will change, what will affect your realized return is when interest rate goes down. So a long-term investor is afraid of interest, is facing reinvestment risks. This place now, this is a long-term investor. The short-term is the one that has a positive duration gap. A long-term investor will have a negative duration gap. So why I'm saying short, so that you know, is that short-term investor is afraid of price changing, because if price move, you are going to be selling the bond at a price that is maybe below the market value, the carrying value. If you do that, you have a loss. So for a short-term investor, is afraid of the price. So the price of the bond going down, and that is for the interest rate going up. So the way I balance this is to P. If duration gap is positive, you have P, which is price risk. Anytime you have a positive duration gap, just remember it is price risk, and that is all. We don't need the other ones, because if you know that it's a price risk is the risk of interest rate going up because the price of the bond will go down, then you are covered. Meaning that if the duration gap is, and make sure that when you are calculating duration gap, use modified, and you are giving a modified duration, use Macaulay duration. Know that the definition has to you have to use that formula that we gave that time. Multiply your modified duration with 1 plus R to go back to Macaulay duration, subtract investment horizon from Macaulay duration to get that. Please, maybe I should just take some questions. Okay, let's answer one so that it will be that we answer one question, because it's just 5 minutes. And then if you have question also, let me know before we close. Let me have a question to answer. Is there any question? Do you have a question now? We have some few minutes, I think 5-6 minutes. Duration gap is Macaulay duration minus investment horizon. Here you are giving, yeah, somebody has answered it for us already. Here you are giving modified duration. So you need to, what this is saying is that because we are giving modified duration, and we know that modified duration will be, you have modified duration. And if I want to convert modified duration to Macaulay duration, it is modified duration times 1 plus R. So you see that Macaulay duration is higher than modified duration. So automatically, if it means that Macaulay duration for this is higher than the what? Than the investment horizon. Macaulay duration is higher than the investment horizon. So if Macaulay duration is higher than investment horizon, then we now say that the duration gap is positive. If the duration, this actually by usage. So if I want to master the calculator, I would prefer to use it on several areas, and then have time before. So if I'm in certain area, I will use the calculator. YouTube is good. You can have some videos on YouTube to show you how to use the calculator. The best way, I think, is by practice, because sometimes if you just watch a video, a complete video on calculator, you still forget. You know that yes, the calculator will do this function, but you forget what to do. So I would just say that at a certain, if you do that, yes, you do the video, you write some things down, but then when you come to use the calculator, at any point use the calculator. So if I want to do price, I'll use the calculator, and then keep repeating, keep practicing. You practice and you get perfect with it. Any other question? So the answer here is B. The answer is B. The duration gap is positive. There are some other questions that we have. Please, it's not as if they are not important. I still try and see what you can do about it. Good to read. Do you have any question that I can answer? Otherwise, I would just say it's a pleasure for me. Okay, so this one. Yeah. Correct. So I would say if there's no problem, from our weather in Abuja, I would just say I'm signing out. If you have any question that you need to find out, if you have any problem, I gave you my number already. Please reach out and make sure if there's anything we can do. The society office is there. We are here to assist in your preparation. You can't see me physically because most of you are in Lagos and I'm in Abuja. But then you have the contact numbers to contact us. We have our email addresses as well, so you can send us a mail. You can chat us. We are open. We are on LinkedIn. We are everywhere. You can see us anytime. So again, I will just say thank you so much for the opportunity, and I thank the CFA. So I'm typing my number 08082700083. I'm thanking the CFA Society Nigeria for providing this opportunity, and then please, then thank you so much, and good night and goodbye. Signing
Thank
out.
You very much, Musa. Thank you very much. Yeah. So right now we're going to be
number for them.
Okay, I'll do that. I'll put his number on the chat box. Right now, this we have ethical and professional standards. Dewey, I have let you co-host, so you can share your screen.
All right, thank you.
Good morning. Good morning, Udiri.
Good morning. And good morning, everyone. My name is Udiri. I'll be taking you through ethics and professional standards for the next 1 hour. So let me share my screen now. If you can see my screen, please let me know.
We can see your screen, Udiri. You're welcome. Thank you so much.
All right. So good morning once again, and I think it's a pleasure to be here. So for the next 1 hour, we'll be going through the ethics and professional standard curriculum. I want this session to really be very interactive because, like we all know, ethics is a very wordy, the content is very wordy. It's not like you're using calculator or something. So I'll do more of reviewing the learning outcomes and asking questions that you can drop the answers in the chat box. And if there are any question in the course of the presentation, just draw me back to it. You can also drop it in the chat box. All right. So if you look through let me put on my video a bit because of the network. So if you look through the curriculum, you will realize that ethics that used to be the first has now been moved to the last. It doesn't mean that it is less important now, but ethics is at the core of the investment management industry, which is why, so much requirement has been put under it. There are about 21 learning outcomes. And for today, I want to really run through the outcomes to ensure that we understand what is expected of us, at least even when we are reading or when we are reviewing our notes ahead of the exam. And there used to be 5 sections covered on that. There are still 5 anyway, but one of the sections have been dropped. The GIPS, extensive part of the GIPS, I would like to call it, has been dropped. And then the last session has now been dedicated to application, which means that what the CFA Institute is looking at is that we not just read and cram, but we understand, the context of this ethics and the ethical dilemmas that we face, in the investment industry, and we are able to apply it as appropriate, in the course of our work. So let's start with explaining ethics, which is the first learning outcome. So ethics is something we've heard every day. Let's remove CFA from it now. Ethics is a word that is common. So I want to ask you, in your own words, what would you say, or how will you define ethics in your own words? Drop your comment in the chat box. So in your own words, how will you define ethics? Can you hear me? Okay, somebody says ethics simply means doing it. All right, somebody says ethics means doing the right thing. Yeah, which is good. Any other comments? Okay, knowing what is right and wrong, knowing right from wrong. Yeah, any other comments? Making good choices, interesting. Somebody says simply the guiding principles of the profession. So what I would say, ethics, according to the CFA curriculum, ethics is described as a set of moral principles. I really like that word moral principle, and I really want to highlight it, which is why I'm using that definition. It's a set of moral principles that provide guidance for our behavior. So a set of moral principles that decide how to behave, that guides your choices, that guides your decision making, that also helps to decide, is this the right thing to do or is this not the right thing to do? So these are moral principles that guide the behavior of a community. It could be a society, it could even be a profession. And one of the interesting things about ethics is that it requires judgment. It requires the ability to make decisions and reach a conclusion. And those decisions are based on what you've read, what you know, what you've seen. Also, which is why one of the important things about ethics is that it's a moral standard that goes beyond just keeping the laws. and obey rules and regulation. It is more of a higher standard beyond the law. So we'll get to a point where we see that is there a conflict between law and ethics, or how do we balance law and ethics? And when you talk about ethics, you're looking at issues around fairness, you're looking at integrity, you're looking at transparency, you're looking at, does my actions affect the next person? Or do I take into consideration the interest of other people in trying to make a decision? So these are just components around explaining ethics, and why the questions may not state categorically saying define ethics. One of the things you will definitely see is different aspects of ethics being put into a question and then ask which one explains ethics best, or which one is more appropriate when it relates to ethics. So understanding that concept in the entirety is very important. The next learning outcome talks about describing the role of a code of ethics in defining a profession. So we are in the investment management profession, and when you say a profession is more of a community, a work community, or an occupation community that has specific education or expert knowledge, or a way of doing things. How do we practice what we do? So you talk about medical profession, you see the doctors, you talk about the legal profession, you talk about the accounting profession, and even the investment management profession. So, but there are code of ethics that define these professions. Every profession, when you are set up, they need to create a set of principles that members of that profession will have to follow, so that they are able to hold them to a high ethical standards. If you are in the medical profession and there are no standards, there are no code of doing things, how are you going to judge whether a member has done something right or something wrong? And the action or inaction of a member of that particular profession might even lead to the death of somebody or a patient, working in the hospital, and you're trying to do things, but so after all, there's no rule, there's no code of ethics, there's no standard governing us. So I can do what I want. So in order to ensure that the activities of the profession is streamlined, and every member does things in a set of way that is replicable to a large extent, there's a rule, there's a code of ethics that has been defined for the profession. So the learning outcome says describe the role of a code of ethics in defining a profession. So one of the things you might see in the exam is a scenario of a profession, and code of ethics are tied to that particular profession. Or you might even be given a generic question on, is this a code of ethics that relate to a particular profession? So understanding the purpose of a code of ethics in a particular profession, is also very important for the exam. Now, the third learning outcome talks about describe professions and how they establish trust. I've talked about profession as an occupational community that has specific education, expert knowledge, and a framework of practice and behavior that governs the trust of members, the respect of members, and also recognition of members. But it is these things, it is this set of standards that have been set, is this rule that have been set that helps to establish trust. Because if I want to deal with a doctor now, I know that there's a code that they live by in their profession. And because I know that there's a code that upholds them to a higher standard, that's already building a trust. So I can trust the doctor to do the right thing. I can trust him to ensure that it takes into consideration my own interests. So the establishment, the fact that there's a code of ethics in a particular profession helps to also establish trust for that particular profession. Now, for a profession to be credible and to be able to establish trust, there are certain things that needs to be in place. One is that there's a standard of behavior, which I've spoken to about. That profession also has to be able to provide service to the society. Every profession, to a large extent, comes together to provide service to the society, not to provide service to members, not just to make money. For the medical profession, it is to ensure that patients get good health. There's a standard that ensure that things are done in the hospitals and particularly to patients. Same in the legal profession, same in the investment management profession, and same in the engineering or other profession. So definitely a profession provides a service to society. And because they provide services to societies, those professions are client focused. The focus is to the people that they provide that service to, not to the members. And because of that, it holds them to a very high standard. And one of the interesting things about the investment management industry is that your duty is not to yourself, not to the firm to make money. It is more towards the clients that you serve in order to provide good returns to them, in order to ensure that their assets are well protected, in order to ensure that the way you're investing in aligns with their interest and aligns with their risk appetite or their expectation as investors. Now, I want to ask a question. Number 6 says, identify challenges to ethical behaviors. We know that, we all want to do the right thing. Everybody wants to do the right thing. And we always believe that if I'm put in any situation, I can always do the right thing. But the truth is that there are challenges to engaging in ethical behavior. And failure to acknowledge and to understand those challenges can lead to poor decision-making and can also lead to some unintentional consequences that probably are not planned for. So I want to ask, 1 or 2 people should tell me, what are these challenges to engaging in ethical behavior? What are these things that hold us back from engaging in ethical behavior? Please drop your answers in the chat box. What do you think are the challenges to us behaving ethically in any given situation, whether you are working in the investment management or you are working elsewhere? What do you think are the challenges to ethical behavior? Anybody, please drop somebody says money. Well, money is a very good one. And if you work in the industry that we work in, money is a very big appetizer. Somebody says overconfidence bias. Sometimes we feel that if you put me in that situation, I will be ethical. Until you are put in that situation, you really don't know whether you'll be ethical or not. And then somebody talks about situational challenges, money or fame, which is good. Overconfidence bias against stigmatization, interesting. Fear of disobeying superior, yeah, that's true. Situational influence, conflict of interest, bias, loyalty to employer. So what this shows me basically is that we've read the curriculum, and I think that that's a good thing. One of the challenges that the curriculum states is the fact that, particularly when you work in an investment management industry, the thought of salaries, of bonus, prestige, those things are things that tend to affect our judgment, and tend to make us take interest in the short term rather than looking at the overall picture. So people tend to believe that they are ethical and their ethical standards are higher than average. Everybody cannot be above average anyway. But what we've seen is that surveys have shown that this is not always the case, which is what leads to overconfidence bias. We are more likely to overestimate, our ability to be moral, our ability to do the right thing, when we are faced with that situation. And then we've talked about situational influence. Situational influence basically means that there are external factors that might affect you, that might shape our thinking and our decision making, that might impact on our behavior. And those situational influences are what we talked about: money, prestige, financial reward, bonus. So you take a decision because I know that at the end of the day, to impact my firm, and my firm will be able to pay me, large bonus at the end of the day. And somebody talked about loyalty to employer, which is a very powerful situational influence. When you are loyal to your supervisor, or you are loyal to your organization, or even loyal to your fellow employees, your colleagues, that can also influence your decision making, and can also impact how you take decisions, that are ethical, for your clients. So number 7 talks about compare and contrast ethical standards with legal standards. I said earlier that ethics takes you above the law, but there are times when something is legal, and something is illegal. But at the end of the day, it can also be ethical or unethical. So you might find yourself in a situation where I'm trying to think of an example to give. You might find yourself in a situation where, okay, so in Nigeria, for instance, insider trading is unethical. Even though the practice of that or the enforcement of that is not as, in other developed markets, but in Nigeria, insider trading is wrong. Now you might say, oh, because it's wrong here, you might go to another country and it's good to, it's not a law. There's no law that prohibits you from trading, from leveraging information to trade. But we all know that based on the code of ethics and the standard of professional conduct, insider trading is unethical. So, but the fact that you're in a country that has no law against it, that makes it legal. But at the end of the day, it might be unethical. So what that means is that there's a difference between ethical standards and legal standard. And if you always approach ethics from the point of view of not just what is right and what is wrong, because right and wrong can restrict you to the law. The law can define, oh, this is right, but this is wrong. But if you pay particular attention to that word, that key word where we define ethics as moral principle. Moral principle is very encompassing because it takes you to look at how will my actions or inaction impact on the next person? How will my action or inaction affect this organization? How will my actions or inaction affect the stakeholders around me? In a country, it could be seen that maybe killing somebody is not illegal. But does that mean that you should go ahead to kill somebody? Because that doesn't fall under ethical principles. So insider trading applicable in other countries might be legal, but it's unethical. And then whistleblowing is another case that compares ethical standard with legal standards. So we might say, oh, you're blowing a whistle against a wrongdoing in an organization. Is that legal? Is that ethical? In some places, it might be illegal, but we know that that's the ethical thing to do, particularly when a principle is being contravened or an employee is taking advantage of maybe information or something for his or own benefit, or even for the benefit of the client, or puts for the benefit of the organization, but puts the client in a disadvantaged position. So for the exam, it will be good to understand how ethical standard and legal standards compare, and also understand how they are different, and one is always higher than the other, which is the ethical standard. So yeah, the law is the law, but ethical standard takes you above the law. So if you see a question, and even when it states that the law is this, the question is, yeah, the law is this, but is that ethical or is that not ethical? So the mindset I want us to have is that when you're reading something, it's not about the law anymore, and if you also read the curriculum, you realize that the institute wants you to look at things not just, oh, this is a law here, but the law just gives you a minimum standard of what to follow. But ethics takes you beyond the minimum standard to hold you accountable for up to a higher standard. So when you have that in mind and you see a question, you're able to say, okay, it's not just about right or wrong. Is this morally right or is this morally wrong? So that's very important for us to note. And then describe a framework for ethical decision making. Now, the importance of having a framework is to put things in context, because we all want to do what is right and what is, at all times. But when you have a framework that has made it easy for you to do what is right, what that means is that there will be consistency. There will be consistency at all times, and it's easier for you to also justify, okay, this thing I did, this is the process I went through in making that decision. Not just that things are done just anyhow, arbitrarily, should I do this or should I not do this? But the concept of a framework for ethical decision just basically creates a process, around institutionalizing that ethical decision making in organization. And once you have that, it's easier for people to, once you follow that through, you get to a point where you say, okay, we can consistently, be able to make ethical decisions in this organization. And there are 4 steps that the curriculum has given us in engaging in ethical conduct. So I want us to be able to chat on that. So what are those steps? What are those steps in the framework for ethical decision making? Please drop your answer in the question, drop your answer in the chat box. In establishing an ethical framework to guide our internal thought process, there are 4 steps that the curriculum has given us. And I want us to state those 4 steps in the way it was given, not just telling me number 4 as number 1 or number 2 as number 3. What are those 4 steps? 1, 2, 3, 4. So, and state the entire 4 step, not just one out of it. So what are those 4 steps? Okay, I'm seeing the answer, but I want them together. All right, in the interest of time, I've seen identification, I've seen consideration, okay, I've seen decide and act, and I've seen reflect. So these are the 4 steps. Identify, what are those facts that I need to know? What are those things that I need to know? Who are the stakeholders involved in this decision? That I need to consider. What are my duties towards this stakeholder? And what are the ethical principles that I also need to be mindful of before I make this decision? And it's important for us, to highlight that. What are the ethical principles that I need to be mindful of? In this decision process, what are the conflict of interest, either actual conflict of interest or potential conflict of interest? So that's what the first step requires, for us to be able to identify the relevant facts, remove opinion, remove your biases, what are the relevant facts to this particular case? Who are the stakeholders in this particular case? What are the duties that I owe to them? Are there ethical principles that I need to follow, before I make this decision, or I need to be aware, and then are there any potential conflict of interest? And then once you're able to do that identification, the next thing to do is to consider. So consider what are these situational influences. We talked about situational influences as the external factors that affect our decision making, that impact how we make ethical decisions. So what are those situational influences that come into play here? Do I need guidance, additional guidance? Do I need to talk to the compliance department? Do I need to talk to my supervisor? What are the alternative actions that are involved here that I also need to look into? So that is consider. And then once you've been able to identify and then you taking into consideration a lot of these things, the next thing to do is to decide and you act. And then you go back to look at your decision. So you reflect. The outcome that you have now, is it what you anticipated? Why was that? Why wasn't that? So once you follow this framework, you can see that to a large extent, it will guide you to always make the ethical decisions at any point in time. And I think also that this framework you can apply to any case study that you're giving. Any question that you're giving, particularly questions where you have a case and then you have to make a decision on whether the person involved was ethical or not. The first thing to do is to identify the facts, identify the stakeholders, identify conflict of interest, consider a lot of things, decisional influences, consider guidance, consider your alternative actions, and then you make a decision. So this framework is not just useful in your organization or useful in things that you do. It's also useful to apply it in cases that you get, in the questions that you get. So the next learning outcome, before we go into that, I want us to quickly do some questions. So I didn't want to show through the slides. They are just wordy. I just wanted to speak through to them. But I have a question here that I want us to answer and drop our answers on the chat box. So the first question says, which of the following statement most accurately justifies why the behavior? So we talked about the legal standard and we talked about ethical standard. And the truth is that the law cannot be used as a mechanism to ensure ethical standards. There's a law, yes, but it doesn't mean that people will be ethical, because even the law can be a minimum standard, but ethical decision requires something much more than the law. So the options are A, laws do not follow market practices. B, laws are not subject to interpretation and compliance, and C, a new law may reduce or eliminate an existing activity. I've only seen one answer, so please drop your answer on the chat box. Okay, I see a lot of people are saying B. So it says, which of the following statement most accurately justifies why the law cannot be used as a mechanism? The law cannot be used as a mechanism because the answer is the B choice, laws are not subject to interpretation. The truth is that laws are subject to interpretation. You know, when there's a law, you interpret it the way you want to interpret it. You know, you interpret it the way you see it. Your perspective might be different from the other person's perspective. So the answer is a C, because a new law may reduce or eliminate an existing activity while creating the opportunity for a different but similarly problematic activity. And the truth is, you create a law to solve a problem, to stop a wrongdoing. You know, that law, yes, it can eliminate, but it can also create loopholes for other wrongdoing. You know, so you can't necessarily rely on the law to be used as a mechanism to support ethical behaviors. So the answer is C, and congrats to those who got it. So our next question says, which of the following statements with respect to situational influences is least likely correct? So we talked about situational influences as those external factors that affect our decision making. So which of the following is least likely correct with respect to situational influences? Number one, overestimating the morality. Apologies, I think I was thrown out. Can you see my can you see my slide?
Yes, yes, we can see it.
Hello, can you see my slide?
Yes,
all right,
yes,
I
we
think
can
I
see
was thrown out. Sorry about that. So we're looking at the second question as it relates to situational influences. All right, so what's the answer? Which is least likely, least likely? So the answer is B. It says situational influences create the tendency of accepting long-term risk, which is wrong. Situational influence exposes you to focus on short-term risk. So let's move on to the next question. Intrinsic motivation is the primary determinant of a certain situation. Joyce says my voice is breaking. Please, can you hear me? Can everybody hear me?
We can hear you, but you were breaking. You were breaking. But it seems better now. Can you hear me?
Can you hear me? Okay, can you hear me now? No, I can hear you.
We can hear you, Odiri.
Can you hear me now? Okay, so let's quickly run through this question. So please drop your answer in the chat box. And individuals' internal intrinsic and traits and intrinsic motivation ethically in a certain situation, the answer is no. Because good people unethically in certain situation, you are placed in a particular sort, say whether you. Anyways, we talked about the structure of the CFA Institute Professional Conduct Program and the process for the enforcement of the code and ethics. Can you still hear me? I'm reading the chat and it's saying I'm breaking. So the code of ethics and the standard of professional conduct stipulate and candidates on how we need to conduct ourselves in a professional way and also in an ethical way, with integrity and across all situations such that it benefits the society. And this code and ethics and standard of professional conduct applies to CFA Institute members, it applies to charter holders, it applies to CFA candidates. And we'll see a number of the case studies in the exams that speak to this code of ethics and standard of professional conduct. And one interesting thing to know is that the professional conduct program, working with the disciplinary review committee, is responsible for enforcing of this code and standard. The learning statement has asked us to describe the structure and the process. So what that means is that these are questions that can come up. So who is responsible for enforcing the code and the standard, and how is that carried out? So there can be cases, there can be different options on how the structure is carried out in a question. It's important for us to be able to know that. The disciplinary review committee is a voluntary committee. It's not an involuntary committee. It's made up of members, chapter holders, who volunteer to serve on the panel to review the work with the professional conduct staff to ensure that those policies of procedure for professional conduct form the basic structure for enforcing. The question that we can be asked is, how do this appear? We tend to disclose on this is a source of the database. And if there's any negative, or when you tick it and you say yes, if there's any no, noted on that. And then we can another source is a written complaint. If a PCP staff, that's a professional conduct program staff, raises a complaint against any member or candidate or charter holder in any form as a result of anything, that is also a source to go into that will be looked into or investigated. And then if there's any actual evidence of misconduct, so either in the media or any public source. So let's take notes, a public source, not a private source. The PCB staff may come across violations through media, any public source. After an exam, they decide to type, oh, this question came out, not knowing that some other people are still about to go and write the exam. Those are cases of violation, and that can come up. That in review can come up as a result of that. And then actual violation of the rules on the exam days, which is something we need to take particular attention to. If that is reported to the producer or somebody on ground, that can be a source of inquiry. And then the CFA Institute can also conduct analysis of scores and exam material after the exam, as well as monitor online. So even when you post this thing online, I just think, oh, after all, the exam has gone, we finished the exam. That can be very risky, because a lot of this conduct and review are carried out online now, particularly as we are all moving to the digital world. Inquiries initiated from any to be done. Annulation is carried out. If there's any violation, there's a sanction, and that sanction can be in any form. You could be suspended. If you're a charter holder, your charter can be withdrawn. If you are a candidate, you might be suspended from writing the exam, for life, depending on the magnitude of the withdrawn or even revoked. So this Please, can you tell me at what point you lost me? Hello? Hello, can you hear me? Hello?
Odiri, we can hear you.
Hello? Okay. Okay. Can you tell me how, because I was just auditing now. Wow. Okay, that's actually a long time. All right, so let me move into some questions so that we can, get back on track. So let's answer this question and drop the following: is this likely required under the Code of Ethics? So members and candidates must promote the integrity and viability of the global capital market for the ultimate benefit of society. So please take note that we're talking about the Code of Ethics. There are 6 Code of Ethics. Just a reminder, there are 6 Code of Ethics, and it's important for us to be able to memorize this code, and be able to identify them in questions and in cases that might be given to us. And the 6 are act with integrity, competence, diligence, respect, and in an ethical manner, with the public, clients, prospective clients. So the things I highlighted in red are very important, for us to note, because you might be given a question and it might tell you with prospective client or with existing clients. Another question might say with prospective and existing clients. So it's important for us to understand these words the way that they are in the curriculum. The second one talks about place the integrity of the investment profession and the interests of clients above their own personal interest, and then use reasonable care and exercise independent professional judgment when conducting investment analysis, making investment recommendations, taking investment actions, and engaging in other professional activities. And then number 4 talks about practice and encourage others, to practice. So you might be given a case where they say you should practice in a professional and ethical manner that will reflect credit as a component of the Code of Ethics. No, it is to practice and encourage others to practice. So, we need to be deliberate when we are reading and studying the Code of Ethics. And then next talks about promote integrity and viability of the global capital market, not just the integrity of the global capital market, integrity and viability. And then for the ultimate benefit of society, not for the ultimate benefit of the clients. So these are very specific areas where you can get questions that can just throw you up, because you know the 6 code of ethics, but it's not just knowing them. It's knowing them well and being able to pick them where you see them and pick the right words that are used. So when you say promote the integrity and viability of the global capital market for the ultimate benefit of clients, no, for the ultimate benefit of the society. And then maintain and improve their professional competence and strive to maintain and improve the competence of other investment professionals. So you might be given a case of maintain and improve your professional competence. That's all. No, maintain, improve your professional competence, and also strive to maintain and improve the professional competence of other investment professionals. So these are just a summary of the 6 components that needs to be memorized because they are really very important. So let's answer this question now on the back of that. Which of the following is least likely required under the Code of Ethics? First is promote integrity and viability of the global capital market. The second one says deal fairly and objectively with all clients when providing investment analysis, making investment recommendation. So please take note of the fact that it is least likely also, and then maintain and improve professional competence and strive to maintain and improve the professional competence. So I can see a lot of B, so I can see that that's very easy. The other one is which of the following is least likely a component of the CFA Institute Code of Conduct, the Code of Ethics. Least likely again, so act with diligence and respect with participants of the global capital market, act fairly, objectively with clients and prospects when disseminating investment recommendation, and encourage others to act in a professional and ethical manner that will reflect credit on themselves and society. You know, because this one looks more technical than the other one. Least likely, yeah. Did we see anything about disseminating investment recommendation? No, I didn't give you this insight on that though. So you can see that there's nothing here about disseminating. That's a standard of professional conduct. So clearly the answer is B. So you can see that even this question is more technical. It requires more thinking, you know, than the previous one. So that's why it's important. The Code of Ethics might look so simple, you know, but it's really one of the hearts of the curriculum for ethics. And then the next question says, the responsibility for establishing and reviewing professional conduct policies falls on all of the following, except A, the CFA Institute Board of Governance, B, Disciplinary Review Committee, C, Professional Conduct Program. So what's the answer? I can see a lot of A, so I'll take the answer as A. At least if there's nothing to remember that we made mention of Disciplinary Review Committee. It's a voluntary committee made up of charter holders, you know, who form a panel to review the policies. And also when a candidate member or a CFA charter holder does not accept the sanction or the decision, it is referred to them. The Professional Conduct Program also, they have a role to play in enforcing the Code of Ethics. We didn't hear anything about the Board of Governors, the Board of Governors. All right, so let's take this other one. An exam protocol submitted a violation against a CFA Level 1 candidate. The designated officer, upon reviewing the matter, found that a violation of the code and standard had occurred and proposed a disciplinary action. Can the candidate reject the disciplinary action proposed by the designated officer? A says yes and gives the reason. B says no and C says no. So can you reject? I think we spoke about that. Yes, you can. You have an option to accept or reject the disciplinary action. So my time is really running very fast. I have about 15 minutes. This is the third reading under ethics, and it's basically about the guidance for standard. And there are 7 guidance for standards. I'll just run through them briefly. The first talks about professionalism. So you must know the law. You know, you must act with independence and objectivity. You must not misrepresent anything, any information, and then you must conduct yourself properly. You don't engage in any professional misconduct. The second one talks about the integrity of the capital market. So don't do anything that will cause or act others to act on material or public information. And then you should not engage in market manipulation. So MTN did an IPO towards the end of last year. You know, people who had information that IPO was coming out, you know, they could engage in practices that would probably distort the prices, you know, just for them to be able to profit out of that. That's market manipulation. The third talks about duties to clients. So you have a duty to your client, you have a duty of loyalty, you have a duty to deal with them fairly and objectively, you have a duty to deal with them in such a way that you take into consideration their suitability for an investment. You know, you have a duty to communicate to them in a fair, accurate, and complete manner. And you have a duty to preserve the confidentiality of your client, except otherwise. You know, there are cases where, you know, you can break the confidentiality rule. Is requested by law, it's an illegal activity, and the client permits. So it's important for us to be able to know these little things. You know, one of the things about ethics in the questions, you'll be surprised, the question looks so simple, but you are missing the answer, because some of these things are embedded in the reading. And if you don't read them properly, you know, you're not able to bring up the answers as quickly as possible. So there are 7 guidance for the standards. We talked about professionalism, we talked about integrity of the capital market, duties to clients. The next one, number 4, talks about duties to employer. So beyond your duty to client, you also have a duty to employer to be loyal to them, use your skills for their benefit, and don't divulge confidential information. You know, you have a duty to not enter into any compensational arrangement that will act as a conflict, you know, to the work that you do for them. And you also have responsibility as a supervisor. Yes, you can delegate, but that burden of responsibility still lies on you as a supervisor. And then the 5th one talks about investment analysis, recommendations, and action. You know, one of the beauty about the investment profession is that you do a lot of research. You know, you do a lot of analysis. So you must exercise diligence in doing that. You must, you know, and you have to be seen as thorough in the analysis that you have done, because if you are doing an analysis to recommend an investment decision to somebody and you've not done, you know, you've not been thorough on it, you've not done complete due diligence, you know, you're putting the client at risk. And then under investment analysis and recommendation, we talked about communicating with clients and prospective clients. You know, in your communication, you need to be able to separate what is fact and what is opinion. Keep your opinion to yourself. Your communication should be based on facts. And then how long should we keep these records? How long should records be retained? You know, records that support your analysis and conclusion. And then number 6 talks about conflict of interest. So conflict of interest is very broad. You know, disclosure is key, is a key part. You know, in short, when in doubt, disclose. If you're not sure, disclose. You know, and then we talked about priority of transaction. You know, your client's transactions, your employer's transaction comes before your own transactions. But one of the interesting part of priority of transactions is that if it's a family member, but it's a client, you treat him as a client, not as a family member. And then under that conflict of interest, you also have referral fees. So wherever you enter into an arrangement where a referral fee is given to you, you need to disclose. And then lastly, responsibility as a CFA Institute member or as a CFA Institute candidate. You know, don't engage in any conduct that compromises the reputation and integrity of the institute. You know, don't exaggerate, don't misrepresent. You know, don't try to overblow the fact that by father I'm a CFA charter holder, I can do magic. You know, I can give you return that are not realistic. You know, so the point is, you know, don't misrepresent and don't exaggerate. So let's take some few questions before we move on to the next reading. So as usual, as all who have not even responded before, you know, to please participate. So Sarah Wallace has recently passed level 2 of the CFA exam. She's applied for the position of a junior research analyst at a leading investment bank. In our qualification and experience section of our resume, she includes the following statements. Statement 1, I have successfully passed the first two levels of the exam in a consecutive attempt. And then statement 2, I have been working for 2 years in the investment industry. I expect to earn my charter 1 year after completing the final level of the exam. So which one is she in violation? Which statement is a violation? Which statement is most likely in violation? So most likely in violation. So somebody says B. So statement B is most likely in violation. I've seen a lot of B, which is good. Statement 2. Now the first statement says, I have passed, those statements are facts. You passed it in 2 consecutive attempts. That's fact. That's not an exaggeration. That's not, your opinion. It's a fact. But the second one, you cannot be playing out the future, in your CV. So that's more like an exaggeration. The next question says, which of the following is not a proper reference to the CFA program? So this is trust, who have been trained in investment ethics and have a strong code of particular attention to the question. It says, which is not achieve better 3 levels of exam that test an advanced curriculum. C says have one up-to-date and advanced skill set on the planet. Which one is not an exaggeration, first of all? So which one is not? I'm saying, I don't know, okay, this is I've not seen any response, but I'm saying B. B is for this particular question. So B says achieve better performance levels of rigorous exam that test an advanced curriculum of investment management. And A looks more like it. CFA charter holder are trusted, objective experts with strong code of ethics. So the answer is A, because it's not, somebody says it's not an exaggeration. If you look at B, which I see some people tinted to achieve better performance results, it's not necessarily the fact that you may be able to achieve better performance results, or it's also the fact that you pass 3 levels of rigorous exam does not mean that you will achieve better performance results. Someone also C, have one of the most up-to-date and advanced skill set on the planet. So look at it from the point of view of exaggeration. Which one is more tinted towards the fact? You cannot achieve better performance results. There's no guarantee that you wrote CFA, pass back to back. So A looks more like it. And also, yes, someone says the question is not. And see, let's pay particular attention to the question. There's least likely, most likely, not. Those are qualifiers, and those are differentiators. If you miss those small keywords, you might interpret the questions, the question differently, and then the answers or some question also. I need to hurry up. Which of the following situations least likely constitute a violation of CFA Institute code and standard? A, senior researcher obtained information concerning a potential merger deal pertaining to an issuer company covered by him, which is yet to be publicly released. The researcher disclosed information to his supervisor and compliance department. B, Margrea recently passed level 2 exam of the CFA program and does not intend to appear for the level 3 exam for at least 3 years. He identifies himself as an active candidate. And then number 3, portfolio manager allocates oversubscribed IPO shares to suitable non-family client account prior to family client account to avoid the appearance of a conflict. Which of the following situations least likely constitute a violation? What that means is that there are 2 violations here. So C is a violation. It's a family client account. The fact that it's a client, whether it's a family or not, does not mean that you'll be put in a disadvantaged position. So C is a violation. B is also a violation. You're not an active candidate as long as you have not registered for the next exam. So the answer here is A, because it's least likely a violation. So I want to, this is the next reading 59, talks about the introduction to GIPS. And the question is, why do we have GIPS? GIPS is basically to create a standard for the investment management firm, to be able to compare. It's easier when everybody aligns together on the same standard, and then you can compare performance. So if you ask me to send my proposal, to bid for a investment management job, I will likely want to put my best foot forward. So GIPS basically just ensures that there's standards that align the investment manager to be able to ensure that we don't misrepresent performance. We don't showcase only the performance that puts us in a good light. And the only people that can claim GIPS compliance are portfolio managers or investment managers. You must be managing an asset or managing assets to be able to claim GIPS compliance. The fact that you sell software for an investment management firm does not mean that you can claim GIPS compliance. The fact that you're a vendor to an investment management firm, does not mean that you can claim GIPS compliance. And what are the objectives of the GIPS standard? Is to promote investors' interest and instill investors' confidence. The truth is, investors will have more confidence in the industry and in the firm if there's a standard that ensures that there's proper performance recording and representation. You don't exclude the ones that are doing badly because you want to put your best foot forward. You don't only showcase the periods where you are doing well because you also want to put your best foot forward. The GIPS standard also ensures that there's accuracy and there's consistency in the data that is used. So whatever you're showing me today is whatever you will show tomorrow because there's consistency. And then also obtain worldwide acceptance of a single standard for calculating and presenting performance, which is very key. Firm A, Firm B, Firm C, whether they're in Nigeria or abroad, we are all aligned to GIPS. We are all showing the same thing. We're all calculating because there's a standard that brings uniformity across how we present. And then as a result of that, to a large extent, it will promote fairness, global competition among investment firms. The truth is, may the best firm win. We are all aligned to the same standard. And then promote industry self-regulation on a global basis. Because of the standard, everybody complies with the standard. And the good thing about GIPS is that, it's voluntary, but if now the regulatory induced, that's even self-regulation, and that helps you even want to do it more and do it better because nobody's forcing you to do it. So I said earlier that only firms that actually manage assets can choose to comply with the GIPS standard. And when you are complying with GIPS standard, you are complying on a firm-wide basis, not just on a single product or on a single account. You are complying at the firm level, and compliance is voluntary. Now, while compliance may be voluntary, you have done it, there's that independent verification that is also needed, which is also not compulsory. But when you go ahead to do an independent verification, it just basically puts a higher credibility on what you have done, on the GIPS standard. And what are the benefits when you comply with the GIPS standard? Firms are assured of fair representation, completeness and accuracy with your data. Investors have greater level of confidence and integrity in performance presentation because this is a global standard. It's not just Lagbaja that created it, and it's not just peculiar to one company. And then one part of this I also want to mention before I take some question is on the use of composite. So composite is a very tricky thing. There's a lot of questions that can come out on it. So it's good to understand what it is essentially and what it entails. So a composite is an aggregation of one or more portfolios that are managed according to a similar mandate or a similar objective or a similar strategy. And what that means is that you're able to group accounts together in line with a particular strategy. So you're not mixing strategy, you're not mixing objective, you align each account that is similar in terms of their objectives are brought together as a composite. And the only accounts that needs to be under a composite are accounts that are fee paying and discretionary portfolio. So a discretionary portfolio is a portfolio where you as a fund manager, you make a say on where to put the money, where to invest the money. is different from a non-discretionary, where it is the client who decides, oh, invest my money here, don't invest my money here. But if a discretionary portfolio, the responsibility, lies in you in terms of where to invest and where not to invest. So I have about 2 minutes more. I want to use that 2 minutes to just take questions. And please drop your answer in the chat box. So the first question says, which of the following firms can most likely claim compliance with the GIPS standard? Which of these firms can claim compliance? So a plan sponsor, no. A software vendor, no. So clearly C is the answer. Which of the following statement is most likely correct regarding verification? So verification ensures the accuracy of a composite presentation, or does it, B says, in order to claim compliance with the GIPS standard, firms must seek verification. And then C, verification tests the soundness of a firm's policy and procedure. So what does verification mean? You've claimed compliance with GIPS. Verification is an independent review, essentially, of what you have done. So to that extent, verification tests the soundness of your policies and procedures to calculate performance in accordance with GIPS standards. So the answer is C, even though ability to what you have done in complying with the GIPS standard. And then, which of the following is most likely correct with respect to the application of GIPS? A, GIPS are voluntary standard to provide performance result to potential clients. I have 1 more minute. B, GIPS are involuntary standard. C, GIPS are voluntary. If you look at A and C, C talks about provide performance result to current and potential. For us, when we are reading our case, to read the question properly and note the keywords, and also read the answers properly and note the keywords. So the question says most likely. So the answer that is most likely is C. GIPS are voluntary standards that are applicable to investment management firms and are developed to provide performance results to current and potential client. So time is up. I know I had some ethics. Read with an open mind and pay particular attention to the words that you read. Don't just skim through. Pay particular attention to the words that you read. And on the day of exam, read the questions properly and carefully, because there are keywords there that can alter the dynamics of your answer if you understand them. So I wish you all the best in your exam. Thank you.
Thank you very much, Odiri. Thank you very much, everyone. So we're going to be going on a 30-minute break right now. We're going to reconvene at 12:30, and we're going to be having the econ session once we reconvene. So we're going on break right now. Please join in at 12:30.
Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Pure Factor Learning Center is a CFA tuition provider in Lagos, Nigeria. We have a wide range of resources that support you to pass your exams. We have a team of qualified tutors with extensive experience in teaching CFA. The main focus at our lecture center is to provide you with the necessary support to make sure you attain your goal. Our unique features include a conducive learning environment, uninterrupted power supply, highly experienced lecturers, easy accessibility, and spacious parking facilities. We offer 2 prep classes, in-person classes and online live classes. For our in-person classes, lectures are solely on weekends. You have 24/7 access to all our tutors. All classes are completed a month to your exams. For our online classes, you have access to our live classes, 24/7 access to our tutors, and access to our online learning management system with recorded videos. Pure Factor Learning. Come to us today and let us make your dreams a reality.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Are you thinking of a CFA prep provider where you can get high quality tuition that will be delivered by some of the very best investment and finance professionals? Think no further, Ivy League is the place for you. At Ivy League, we have a consistent history of delivering and surpassing on our students' expectations across several finance qualifications. At Ivy League, our tutors share a unique characteristic of being very skillful, very passionate, committed, and above all are dedicated to the success of our students. Our CFA lectures holds weekends from 9 a.m. to 6 p.m. on Saturdays and 11 a.m. to 6 p.m. on Sundays. Each class will run for 2 hours with a 15 minutes break in between classes. The classes will be delivered via our virtual learning management system. Why not join us at Ivy League? Simply visit our website on www.ivyleaguenigeria.com/CFA.
If you've made a decision to aim for a long-term and successful finance career, taking the Chartered Financial Analyst CFA exam and studying the curriculum is an excellent way to ensure you have a strong knowledge base and top-notch skills. Are you ready to take the bold step to invest in yourself? CFA Society Nigeria is at your disposal, promoting the highest standards of investment practice in Nigeria. As an affiliate of CFA Institute, CFA Society Nigeria seeks to promote the highest standards of investment practice in Nigeria and to provide a vibrant community in which its members and other key players in the investment industry can interact and grow. When you have the CFA charter, you're globally recognized. Take advantage today by writing the CFA exam and joining us at CFA Society Nigeria. For more information, visit us at cfasocietyn.org. CFA Society Nigeria, making finance a force for good.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance, and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship, and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile, you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Good afternoon, everyone, and welcome back to this year's bootcamp revision. The next topic we're having now is economics, with Wale Okunriboye coming on to command. Thank you, Wale.
Okay. Hello, can everybody hear me? Yeah. Hello, can everybody hear me?
Yes, we can, Wally.
Okay. Thank you. Okay, so just over the next 2 hours, look to run quickly through the economics module. The economics module is boxed into 7 topics overall, 2 study sessions, demand and supply analysis, a bit about market, about market systems, then some macro with GDP, business cycles, and then policies, trade. Then it ends up with currency exchange rates. What I'll do is just looking through how to best optimize our time. I suspect one of the most important topics to a lot of students is always currencies. And so I'll try and run through that first, and then we'll come through with the rest, given that the currency segment has a bit of calculations involved in that. If that's fine, I'll just push through to that. Yes, so currencies and exchange rates, the key LOS that the syllabus wants you to sort of master take a key note of a lot of things at definition. There are some calculations, basically how do you calculate and interpret percentage changes across currencies, cross rates, forward discounts and forward premiums, and then how to check whether the forward rate is consistent with arbitrage, no arbitrage conditions, and then the rest of it, a lot of things, that concepts that they want you to kind of understand really. So we'll take it a bit slowly, starting first with some basic notations. In the CFA material, I mean, typically we all hear things like base and price currencies. Now, for the CFA curriculum, for the sort of the CFA exams, it's always important to sort of know that there's a notation, and that notation is what they call the price and base currency. The base currency is what you refer to in terms of 1 unit. For example, if you say today the Naira-dollar exchange rate is 416 Naira 50 kobo, that means $1 is equals to 416 Naira 50 kobo. The dollar here, which is the currency that is in 1 unit, is the base currency. The price currency is the currency in which the base currency is expressed in. So in our example, price to base NGN USD 416.5. This is the notation we sort of be used to for the sort of the curriculum. Now the important is because in the real world they may use different connotations. In the real world, people say USD NGN, and you say it's 416.5. Keep that away. For the purpose of this study, just know that price to base currency, the price currency is the unit, is the one that is expressed in terms of the base currency. The base currency in our example is the US dollar. And just if you kind of get this hand, it's almost the same application you can use everywhere else. NGN USD, the base currency is the currency that is expressed as a unit, 1 unit. The other one that is expressed in terms of the base currency is the price currency. Now, a decline in the price currency represents in our example, represents a Naira appreciation. So for example, if the rate goes from 416.5 to 400, that means the Naira has appreciated, and that also means by inverse, the dollar has depreciated against the Naira, and it also applies vice versa. So in other words, if the exchange rate goes up, if 416 goes up to 430, that means the Naira NGN has depreciated and the USD has appreciated against the currency. Now the exact calculation, we'll get to that in a short time, but it just means that just understand this directionality. Okay, someone is asking to switch to slideshow. Okay, oh, this is fine. Yeah. Okay, so okay, yeah. Now the next thing to also keep an eye on is what is this differentiation. What they would like you to also understand is distinction between nominal and real exchange rates. So most of the time we refer to nominal exchange rates. That's a distinction. That's most when you say Naira is 416.5, you're referring to the nominal exchange rate. That is the exchange rate that is not adjusted for changes in inflation or not adjusted for price changes across the 2 currencies you're dealing with. So that's the nominal exchange rate. The real exchange rate is, of course, as everything in economics, is the nominal exchange rate adjusted for or adjusted for inflation. So it's the nominal exchange rate adjusted for relative price changes across two currencies. And so the real exchange rate, I've put DF here, that means domestic foreign, just to get it familiar with domestic foreign, is given as a nominal exchange rate domestic foreign times your foreign inflation divided by your domestic inflation. Now, that's the formula, that's the definition. However, in reality, that's a bit tricky. What they tend to give you is how do you calculate changes in the real exchange rate. So they will tell you that, oh, the real exchange rate has depreciated by, or what they could most likely tell you is that, oh, the nominal exchange rate has fallen by 10% or has appreciated by 10%. Inflation is at 2% in the domestic currency, and CPI inflation is 10%, 20% in the foreign currency. So what is the change in the real exchange rate? And the reason why is because it's very difficult to observe real exchange rates in theory. In practice, I mean, it's a concept that is theoretical, so it's very difficult to see them in practice. Most people can relate to them. So what you can estimate, however, is okay, if the nominal exchange rate has moved by this and the inflation rates at this, I could figure out what the change in inflation rate is, in the real exchange rate is. And that's what this is here. So important to remember is one of the many factors that influence FX rates is not observable in the short run, as I said earlier, and is a poor predictor of FX movement. However, people say it's something you see over the long term, that currencies tend to move in the direction of where the real exchange rate is pointing to over time. But like I said, it's unobservable in the short run, so it's a bit of a theoretical concept. And the important thing to know for the exam is you could be given a scenario where they could tell you, oh, some guy who's located in England, the British pound has depreciated by 10% over the last 1 month. UK inflation is this, Euro inflation is that. What's the likely change in the real exchange rate over that period? And it will then tell you what does it mean. So they give you a definition. What you want to note is that a positive change in the real exchange rate means that for people who are it means that they now have weaker relative purchasing power relative to things abroad. And the reason why is to look at it, how the formula works. For you to have a decline in the real exchange rate, it means that your domestic inflation must be very high relative to what you have abroad. That's when you have a negative. In other words, a decline in the real exchange rate. Now, if you have a decline in the real exchange rate, it has to be that you're relative to what inflation is abroad. It sort of means that your purchasing power relative to your currency. So that's the idea behind why countries say if a country's currency is weaker, then it means it's good for their exports. Kind of the idea behind it. And the next concept they try to explain is spot and forward exchange rates. So spot exchange rate is exchange rate available for immediate delivery, or T+2. So if you do a currency transaction, whatever is available for immediate delivery or at least T+2, and that was today plus at least 2 days, that's referred to as a spot exchange rate transaction. And then for the Canadian dollar, which is a CAD, is typically T+1. And a forward exchange rate is anything longer than that, 30, 60, 90, anything longer than T+2 is seen as a forward exchange rate. Then you also should be wary of domestic direct and indirect quotations, depending on perspective. So for example, if you're a Nigerian and typically the currency is quoted as NGN USD, in other words, the Naira is set to the price currency. The price currency is the domestic currency and the base currency is the foreign currency. From that perspective, that's what you refer to as a direct quotation. So in other words, you see NGN USD is 416.5. However, if it was to be quoted indirectly to a Nigerian investor, all you just need to do is just invert the direct quotation and you have what. So divide 1/416.5, that gives you what the indirect quotation would be. So it's the reciprocal of the direct quotation. You also have what they call bid and ask spreads, which are typically in currency markets, you get quoted in pairs. So what you tend to find is that exchange rates are quoted in two rates. There's one is a bid rate and ask rate. The bid rate is where where the dealer is willing to buy from you, and the ask rate is where the dealer is willing to sell to. So whoever puts that code up, the rate that's called the bid is where he's willing to buy from you at, and the rate that's called the ask is where he's willing to sell from you at. Usually the bid is always lower than the offer. Otherwise, what it means is that you can buy from him and sell to him at the same time if it's not lower. Most currencies are typically quoted to 4 exchange rates, 4 decimal places, except the JPY, which is quoted to two decimal places. Now, we're here to where we get to one of the places where we get to what's called calculation. So how do you calculate percentage change between two currencies? It's important to note that for now, and I use this example here. How do you say when a currency appreciated or depreciated? So for example, if you say the Naira has moved from 416.5 to 435, most people would say that's a 4%, the Naira has lost 4% to dollar. That's what you would say, 4.4% to be exact. That's what most people would say, but that's actually wrong within the context of the exam. And that the reason is because that weight is basically tracking appreciation in the US dollar over the Naira. It's not reflecting Naira depreciation. What has happened is, like I said earlier, when an exchange rate moves higher, it means the currency has depreciated. That's the price currency has depreciated relative to the base currency. So if you say 4.4 is the answer, then that answer is wrong. However, if you say the Naira has depreciated by 4.3, that's the correct answer. And it's interesting, they'll actually show you 4.3 and 4.4 in the exam. So most people who pick 4.4 will be wrong. So it's just important to note that. How do you arrive at that thing? And that is just basically, so for the first case, what you're doing is you're putting 416.5 over 435 minus 1. That's what will give you 4.3%. If you did 435 over 416 minus 1, that's what's going to give you 4.4, which is an appreciation in the dollar, not a depreciation in the Naira. So it's always good to note that both two things don't give you the same. So in other words, it's not as if you just remove the sign, it gives you the mirror. It's a different calculation. So always good to sort of remember that that's how you calculate percentage change or changes in regards to exchange rates when it comes to currency calculation in the exams. You also have what they refer to as cross exchange rate. And what we'll just do here is I'll break here and we'll take an example from the material to sort of explain how that works. Just 1 second while I share my screen. Okay. So okay. Yes, so we'll just take some examples from. So cross exchange rate, the idea behind cross exchange rates is when you have two currencies that are, it's particularly important for when you have currencies that are not seen as being heavily liquid. For example, now you're a Nigerian and you want to buy goods from Ghana. What's the Naira dollar? What's the Naira CD exchange rate? There's no direct market between Nigeria and Ghana that is liquid. There's no direct currency market between Nigeria and Ghana that is very liquid. Or let's say, let me look for some other currency that is maybe, let's say Nigeria and Afghanistan. It's such a very, there's no direct linkages between Nigeria and Afghanistan. So there's no direct currency market between those two. So what you typically would do is you would have to go through a third currency. So for example, like with Nigeria-Ghana example, there's a direct Nigeria dollar exchange rate market. There's also a direct Ghana dollar exchange rate market. So the concept of a cross rate is to try and use that third currency that connects those two currencies to extract what the implied exchange rate between Naira and CD would be. And that's basically how it works. So in the example we have here, for example, the example we give in the curriculum, you have US dollar, euros, Swiss franc, as well as the GBP. So these currencies, and the first question here says, the CHF, which is the Swiss franc euro cross rate. So in other words, whenever you're dealing with a problem with cross rates, so in this scenario, we're going to be using, the question wants us to get what the exchange rate for the Swiss franc and the euro is, but it's not provided us here. What we've provided them, so the currency we're looking for is the CHF. Hold on a second. Sorry, what we're looking for is the CHF euro exchange rate, right? Now, however, we've been given a USD rate and we've been given a Swiss franc euro rate. So the first thing we'll take is the CHF USD, because the US dollar is common to both currencies. And we also have the USD euro rate. So from this, it's clear to us that if we do a bit of maths, we knock this off, we have exactly the same CHF euro rate we're looking for. So to solve our question here, what we just need to get is what's the CHF USD rate? Spot rate, that's 0.99, and we multiply that by the USD euro rate, and that gives us 1.1701. So if you multiply that, we'll get our answer. Has anybody worked out the answer? Somebody can try it out. So that's this times this, essentially, we'll get what we're looking for. Everybody press the calculator. Okay. So 0.99 times 1.17 C. So someone has come through with C. Is that the answer? Yes, C is correct, 1.1585. So that's how you get that. Now, the next example here is the GBP euros. So again, pretty similar, although there's a small trick here, and that's why it's always good to do the examples. So we're looking for the GBP euros here. So pound and the euros. However, we have USD euros and we have USD GBP. So now in this instance, what you've been given is the USD GBP, and you've also been given the USD euros. What you're looking for is the GBP euros. So we need to take an inverse of this. So we need to invert this. If we inverted it, that would give us GBP USD times USD euros. If we multiply that, we have exactly what we're looking for. So what we're going to do is we take the reciprocal of this 1.138, so 1 divided by 1.3118, and multiply that by 1.1701. Yeah, okay, and okay, somebody has already figured that out. So if we did that, that would give us 0.8920. So yeah, so that's pretty much how you go about navigating cross rates. Really, you just figure out what you're looking for, and then try and work out using this approach. So you know what you're looking for. They're giving you a series of exchange rates. You try and figure out if you have to invert, you invert, but always make sure you get what you're looking for, and then once you get that, you know what you need to do. So yeah, pretty much that's it. I mean, we can try the other pyramid. Okay, so this next one is basically trying to test our knowledge of exchange rates. So based on the exhibit, the euro is expected to appreciate by how much against the dollar over the next 1 year. You don't actually need to calculate this, because if you look at this, well, okay, let's calculate it. But what's going to be the percent over the next 1 year? This is where they expect the USD euro rate to be, and this is where it is today. So if we're to calculate the percentage change, how do we go about it? We'll just take where it is today divided by where it's going to be, and yeah. So what's that direction going to be? Is anybody trying? Anybody trying? Anybody trying? It's B. Well, it's B, but yeah, so the answer is 0. So if you did that, remember what we said that USD, Euro. The Euro is the base currency here, and this is the price currency. So the percentage change between the two of them is 0.7%, right? However, that percentage change refers to the US dollar. Remember, it refers to the change in the US dollar, not the change in the euros. To get the change in the euros, what it means is that it's the inverse. So and when you calculate 1.1701 divided by 1.1619, you get 0.7, right? But that 0.7 is the change in, is telling you that that's how much the dollar will appreciate against the pound, against the euro. And it's not telling you by how much the euro will depreciate against the US dollar. But in this example, it's probably the same thing. So it's going to be 0.7%. That's because they give you one decimal place. Sometimes they may give you two decimal places, which may allow, you may say that there's an approximation going on there and it's slightly different. So next question, it says, how much is the dollar going to appreciate against the pound over the next 1 year? So again, it's kind of similar. How much is dollar going to appreciate against the pound? This one should be straightforward. So anybody trying that? You're trying that? Okay. Anybody give me a show? How much is it? Dollar? Okay. C. Yeah. C. Okay. Big Ben got it. Yeah. Okay. So what the next one here? The Swiss franc is expected to depreciate against the GBP, depreciate against the euro, appreciate against the GBP, euro, and USD. What was that likely pointing to? Yeah. You calculate this without actually doing any calculations, but you can actually figure it out. So you can see from here straight away, the Swiss franc is already there because this number is lower. So you can see it's appreciating against the USD, which is correct. Now, however, if you then look at the USD and euros, you can see the dollar is appreciating against the euro, and the dollar is also appreciating against the pound. So by default, the Swiss franc is appreciating against the USD, and the USD is also appreciating against the other two currencies. And to a large extent, you could say that C is the answer. But of course, you could work it out, of course, by computing the cross rates and seeing what it is. So we know we already computed on cross rate here. If we compute the cross rate for the expected rates, we would also get to see that the CHF is appreciating against all currencies. So, okay, I'll just stop here and we'll get back to our material. Okay. So yeah, so that's about cross rates. So now next thing we then need to realize, another calculation again, is what they call forward quotations. So currency markets, a lot of currency markets, they deal with a lot of forward transactions as well. Why? Because people want to hedge against FX risk, the risk of currencies moving against them. So they want to hedge against that risk. So to hedge against that, you want to buy, you want to confirm a rate today. So for example, I'm receiving a payment in 30 days time, and I'm receiving $1 million in 30 days time, and I want to hedge against the risk that the currency will move against me in 1 month's time. So what I do is that I'll go and lock in a fixed rate today for that future delivery. So typically I'll go to a dealer, a bank. The bank will tell me, okay, this is our quotations for forward rates. 1 month, typically they'll quote it from 30 days, 60 days, 90 days, all the way to 1 year, saying if you want to buy for delivery in 1 year, this is what they have. And they typically put it in what they call they don't put the exact forward rate. What they do is they put a forward quote. So how do you arrive at that? They're typically called points or pips. The formula for the forward point is the formula for the forward point is given by the forward rate minus the spot rate times 10,000. And why is it 10,000? Because exchange rates are typically quoted to 4 decimal places. However, for the yen, that would be times 100 because Japanese yen is quoted in 2 decimal places. So that's why it's 10,000. Actually, you just take the difference between the forward rate and the spot rate. That gives you the 4, and then divide and multiply by 10,000. That gives you what the forward point is today. Same thing, the forward rate can also be quoted as a percentage of the spot rate. In that case, it's called a forward a percentage. So in that case, what they use is the formula is given by the spot rate 1 times the forward rate, 1 plus the forward rate as percentage. That gives you what the forward rate will be, forward point as a percentage. Let me see, we'll do an example, so we'll see what it means. And there's also the concept of, so now, if to say let's use an example. So if we say the spot rate of the USD euros today is 1.2345, that's the spot rate today. And the forward rate, say in 1 month's time, is given by 1.2360. The 1.2360 is higher than the 1.2345. So what that tells us is that the forward is trading at a premium to the spot rate. So that means what this is saying is that the euro is expected to appreciate against the dollar over the next 1 month. So, and it also means the euro is trading at a forward premium to the dollar over the next 1 month. That's because really just because the forward premiums, it shows that the currency will depreciate over the next 1 month. That's the forward. That's what the quote is. And so whenever you see in this instance where the forward rate is higher than the spot rate, then it means the currency is trading at a forward. What you have is a forward premium, and it means the base currency is trading at a forward premium to the price currency. And of course, the inverse is that the price currency is trading at a discount, a forward discount to the base currency. See. Okay. Okay. Someone is saying, okay, let me just run through that again. So I said, maybe I'll use Naira. So the Naira exchange rate today, the NGN USD today is 416.5 Naira today. That's what it is today. Now, you go to a bank and the bank says, Big Ben Bank says, oh, you want to receive a payment in March for dollars. That's okay. We're willing to give you at what, 430.5. That's a forward quote. What this tells you is that the Naira is trading at the USD. This is a forward premium. Because why? Because the forward rate is higher than the spot rate. So it's a forward premium. Now, what that means is that the dollar is trading at a forward premium to the Naira over the next 1 month. And the Naira is trading at a forward discount to the dollar. That's the implication. That's the implied, because like I said, this is the price, this is the base. If this happens, if you see a scenario where the forward rate is higher than the spot rate, it means the base currency is trading at a forward premium to the price currency, and vice versa, the price currency is trading at a forward discount to the base currency as well. So it's always good to have what that notation is. Then you also have the forward discount case, in which case, if you check the forward, and let's say NGN USD is now 400. Yeah, if that's the case, then what you're saying is that the USD is trading at the forward discount to the Naira. That's because the forward is lower than where the spot is today. And what this means that it's telling that the currency is likely going to, that's what the dealer is saying, is that the dealer expects the currency to appreciate, the Naira to appreciate against the dollar in this discount scenario. So it was good to understand the meaning of that. Now, this is now I guess the meat of currencies is always what informs, what drives the forward rate. Because most people are you're never worried about the spot rate, because the spot rate is where the exchange rate is today. what you're always worried about is, from a finance perspective, is how do I deal with uncertainty in the future? How do I manage possible movements against me, for me, particularly when you have payments to make or when you have receivables to collect. The businesses always want to know how the exchange rate is priced. So it's always the forward rate you're worried about. Now, one way sort of think about this for level one, I said level one is to what is referred to as the no arbitrage forward, or the interest rate parity condition, which states that what tries to say is that all exchange forward rates have some relation between the interest rate and expectations around the spot rate. So the general rule, however, is that and the no arbitrary condition is explained by simply. So assume, say you're a Nigerian investor, right? Or you say you're an American investor, right? What's the no risk? If you're a risk-free investor, just looking for risk-free trades really to invest your money in, the option available to you in the US is just to invest your money in, well, let me say 3-month treasury bills, which is 1 plus D. So D here will be like 3 months. So that's the option. That's one option available to you, right? You have $100, just invest it in 3-month treasury. That's risk-free, right? Now, another option is, however, if somebody now comes to tell you, okay, why don't you invest in Nigeria? Or you bring your money into Nigeria. If you bring your money into Nigeria, it means you're going to convert your currency at the spot rate, and then you would invest in a Nigerian interest rate. You say, oh, Nigerian interest rate, US interest rate is about 1%, Nigerian interest rate is about 10%. Why don't you bring it in? So you invest, you bring your currency, converted it to Naira, $100, converted it to Naira, and from there, you invested it in Nigerian 10% 3-month treasury bills. Now, at the end of that, your 3 months, you're going to come out by doing what? At an exchange rate. That exchange rate is going to be likely different from what you invested in when you came in at the end of 3 months. So the no arbitrage rule states that as long as this relationship, the forward exchange rate, if you're able to get somebody who offers you a forward rate, is at par with your domestic rates, you're not likely going to invest. That typically the forward rate must be such that, given the interest rate and the spot rate, it makes you indifferent between staying in the US and coming into Nigeria. That's the equilibrium condition. And this is often simplified into something like this. So the forward rate must be such that the spot rate and the differential between the log linear differential between the foreign interest rate and the domestic interest rate must be such that equates the spot rate. That's the forward rate that must be derived from the no arbitrage condition. That's the forward rate. Now, if the forward rate is different from this, there's an opportunity for people to make arbitrage profits. And the general rule is that the currency with the higher interest rate will trade at a discount in the forward market, while the currency at the lower interest rate will trade at a premium in the forward market. Is it a good predictor of spot rates? Most people say no. So, well, the rule is that it should be a predictor of spot rates, but however, that's why you have carry trade opportunities. So why do we have carry trade opportunities? Carry trade opportunities exist when people believe that the forward rate does not predict what the spot rate will be. So, for example, you're a foreign investor, you came into Nigeria at 400, and you bought a forward that was saying, okay, in 3 months' time, the Naira will be 410. I'm just assuming. And now, if in 3 months' time the Naira is still at 400, you would have captured those gains, in other words, but if you didn't decide to hedge yourself by buying the forward. So that's when carry trade opportunities come into play. So what sometimes people do is they scale it for time, because, as in finance generally, typically as 1 year, but if it's less than 1 year, then that's where this tau comes in. Tau is just a fraction of what it is. So if it's 3 months, that means 3/12, which would be, it's 3/12. So basically just capturing the fact that not all investments are 1 year. So it tries to scale for that. We'll do some examples. Let me pull up an example. Yeah, okay. So this trying to just show through for the forward. What I was talking about is spot and forward points. So okay, let me look for something. Okay. Yeah. Okay. So we have a French company. So yeah, this is typically how it come in the exam. You have a company, you are receiving, you sold the product to somebody in another country, and they're supposed to pay you back within 1 month, 32 days. And so you expect to receive payments $50 million. So you're worried about, you need to hedge the risk that this $50 million, because you are based in euros, you use euros, the guy uses pounds, so the guy is going to pay you in pounds and you hedge yourself. So and this is what the GBP spot rate is today for the euro. You're going to go and meet a dealer, and the dealer quotes these forward points for you. So how do you deal with that? How do you deal with these forward points? Remember the formula that we had in that I was showing you about earlier in the material. Just to be clear, everybody can still see my screen. Okay. No, it's not this. Yeah. So you're giving okay. Yeah. So you're giving the spot rate and the forward points. This is the forward points, not the forward percentage. You know that the forward points is given by the differential between the FP is given by the differential between your spot rate minus your forward rate. That's whatever the difference between those two. That's how you determine your Okay. So your forward point is given by the differential between the forward quotation minus your spot quotation times 10,000, because of, we said we're scaling by 4 decimal places. So you know what the spot rate is today. The spot rate is this is your forward point. You know what the spot rate is today. The spot rate is this, and this is what he has given you as your forward point. So it's here, this is minus 1.4. What you then do is multiply this by, you're basically trying to solve for what the future forward rate is going to be. That's what the example is actually asking you to solve for. So you know that this is you need to multiply. This is what your forward point is. Your forward point already has been given to you. So you're trying to sort of walk back the answer. So if we were to walk back the answer, pretty much we know what the spot rate is. That's what this number is. And we're trying to figure out this. We know this is given, and this is 1.4 points. Now we're solving for this guy. What number would that be? Minus 1.4. So you also have to, anybody give it a go? Just to be clear, what would he be doing since he's receiving payment? Would he be buying or selling pounds forward? He's a French company, so he's receiving payment. So clearly what he wants is euros. So that means he can't be buying euros. So you can always eliminate option C. The answer is one of these two, because he will have to be selling pounds. He's going to receive pounds and he doesn't want pounds. So he have to be selling pounds and buying euros. So which of the two answers would that be? Sure. Nobody's giving it a shot. Wow. B, yes, the answer would be got stuck. Okay, so yeah. So essentially, you're just dividing. So let's go back right again. So like I said, the forward point is given by your forward rate, which you don't know what it is. So the question has given you, it's told you that. So let me clarify. Yeah, so it's giving you that. Remember what we said? We said your forward point. Oh, sorry. Your forward point is given by your forward rate minus your spot rate times 10,000. Now, the question has given you what your spot rate is, which is 0.8725. It's telling you that given the above, the trader could hedge. So we are looking forward. The question we're trying to solve is the forward rate. And it's giving you what the forward point is. The forward point is minus 1.4. So if this is minus 1.4, we simply divide minus 1.4 by 10,000. I was doing a bit of elementary maths to bring this one over to the other side. And we're left with FP minus 0.87252. So if you bring that over to this side, that means you're going to be adding 0.8752 plus rather minus minus 1.4 over 10,000. So if you did minus 1.4 over 10,000, you should get the answer. Does everybody get the answer? $1.4 divided by 10,000. Yeah, 1.4 divided by 10,000 is 0.3014. 3014 plus point, or rather minus, when you subtract it from that, that gives you. Yeah, so 10,000 is, remember we said that currencies are typically quoted in 4 decimal places. 4 decimal places. So that's the standard quotation for currencies on the CFA exams. You except the Japanese yen, which is quoted in 2 decimal places, but most currencies are quoted in 4 decimal places. So what you always take is that because it's 4 decimal places, then it means that's where they get the 10,000 from. For 2 decimal places, we're going to do times 100. That's the yen. It's going to be times 100. So just take it that the 10,000 is just before it's just a means of scaling, because if you have 4 decimal places to normalize it, you have to do by 10,000. Yeah. Then the next question here, it says the best interpretation of the forward discount is shown by the euro is expected to depreciate over the next 30 days. The 1-month interest rates in the US are higher in the UK. 1-month interest rates in the UK are higher than the Eurozone, and 1-month Eurozone rates are higher than the United Kingdom. Now, remember what we said? We said that when you have a forward discount, what does it mean? When you have a discount means the currency that is trading at a discount has what? Higher interest rates. A higher interest rates. Oh, the answer is B. B is the answer. B is not C, because he's receiving pounds. So because he's receiving pounds, how does he hedge? He's a French company. It's basically, look at it like this. You're a Nigerian company. You're going to be receiving Ghanaian cedis. You don't need Ghanaian cedis. What you need is Naira. So how do you hedge yourself against that risk? You sell cedis forward, even though somebody's going to give you. So you sell it forward in the currency market. And so that's how you sell cedis. So in this case, it's not C, because he will have to be selling. If C means he's buying pounds, the man is going to receive 50 million pounds. He doesn't need to buy more pounds. What he needs to do is sell pounds and buy euros, which is the currency. And it's C, because once you work this out, this is 0.00. You get it. Okay, so the best interpretation for the forward discount you're seeing here is the best interpretation for the forward discount you're seeing is, remember what I said? I said when a currency has a higher interest rate, it trades at a forward discount. When it has a lower interest rate, it trades at a forward premium. So in this case, the forward point is negative. That means the euro is trading at what? The base currency here is trading at a discount. That means most likely interest rates are higher in the eurozone than in the than in the UK. Now, the question as always says best. So that's one thing about the exam CFA you have to get to know it, because if you actually said the euro is expected to depreciate over the next 30 days, yes, you're correct, because that's what the dealer is saying. The dealer is saying, well, he expects it, but this is just one dealer. So which answer best tells you what's going on here is that interest rate in the euro must be higher. That's why he's giving you a negative. If interest rates were lower, you definitely won't get a negative sign. All right. So here, next question says, a 12-month forward future. If the 12-month forward rate, so what we're given is the 1-month forward rate. If the 12-month forward rate is given by this, what is the forward point? So, okay, damn right, that's my question. So, I said the currency with the higher interest rate trades at a forward discount, whilst the currency with the lower interest rate trades at a forward premium. Now, what the question says here, number 2 was saying was that, which is the best interpretation? Now, if you said is expected to depreciate, well, that's correct, but you can't say that's entirely correct, because remember what we said, that you don't necessarily always get is an expectation, so it may not necessarily depreciate like that. Whereas, and again, the forward is not always the best predictor of future spot rates. So because the forward is not always the best predictor of future spot rates, the guy may be wrong. But what you can say for sure is that the reason why you're seeing a negative forward point is that what interest rates are higher. That one is for sure. Because if you remember the no arbitrage condition, it means that you must have plugged in a higher interest rate number there for it to arrive at this. Let me go over that point again. Yeah. So, like I was saying, so I think it's back to this chart here. Yeah. So this is the forward. So we all understand this part. You're in your home country, then you try to go abroad, you invest in the foreign currency, you invest in an interest rate. Then the forward rate, how do you solve for this forward rate? Solving for this forward rate means you have this. So making this rate of the formula, doing some mathematics, gives you this. Now what this is saying is that if this number is negative, how does this number become negative here? This number can only become negative here if this forward will only be a negative rate. Remember, we're dealing with domestic, right? It will only be negative if and only if this D here is minus, or rather if this D here is higher than this D here. Because I don't know if you know this thing in wherever you have a division, if you take a log linear expansion, this term here will be subtracting this term because it's division. So if these two terms are subtracting, what would then mean is that for you to get a minus, it must be that this denominator is larger than this denominator, than the numerator rather. That's when you get a minus, and that makes the sign negative. Some of it is just mathematics, doesn't have anything to do. If I was to show you the proof here, it's just primarily because if you remember log linear expansions, it means this divided by this, it means you can reduce some form of subtraction relationship, and then because of that, as long as this is higher, it will be negative. So that's why you have it. If this is lower, it will be a positive relationship, and this will be positive. So, but the general is always that the currency with the higher interest rate will always show a discount, while that with the lower interest rate will always show a premium in the forward market. Is it a good predictor? Not necessarily so. That's why the answer couldn't be B in that, it couldn't be A in that last question. Okay, just to run through, I think. So for this, what this one I just want us to calculate is how do you calculate forward points here? So again, the formula for forward points, you have 0.87925, subtract it from this, that will give you a number, then you divide that number by 10,000, that will give you, what's the answer for this? So in this case, we're just asking us straightforward to just apply the forward points formula, which is the forward point is given by your spot rates, by your forward rates, 0.87295 minus your spot rate, 0.8752. and you divide the answer by what? By 10,000. So if you did that, my suspicion is you probably get what? You probably will get, anybody work it out? Yeah. Has anybody worked it out? So this minus this divided by 10,000. Have we divided by 10,000? Harris says yes. So the answer is A. So yeah. So A. All right. Okay. So, oh, sorry, multiplied by 10. Sorry, multiplied by 10,000. Multiplied by 10,000 times 10,000. So that means that's what takes away. That would have been C, right? If it didn't multiply, if it divided, that would have been C. So yeah, they always have a way with that. So next question I think is so this is an example now. They said, so if you found a second dealer who quoted the 12-month forward at a discount of 0.3%, what then do you do? So you found a second dealer. So basically, if we were to compare this as a percentage of the spot, if you now find a second dealer who quoted it at a, so what they're asking us to do is, what's the forward premium or discount on these quotes here? So what's the forward premium or discount on these quotes here? Can we calculate that? Yeah. So yeah. So the solution to that is, what they're asking you to do is this. So this man has queried, you calculate the forward points. Now express the forward point as a percentage of the spot. Or rather, let's go through the long and hard way. The long and hard way is to say, yeah, the long and hard way is to say the spot rate times 1 plus forward points as a percentage of the spot rate. Yeah. So the forward point as a percentage of, express the forward point as a percentage of the spot rate. And yeah. Has anybody got that? So this 22.5 that we got, we express it as a percentage of the spot rate. What would it be? Yeah. So okay. 22.5, the percentage of the spot rate. Everybody's silent. So what's the difference between, so here the answer to that is basically, we'll just take the difference between these two. which is this, express it as a fraction of this spot rate, and then multiply by 100. That is the forward premium. That's the forward discount. So when we said 0.872, 0.7295 minus 0.8752. What did we get when we submitted that? Yes. Okay, so that's this. So this would be a negative, right? Because it would be a minus. So then this then express this as a fraction of 0.8752. Yeah, so that's minus 0.2571, right? Percentage. So that's the spot rate. Now they said another dealer was quoting the forward rate at a 0.3% discount. So he was quoting it at 0.3% discount to the spot rate. Now, what would the French dealer do? Because that means this person was assuming that the euro would only depreciate by 0.257% in the next 12 months. That's what this dealer one was doing. Dealer one was saying that, okay, the euro will only depreciate by 0.257%. Dealer two, however, says, no, I think the euro would depreciate by even more, 0.37% discount. That's what he's saying. So that means he assumes he's going to depreciate by even worse. So what should the dealer do here? Given that he's seeing two dealers giving him two different exchange rates. One dealer is giving him this and one dealer is giving him that. Ideally, what should he do? If he was a sharp guy, no arbitrage, and what CFA is saying is option one, trade with either dealer because the two forward quotes are equivalent. We know this is not correct because we've seen that this man is saying is this man is saying is this, so it's definitely not correct. I'm locking a profit by buying euros from the second dealer and selling to the original dealer. That means you buy from this guy who says he's going to share and push it to this guy, or you buy from the original dealer and sell to this guy. Now in CFA, the one thing we always do is we buy low, sell high. So if we buy low, sell high, who is giving us a cheaper rate? It's most likely this man, because this man assumes the euro will depreciate more. If the euro depreciate more, we are a euro based fund, need more euros for every GBP we get. So we buy from this guy and we sell to this guy. That's what we do. So the answer is B. Okay. The last one is so the last one, what this one is saying is that if the euro spot and the spot, the number of forward points here equivalent will be, I think this one will try and walk through. Yeah. So again, it just goes back to that example to that formula I was showing you earlier, which is this formula here. Yeah, which is this formula here, really. What they're asking basically is just to calculate what the forward rate would likely be closest to. That's essentially what they're asking you to do. So if you apply the formula, spot rate, you have the spot rate, you have your foreigner scaled for that, which is what they're doing here. If I just go straight to the answers, which is what they're doing here essentially. So what they just did was you have the forward, your spot rate, 1 plus GBP, which is the foreign currency. You are based in euros. That tower I was talking about was 270 because they're giving you 270 months of the 360, 360. That's the forward rate that they're working. So just basically applying the formula that you have essentially. So yeah. Okay. Okay. We're run along now. Okay. Okay. And so I think beyond that, most of the rest is just really explanations, definitions, trying to know things. They're always going to deal with talk through issues of potential currency exchange rate regimes. You should know the properties of an ideal exchange rate regime, which is that exchange rate is credibly fixed, all currencies are fully convertible, and then each country wants to be able to make independent monetary policies. So this is like what they call the impossible trinity in economics, that there are three desires of every central bank, which is to have a fixed or stable, fairly stable fixed exchange rate and full currency convertibility. In other words, foreigners can come into of unrestricted capital flows. At the same time, being also able to make independent monetary policy without reacting. However, what people have realized over time is you can only chase two of these conditions, while you have to forego a third one. So there's never really an ideal currency regime. So what kind of currency regimes do you have globally? Different types. You have countries that have no legal tender. In other words, they are using some of that currency as their own currency. That's, for example, the dollarized countries like Ecuador, El Salvador, and the likes. Then you have those that use euro, such as Kosovo, San Marino, Montenegro, and those that use a basket. Then for countries that you have monetary unions like the Eurozone is one big monetary union, so they all use the euro as their currency. You have countries that pursue what is called a currency board, in which case they keep a fixed amount of dollars and they back their currency with a fixed amount of dollars. The currency board is responsible for establishing the value of their currency, their exchange rate, based on the amount of USD they have within their economy. You have various countries that do that. You have fixed parity. These are countries that they just said they actually at a fixed par number to another currency. You have the dollar-based ones. You have the euro-based ones, which is the francophone countries in Africa, CFA franc countries. That's the West African and the Central African CFA franc. And then some of the Portuguese and French provinces, so Cape Verde, Sao Tome, Comoros, all these currencies that are pegged against the euro via Portugal is via Cape Verde is via Portugal and Sao Tome, Comoros is via France. They also have those that use a basket of currencies. For example, the rand-based currencies in South Africa, which is Namibia, Swaziland, and Lesotho, all surrounding the South African rand. So they use some basket. You also have those that use a sort of target zone. In other words, they believe that their currency should trade around some percentage of some anchor currency. Then those that use a Cronen peg. In case of Botswana, they use a basket. In case of Nicaragua, they just use it. It should be at some rate fixed with the rate of depreciation related to the USD. You have those that use a crawling band, like China. They use a band. A lot of countries fall within this band. And they have the mile float countries that use a mile float. A lot of countries, Nigeria, fall within this bracket. And then you also have those that are they independently float their currencies. They let their currencies be fully floated. No set target within which the central bank wants to do that. So these are all the floating currencies. So now they have no specific target of where they want their exchange rate to be. Wherever the market wants the exchange rate to be, that's it basically. And last thing for currencies are exchange rate and trade balances. How does exchange rate influence trade balances? So one thing we often hear a lot of people say is that, okay, if you devalue your currency, it will support what's the implication of that on your trade balance as a country? Is it good for your trade balance? There are two alternative approaches. First is the elasticity approach, which says for devaluation to be effective in addressing the balance of trade deficit condition, there are two conditions that must be present. Number one is the Marshall-Lerner condition, and basically is the Marshall-Lerner condition, which is given by, the long and short of what the Marshall-Lerner condition is saying is that the elasticities of your imports and exports must be greater than 1. In other words, they must be greater than 1. Now, if you remember, I think we'll come down with the elasticity, but the elasticity of anything is greater than 1. It means a small change in an item would lead to a big change in quantity demanded. So what they're essentially saying is that if your currency devalues a bit, there's going to be a big adjustment in terms of the volume of imports and exports. If you have that scenario, in which case your elasticity of your export and elasticity of imports, the sum is both higher than 1. So in other words, your export and your imports are highly elastic or highly sensitive to changes in your currency. Oh boy. Okay, back. Hello? Hello? Can everybody hear me? Can everybody hear me? Just to be sure. Okay. Thank you. So, what essentially is trying to say is that so what the elasticity approach is saying is that if your import and export are highly sensitive to changes in your exchange rates, then yes, changing your currency will positively impact your trade balance. But if you find that your elasticity of import and exports are not more than 1, then it's unlikely what you get is that anytime you change your exchange rates, there will be changes in your export and import. So first thing it says, look at elasticity. What's the elasticity of your export and import? And it's given by, the Marshall-Lerner condition is given by this formula here, which says the weight of your exports times your elasticity of exports, the weight of your imports times what this one checks is, it kind of makes it a positivity condition. n-1 must be greater than 1. As long as greater than 0, in other words, as long as the sum of these two items is greater than 0, it's positive. That's the Marshall-Lerner condition. Now, if imports and exports are elastic, it always holds. If imports alone are elastic, so in other words, if this is greater than 1, then you know for sure that the condition will always hold, because this is always most likely going to be positive. But as long as this is positive, to an extent, you expect that it will always hold. So so it just reduces. But I think the important thing is just the concept. The concept is that if your export and imports are not elastic, so in other words, if one of the elasticities is less than 1, then more likely, particularly for imports, if the elasticity of imports is less than 1, then what that tells you is that this sign here will be a negative. And this sign here is a negative. It may take all these conditions into negative. So and the other approach is what is called the J curve, or so you have J curve, which is that there's always time lag between when a currency devalues and when there are changes in your trade balance. So that's what it's trying to say. And the other approach is the absorption approach, which just talks about for devaluation to be positive, it must increase national savings and things like that. Again, what people find is that this only holds when the economy is operating at excess capacity. Things like that. I think, so what I'll just do now is I think we'll run right back to, I don't know if there are any questions on the currency. Otherwise I'll just go straight to elasticity. Topics in demand and supply. So again here, there's only one thing is required to calculate, which is just what price, income, and cross elasticities. Most of the other things here are basically comparisons, being able to distinguish, being able to describe concepts and things like that. But the key things they want you to be able to calculate in the exams would be price, how to calculate price, income, and cross price elasticity, and how to interpret it. Now, elasticity just basically refers to the rate of change in something with respect to something. Now, in the case of demand, basically what it's referring to is that the quantity demanded of a good or service is typically a function of three primary factors of importance to us in economics, which is one, the price of the product. That's, for example, for good X, the price of good X is very critical in determining the quantity demanded, the income level of the consumers, and the price of alternative goods. So now of goods that are of other goods. Let's just be there for sure. Let's just do that. So own price elasticity, income elasticity, and cross price elasticity. And for almost everything, it's pretty much the same thing. You're taking the derivative of the quantity demand function with respect to the variable of interest, whether it's price, own price, income, or price of other goods. Now we'll see some examples. Basic concepts for you to remember. How do you interpret elasticity? So they're giving you an elasticity of the elasticity. How do you interpret it? For own price, you always take the absolute values for own price. Absolute values, that means you ignore negative signs. And then you interpret it between how it's zero is perfectly inelastic. What that means is that even if you change price by a big magnitude, the quantity demanded is not going to change by much. That's more perfectly inelastic. So in other words, if you increase the price of the product by a lot, quantity demanded won't change. And we'll get to what kind of products this look like later. And relatively inelastic means that if you change it, let's say you increase the price by 10 naira, quantity demanded adjusts, but not by a lot. Again, it doesn't move, but you need a very big increase to see some changes in quantity demanded. Mutually elastic are goods that you increase the price by one, quantity demanded adjusts by one. So 1-to-1 relationship. Relatively elastic are you increase it by small, increase by a lot, but not by a lot, but increases by some magnitude. So that's relatively elastic. Then perfectly elastic is you increase by just a small quantity, and that's it. People change their behaviors to that product. People change completely. Typically, you find for goods that have a lot of substitutes, or like in a market, and for agricultural products, for example, this is an example. Because if you're selling an orange at maybe say 5 naira, and I know just down the street another guy is selling that same orange for 2 naira. If you tell me you're going to increase your price from 5 naira to 10 naira, I know that guy is still keeping his own at 2 naira. That's it. I'm off. I'm not buying it from you again. So pretty much that's a very good example. So for income elasticities, basically these are goods that, as the salaries of they have two types, normal and inferior. As the salaries of the consumers increase, they tend to buy more of those goods. In that case, it's positive. So in other words, their salary increases, their income levels increase, they buy more of that product. Those are normal goods. For inferior goods, are goods that, of course, when salary increases, they suddenly cut down on that. Historically, they used to say Gary, cassava was a good example, but generally they find that goods that people just buy as secondhand clothes. People just buy, for example, secondhand clothes. And as people's income levels increase, they just gradually stop buying secondhand clothes because they feel they can do better. Then you have things like cross price elasticity, which is basically two types: substitute goods and complementary goods. If the cross price elasticity, in other words, if you increase the price of a good, and immediately demand for another good picks up, it most likely means that good is a substitute. So, for example, Milo and Bonvita, often different types of beverages. If you increase the price of one and the price of the other one stays constant, the natural what people do is they'll substitute away from that product to that product. Complementary goods are goods that, of course, if demand increases, if the price increases for one, then consumption reduces for the other one. It means those two goods must be consumed together, because that's why the demand is reacting in the opposite direction. Yeah, this just tries to summarize some concepts. Let me see, we'll just take some examples just to try and drive on the points. Yeah. So. Right. Okay. So we have let's try question 5 here. Yeah. So this is really how you probably see in the exam. So you have quantity demanded for onions. Onions is given by this function. You have a constant, and then you have a negative relationship. The sign here is negative for the price of onions. It's positive for the income level. And then for the price of tea is given by tomatoes, is negative. So what would I tell you about tea immediately? Tea is well, tea is most likely what kind of good? For us to ask a question, what type of good would tea be? Given that the coefficient relative to P is negative, what would that be? Anybody? Oh yes, Zuzu, the slides will be shared. Complementary, yeah, thank you. So, because as the price of tomatoes is going up, it's called that demand for onions is coming down, so it's complementary. So yeah, so how do we solve this question? The question says quantity demanded, price of a pound. Okay, yeah. So it says if the price of onions is 125, so now we're giving you the price of onions, and the household income is $2,500, and the price of tomatoes is 3.75. The cross price elasticity of demand for onions with respect to tomatoes is given by closest to. So how do we compute that? The first thing we do when we're trying to compute that is to figure out what is the, sorry, give me a second. Yeah. Okay. Sorry. Yes. Just had few technical issues. Okay. Sorry about that. Okay. So yeah, so we're giving an example here. So the first thing we'll do, let me just pull up okay, how to walk through elasticity questions is always to note that. So the first step you do typically, most time when they give you a question, is solve for Q. So Q is given by your quantity demanded. Then you solve, after solving for Q, you have the coefficient, which is C, and then price. So it's just it, but I'll show you what I mean when I start working on that. Okay. So in this example now, we're giving quantity demanded. So like I said, the first thing you do is you solve for Q, quantity demanded. So what is the quantity demanded, which is given by this function? They've given you what your price of onions is. So your price of onions is PO is 1.25. So if you're solving for Q, it's going to be given by 3 minus 0.05 times 1.25 plus you solve for, you introduce your 0.009 times 2,500. So basically you plug in all the information they've given you into 0.16 T. So T here is 3.75. 3.75. So you plug it in, that gives you what our quantity demanded is. So what's our quantity demanded for? What's our quantity demanded? What's it going to be? Quantity demanded. So what we've just done is we've just plugged in the numbers they've given us. They've given us price of onions, we plugged it in, income, we plugged it in, and price of tomatoes, we plugged it in. So we solve for Q. So after solving for Q, what do we get? What do we get? First capital, so that would be 24.8375. 24.8375. Yeah. So that's the quantity demanded function for onions. Now the question says, now if you remember, your elasticity formula is given by your percentage change in price, so it's always given by percentage change in quantity demanded over percentage change in price. Percentage change in quantity demanded over percentage change in price. So in this case, we're looking for price of tomatoes, respect to tomatoes. So we've gotten our quantity demanded. Next thing we're going to look at is asking us, the question asks us, if the price of onion, we're targeting what's the cross price elasticity, right? So oftentimes it's reduced to a very simple, elasticity is often reduced to a very simple coefficient or I would say for a function, wherein it's always going to be sort of like this. The first thing you are computing is your so for elasticity calculation, what you always end up looking for is first is the derivative with respect to the entity you're looking for. So in this case, we're looking for the derivative with respect to what I'll call the derivative of the QD function with respect to QPT. So this is often the first item we're looking for. Second element we're looking for, well, we then multiply that by the price and divided by quantity demanded function. So this is often what it reduces to. So when I said the first thing you look for is you get is your coefficient, I was referring to this, your Q, your quantity demanded. That's we've gotten what our Q is. Our QD here is 24.875. That's this element here. We've been given a price, the price of onions, because we are calculating the unit price elasticity of onions with respect to tomatoes. So the price in question we're looking for, what it's saying is that by how much does the demand for onions change with respect to a change in the price in tomatoes? We know what the price in tomatoes is. The price in tomatoes is what? It's price of tomatoes is 3.75. So we're going to do 3D over 3.75. So that's yeah. So we know what 3.75. The last element we're looking for here is what is the derivative of the demand quantity demanded function with respect to price of tomatoes. Now, if you do a derivative, this is going to be 0 because none of them has price of tomatoes. But the only item here that has price of tomatoes is this, which is the coefficient of PT. So that's the last element we're looking for, coefficient of PT. So with that in question, what would then have our solution there reduces to minus 0.16, which is this coefficient, minus 0.16 times price of tomatoes. Price of tomatoes we know is given by 3.75 divided by quantity demanded, 24.8375. So we multiply it all and we should have what our answer is. Yeah. So Big Ben says B. So the answer should be B. So always with elasticity questions, what you always want to, like I said, is always try and reduce it to this. The first thing you're going to find out is what is elasticity. So if it's given a function, it's always a derivative of respect to that, which is what you have here. Then your price, whichever price is the target price of interest, in this case is PT. And then your point demand. Your point demand is typically what you solve for by plugging in all the values they give you, assuming everything is constant. So and that's it. So at the end, they then ask us to say, okay, household income is, let's say they change. So they can always play around it. They'll give you, yeah, they're giving you price PT. They could play around and give you another example. I think there's another question like that in the book where they give you, okay, this is private university. This is another example here, private universities and public universities. So here they give you quantity demanded of private universities, public universities. In this case here, they then told you, assume that the price of private university is 38, I is income level is 100, and PU is 18. Then said, okay, solve for, which is again the first thing they asked us to do there, complementary goods, right? So solve for this. Okay, let's try our hands here. So let's get our hands dirty here. Let's try and solve for 8 using the approach we used for the first time. Okay. So again, what you first of all do is you plug in all your values there, get your QD. So again, it's just going to be your private universities, that's this. We already have that as, so if we're to solve, we're going to get the derivative of the quantity demanded function with respect to price of private universities. That is given by 0.9. Then what's the price of private universities? That's given by 18. And then the quantity demanded of private, of PR, of quantity, price of demand with respect to private universities. So we solve for QDR. We solve for QDR, we just insert all of this. PR will be 38. Solve for this will be 100. And so forth. So what will the answer be like? What will QD be? Okay, QD is 62.4. Yeah, so we guess it's 2.4. What would then be our final answer? Okay. Minus 1.9. Everybody in agreement? Minus 1.9. Yes, minus 1.9 is the answer. Okay. So same thing, if they were not asking you for income elasticity of demand, income elasticity of demand just means that means this question would just devolve to 0.8 times 100 over 62.4, because the thing that your income elasticity here is 0.8. So what would that be? That would be 1.3. Yeah. And then the last one will be cross demand elasticity of private university with respect to public universities. Oh, wait a minute. Okay, I think I'm going to take the first one. Cross demand of private university with respect to public universities. Okay, yeah. Okay, public universities. Okay, I made a mistake the first week. The first week will be, this should have been minus 3.1, not 0.9. So this would then be 0.9 times, this would be 38, so this would be 18 over 2.4. Sorry, apologies for that. So if the cross price elasticity between two goods is negative, what would those goods be? I think this answer is fairly straightforward. It would be complements. Okay. So let's get back on track. Yeah. So beyond elasticity, I think the rest of it is just basically understanding. So you have the cost concepts, the various cost concepts, total fixed cost, total variable cost. I think what we'll do here basically is try to run through another example as well here. Yeah. I think this one will drive on the point. So this is another example here. Yeah. So basically, your cost concepts in economics. Maybe I'll try and speak through the material, run through the material. So your cost concept in economics, yeah. So basically, they're always all around the same thing. So let's start with cost concepts. Okay, yeah. So you always have your total cost. Total cost is a function of any business that set up basically would have variable and fixed costs. Variable costs are costs that vary in the level of output, and fixed costs are costs that are a fixed level. That's because they are costs that you sink. For example, rent. Whether or not you produce biscuits or you don't produce in a day, you are still going to pay your rent at the start of the year. So they are fixed costs. Salaries of administrative staff, those are like fixed costs. But there are variable costs like cost that, for example, any cost that has to do with per unit. So let's say each unit of output you are incurring a cost that are direct, those are variable costs. So as always, total cost is always some of these two costs. The same concept also applies to averages. So your average total cost would always be a sum of the average variable cost and the average fixed cost and the sum. Typically, your cost curves are U-shaped. This reflects the concept of diminishing marginal returns in economics, which says that as more and more factors are added to a fixed factor, variable factor added to a fixed factor, what happens is that it increases first, or in the case of cost, it reduces first, and after a while, it reduces subsequently. So that's why you always have a U-shaped curve. Now, your marginal cost, which is your MC, always cuts your average cost curves at their lowest points. Now, it always cuts them at their lowest point. So it's always a upward sloping U-shaped curve. So it always cut them at the lowest point. Now, the sweet spot for most manufacturers is being able to produce at the lowest point of the cost curve, because at that point, that's where your profits are highest per unit of output. Next thing, we also look at concept of profitability. So what this trial is look at is, when does a company stop operation? When does it stay in business? When does it exit business and things like that? So for a company that is in a highly competitive, or whatever industry you are in, what we always try and say is that if in the short run, if your average revenues are covering your average total cost, you can stay in business. However, if your average revenues cannot cover your average variable cost, then you should just shut down and close shop, go away, basically, because okay. Can your cost cover your average cost in the short run? As long as your revenues can cover your variable costs, you can stay in business. But in the long term, you have to exit that industry because it's loss making. If, however, you're unable to cover your variable costs, as always, you just need to close shop and go away, because you can't cover your variable costs. You're already losing money and losing money back. So you want to just leave that industry. So then you also have your revenue relationships. So revenues is always your price times your output. That's just total revenue is. Same application applies. You know what your total revenue is. Your average revenue is your total revenue by your output. Your marginal revenue is the change in your total revenue by producing one more unit of output. That now you're under a perfectly elastic when you have perfectly elastic products for goods that are perfectly elastic. In other words, a small change in price drives big changes in quantity demanded. What you tend to find is demand curve is perfectly elastic. In other words, a straight line. So what that tends to happen is that your price is often driven by what the market is. It's typically in a fiercely competitive industry, particularly, like I said, commodities, where there's no special distinguishing features between products. So the marginal revenue is always, the average revenue is always equal to your marginal revenue is always equal to your price, and your price is given by the market because the market determines what the price is. So firms just have to take the market price as given, and then of course, and because they take the market price as given, every change in marginal revenue must be driven by a change in price. Otherwise, marginal revenue pretty much is the same thing as the average revenue. Average revenue is the same thing as the price. Yeah, and so these are the cost concepts, and yeah, so it just goes to talk through what's the minimum efficient scale. For most companies, I said earlier, is always where you're the lowest point of your average. You always want to be producing at that point. That's where you want to be producing at the lowest point of your average cost. There are things like economies of scale, diseconomies of scale. As a company gets bigger, what you tend to notice is that they tend to get scale advantages. So, for example, if you're producing, a very good example, if you're a cement producer, for example, and you're producing 80% of the industry, what you tend to find is that for you, because your business model involves a lot of fixed costs, and rather because over time, all costs become variable. And what you tend to notice is that for large-scale producers, they tend to enjoy economies of scale because they're producing a lot. I mean, it's the same inputs that they put in that they get, but at lower cost, because you're spreading costs over much higher levels of output. Those are economies of scale. As the company just gets bigger, it just naturally sees that its profitability improves because some costs which are already some are spread over larger levels of output. The economies of scale is just, as the company gets bigger, there are certain things that becomes harder to do. For example, communication. What management is saying at the top is different from what people at the grassroots are hearing. And it's just completely bureaucracy, because the company gets bigger, they add various layers upon layers to try and give people jobs. And you just find that it just makes the company more efficient or inefficient. Whereas when they were much smaller and they were growing, these things weren't there. So these gaps weren't there. But as they just got bigger, it just will come with the size. The next section just talks through market firms and market structures. Basically, again here, there's no calculation in the notice. Everything here is just basically describe, explain, describe, identify. So basically, it's just trying to, how can you identify certain market systems? I'll just run through this table, very simple. For firms that deals in the perfect competitive market, again, the main things to just always compare with is how many sellers are there, how many products, what's the degree of product differentiation, barriers to entry, pricing power, and then is there any what's distinguishing features on the product, maybe like branding or non-price competition. So for perfect competitive markets, a market with many buyers and many sellers. I mean, there are always many sellers. Product is a product differentiated? No, there's no product differentiation. Because why? Because, for example, like I said, agricultural products, you're selling oranges, you're selling eggs. There's no way you can say your own eggs are sweeter than, your own eggs are better than another egg because it's eggs. There's no, unless you're genetically engineering the eggs, but it's just eggs. The chicken laid the egg, so there's no way, even if you brand it or say anything, in reality, people are just seeing that it's just eggs. I mean, you didn't do anything special to create those eggs, so chicken just laid them. So there's little or no differentiation among the products that you can say, okay, based on that, you want to charge your product, your egg different from another egg. There's nothing that is like that. Customers will try and beat down, or like carrots. People will try and beat down the carrots to the basic level. And barriers to entry are low. Anybody can enter that kind of industry. You just get chickens laying egg, you're already a chicken, you're already an egg, you're in the poultry business, really. Pricing power of the firm, there's none. It's given by the market. The firm can say, well, we will set our own egg prices at this level. Don't care what the industry does. We have to move in line with the industry, adjusted for transport costs, of course. Anything of non-price competition? No, there's none, because there's no point. I mean, why would you spend time branding and things like that when it's just the same basic thing? So there's none. Monopolistic competition, many sellers. However, products are differentiated. So in other words, there are many people selling the same stuff, but they're able to differentiate their products. For example, bread. I mean, I'm selling you bread that is like this. I mean, I'm selling you sliced bread. Maybe I made it a bigger or smaller, where I can differentiate. For example, milk. Milk is another good example, because where people can vary the sizes, they can vary the sizes around and say, okay, maybe I'm selling just this. So there's some form of differentiation in the products that they're selling. You see, some is full milk, some is skim milk, some is like that. They can apply some form of differentiation. Entry barriers, fairly low, but not as low as you had under the perfect competition. Pricing power, yes, firms can distinguish their products so they can sell. Then, of course, they do a lot of advertising to try and differentiate their products from others. Oligopolies, yeah, oligopolies, you have how many sellers? Typically few. So, for example, telecoms industry, you have just few sellers, typically selling the same product. There's nothing different about it. They're just telling you ability to use communication, internet, phone calls, and things like that. So there's really nothing. However, entry barriers are high. Why? Because fixed costs are high. To set up that kind of business, you have to pay a lot of money, lay so many towers. So fixed costs are high. So because fixed costs are high, the barriers to entry are quite high. So those barriers are why you have just few people operating. Pricing power is quite considerable. Firms typically have ability to be able to play around their products. And then, of course, they always differentiate. Because why? Because that's one of the means by which they can pull customers themselves. Lastly, you have a monopoly, which is just basically one producer. It's basically selling the same thing, one product, and entry barriers are very high. There are reasons why. I think you should know that from the material. Some of it is natural, some of it is maybe because of government regulation and the sort. And then pricing power is quite considerable, although sometimes governments usually step in to regulate prices for oligopolies. They're really well, sometimes they advertise, but you can decide not to do it anyway. Any questions on that? So typical example, typically I try and find is play around oligopolies and just try to see how ideas around price settings and so. One thing I noticed is okay, yeah. So every year, I think I was just trying to figure out Nash equilibrium. So you sometimes get questions on Nash equilibrium as well. I'm just showing how people can sort of think through how Nash equilibrium works. What I'm just trying to do is try and solve one question here so at least everyone can see how it works. So the Nash equilibrium is often used to determine how competition works in an oligopoly type market. Where there are few sellers. Just how to understand how the interactions work. So something you see from time to time. Yeah. Okay. So you have two companies here. One is ARCO and the other one is Barco, and they're both pursuing. They're in the software industry whereby they produce software. They follow two types of strategies. So one of them pursues a high price strategy, and the other one pursues a low price strategy. So how do you? Please bring it. Sorry. Okay, so one of them pursues a high price strategy and one of them pursues a low price strategy. So how do you sort of solve this type of Nash type equilibrium questions? So one thing I think you can do is so you have two companies, you have ARCO and you have Barco, and they're both pursuing two strategies. One is pursuing a low price and high price, and this guy is pursuing a low price, and this guy is pursuing high price strategy. So what I always try and do is just to clarify thinking around the game. Yeah. So what the game is, what this is saying is that if ARCO is playing a low price strategy, what are the payoffs for the two players? And the other guy is pursuing a low price strategy. So let's say, okay, if ARCO is pursuing a low price strategy, the first number is for ARCO and the second number. So if ARCO is pursuing a low price, the payoff he gets is 70, but the payoff for his rival is 70 as well. He gets 50, his rival gets 50. If however is pursuing a low price and his rival is pursuing a high price, he gets 80, his rival gets 0. Now if ARCO however is pursuing a high price and his rival is pursuing a low price, ARCO gets 300, his competition gets 350. Now if ARCO is pursuing a high price and they're both pursuing high price strategies, then he gets 500, his opponent gets 300. Now how do you play Nash equilibrium? So Nash equilibrium, what happens is that for each strategy, you just compare what is optimal for the player. So now let's assume ARCO is playing a low price card. It's playing a low price strategy. Under a low price strategy, what is optimal for him if he knows that what is optimal for ARCO to play if he's in the first state of play, rather let's say what typically the way to look at this. ARCO would assuming my competitor is playing a low strategy. What strategy favors me to play? Do I play a low or do I play high? Now, as my competitor is playing a low price strategy, what favors me? He doesn't know what his competitor is playing. If his competitor is playing a low price strategy, what favors him? His payoff is 50 here, or his payoff is 300. So definitely he will play this card because why? Because it favors him. Because he gets 300, his opponent gets 50. On the other hand, however, if his opponent is in the high strategy phase, what payoff is better? The payoff that is better for him here also is high. Because why? Because he gets 500 if his opponent is paying 50. Same thing for Baco. Baco will look at it that, okay, if my opponent is playing under the low phase, what strategy favors me between low and high, right? So if you look at it, if he plays high, he gets 0. If he plays low, he gets 70. So he's probably going to pick this. Now, if his opponent, however, is playing a high phase, he doesn't know. So he says what strategy favors him on that state of play. So that state of play, strategy that favors him is low or high. He plays low because he gets 350 in that phase. In that phase, he gets 300. So he plays this. So what with Nash equilibrium would always result in a scenario where both players always end up playing, whereby Baco plays a low strategy and ARCO plays a high strategy. Because another game, they both get behind. They both get rather. That's the one that is like sort of seen as stable for both players. Don't know if everybody so follows that. Okay, I'll run through 15. We have 15 minutes to go. So the remaining part is GDP. So GDP, basically, a lot of it is so again here we're required. The only place where we do calculations are when we're calculating GDP under income and expenditure approaches. The remaining part are really technical. Okay, and then how we calculate and interpret GDP deflator, and then calculate and interpret GDP using other methods. So most of it is really explain. There are very few calculations there. So if we're calculating GDP using income and expenditure, what does it mean? Income approach. So GDP, what is GDP? Nominal GDP is price times quantity. Real GDP, as always, is GDP adjusted for inflation. If you're giving a GDP deflator, it's just your nominal GDP or your real GDP times 100. That gives you a deflator. If you're able to play around it to really get where you're going to. Your expenditure approach is given by C plus I plus G plus X minus M. So that's consumption spending, investment spending. You should be able to identify these items if they give it to you. For expenditure approach, you could also be given the value, sum of value added, which is basically just trying to look at difference between how much value added each person adds from each stage of the production process. The income approach is basically what are the sum total of all incomes by all factors of production in the economy, households, businesses, and then you adjust for taxes and transfer payments to be able to sort of go through this process. Yeah, most of it is just really being able to remember a lot of these formulas. I don't think it's anything too difficult. In terms of the concepts, aggregate demand is just levels of price and aggregate income that are consistent with expenditure equals income, and money supply level, that's your IS and your LM curve essentially. Your IS curve basically looks at your aggregate expenditure and income. Basically, the key identity you always have to remember is this identity we arrive at here, where your savings is equal to your investment spending, adjusted for the fiscal balance and the trade balance. How they arrive at it, they assume aggregate expenditure is given by this function, and they just equated it to what your savings is, which is what does the household spend the money on? That consumes it, it saves it, or in the form of transfer, pays out in the form of taxes, net taxes. So transfer payments adjusted for that. And so basically this is the main identity. And why? Because almost every question they ask you for, they'll always require you to make an interpretation of this identity. Savings in every economy is a function of the investment. It's always a sum of the investment that's available, whatever the fiscal balance is, the budget balance is, or the trade balance is. And from there, it can always tell you what happens to domestic private savings. So in every country, domestic private saving is either used or absorbed by investment spending, or financing government tax deficits, or in building up claims against foreign economy. So a country that runs a deficit, for example, a fiscal deficit, it must mean that private saving must exceed trade balances, or else private savings typically must exceed trade balance, whatever the trade deficit is on that side. Otherwise, there's going to be some imbalance somewhere. So if this number is positive, it means the private sector must save more than it invests, or else the company run a trade deficit. So for this number, if this number is positive, that means the country is running the budget, the country is running a fiscal balance. It must be two things that's happening. It must be that one, because for this number to be positive, it must mean that this sum is greater than this, because that's why this sum is positive, greater than zero. And that must also mean that the private sector is not really investing, they're really saving a lot of their savings, and they're using it to, that savings is what they're using to finance this government deficit, pretty much. And, or if that's not the case, then the country must run a large trading balance to be able to adjust and things like that. Let me see. Somebody asked me a question. Okay. Okay. On the so the remaining bits are just with the theoretical. Then on the LM side, what you're really dealing with is the quantity theory of money. So quantity of money, your price times output must equals to the velocity of money times times V. Yeah. So V times money supply, nominal money supply, and nominal GDP. So it's something around that. Okay. Just trying to share the slides. Just looking through what I think is important. Okay. I think I'm out of time now. Yeah. Okay, I guess we can call it a day. For the remaining parts, I think it's just really things you just really need to read the material a lot, because most of it is just descriptive. So they're not asking you to do any calculations or anything. Mostly it's just to oh, okay. So I'm going to make some host. Okay, sorry. Stop sharing. Okay. Sorry, I need to find the sign. Okay. Okay, I should make you host. Okay. Yes. Okay. Okay. Yes. So my time is up. But like I said, the remaining portion, what you just read is mostly just descriptive things. I'll share my slides. So if you want them, I'll share them. Most of the remaining parts of the syllabus is just really descriptive. So no calculation. Most of the calculation bits, as I said, we dealt with currency and another demand and supply. And the remaining part of the portion of the syllabus is just really descriptive. So it's just being familiar with the material and the syllabus. But in terms of the exams, I think the currency bits are always where a lot of the calculations, always where a lot of the work comes out from. So I think we'll just call it a day. I'll wish you all the best in your exams. Yeah. All right then. Bye-bye. Okay, Busai, you can take it from here.
Thank you very much, Wale. The next session we're having now will be portfolio management, which will be anchored by Bukola Akerele. Bukola, you can go ahead.
Sorry, I didn't know I was muted. Okay, good afternoon, everyone. We have 1 hour to just go through what portfolio management is all about. So let me just share my slide. Give me a minute. I don't know why it's not. Okay, just a minute. I don't know. My slide is not coming up. Just give me a second. Let me close it and reopen it again. Oops. Let me log in and log out. Let me log out and log in again. Just give me a minute. Okay, good afternoon once more. Like I said, we have just 1 hour to go by. I hope you guys can see my you guys can see my screen now. Can you guys see my screen?
Yes, we can.
Okay, thank you. So we'll just go in, we'll try to touch as many topics as we can, and before within the 1 hour that we have. And there's one thing I just want to say here before we go in is that most candidates see portfolio management as a topic for calculation. So we are all focused on knowing how to calculate, forgetting the fact that we need to understand what we are trying to calculate, because we're seeing sometimes that those calculations that you have been calculating are asked in an English format, and then candidates are, don't know what to do because all they knew was calculating standard deviation, learning the formulas, but they don't understand the formulas. So I'm going to just implore you all that even though knowing how to calculate is very important, it's also more important for you to actually understand what you are trying to calculate. And so that we could cover more within 1 hour, I'll just give a brief summary on each of the topics, not each of the topics, maybe like 3 or 4. Then we'll probably go to the new topic that was added, which was the behavioral biases. The slides are going to be available for you guys to go through it. So I'm going to just give a summary of each topic, and then we'll do like 2 or 3 questions under it, and then we'll move on. So I would encourage all of us to participate fully, and all the questions come up, just try to put your answers in the chat room, and then we'll solve it together, explain the question, and then we'll move on. So the first reading talks about the overview of the portfolio management. We are supposed to understand the portfolio approach to investing, describe the steps in the portfolio management process, talk about the types of investors that we have and their distinctive characteristics and the needs for each of them. And then we're also going to describe or differentiate between the defined contribution and defined benefit pension. Then we'll talk about the asset management industry, and then talk about the mutual funds and compare them with other portfolio pooled investment. Now, basically, the reason why we say invest in a portfolio is so that you can diversify away your risk. Such that I know for us that have read, you know that it will say that when you want to construct a portfolio, take 2 assets that are negatively correlated with one another, or pick one that has a very low positive correlation. Why we are doing this is because if there's a shake in the market and one asset has to fall in price, probably because they are negatively correlated, when one is going down, the other one will be going up, than you having 2 assets in the same industry. For instance, if you have an investment portfolio in quote right now, and you have, let's say, 5 assets in that portfolio, and those 5 assets are all from the banking industry or the insurance industry, no matter how good those stocks are, you're as good as having just one stock, because one pronouncement from CBN can erode your total portfolio. But when you are creating a portfolio, when we say that negative correlated or have very low positive correlation, you are saying maybe those 5 assets, one can come from banks, another one can come from manufacturing, another one can come from oil and gas, another one can come from fast-moving consumer goods, because it is not possible that one pronouncement from CBN will affect the all 5 stocks in the same way. So that is why we encourage and we preach that investments should be done in the portfolio view, such that all the assets together will come together and now form your portfolio. So what are the steps in the portfolio management process? We have 3 steps in portfolio management. We have the planning, we have the execution, and we have the feedback. Now, over the planning, it's where you decide, you sit down with your client to understand the reason why he or she wants to invest. Just like when we go to the hospital and we go see our doctor and we tell them all that is wrong with us, our symptoms and all. So also you as a portfolio manager to your client, like a financial doctor, in which your client should be able to tell you everything, why they're investing, how much they have, their risk, tolerance level, you know, everything you need to know, their total net worth and all. After all that discussion you have with them under the planning stage, you are going to develop what we call the IPS, the investment policy statement. This is basically a documentation of the discussion that you've had with your client. So you document it down in plain, simple English so that anyone can pick it and understand what you are trying to do with your client. After you have done the IPS, then you go to the execution stage. Now your client's risk tolerance level and the return objective will let you know the kind of assets you can invest for your clients. So that's what we talk about the suitability of our investment. I'm sure you've had ethics earlier on, and I'm sure that we talked about stability. You have to develop your portfolio in such a way that is suitable for your clients. When we talk about suitability, we're talking about you developing a portfolio in order to be able to achieve the return and the risk objective of your clients. So you cannot say because you have two clients that are 30 years old or two clients that are 50 years old, you are going to invest their portfolio in the same way. No, because their needs and their risk tolerance might be different. So from the planning stage, you know whether it's risk adverse, whether it's a risk seeker or it's risk neutral. A risk adverse person is someone that doesn't like risk at all. What a risk seeker is someone that if you have two options in assets, it will go for the one that has the highest risk. What a risk neutral person is the one that is not bothered about the risk, so is indifferent about the investment options that he has. Basically, what he's looking at is the one that will give you the highest return. So while you're doing that, so you know whether the person will have stocks, person will have bonds, or person will have alternative investments in his or her portfolio. So while in the planning stage, you decide what percentage each of these would carry. In portfolio, will say the weights they're going to carry. Whatever asset you're having, all of them will always be equal to 100% at the end of the day. So let's assume that we are the client and you decided that stock and bonds is good for me, and you have decided that it's only 60% I can hold in stock and 40% in bond to be able to achieve my return objective and also my risk tolerance level. So in the execution stage, you now go into the stock capital market, the stock market, and pick, okay, which are the stocks that are good for me. Then you go into the market, go into so you can decide to say, oh, okay, she'll have, you know, an oil and gas stock, she could have a manufacturing stock, she could have a bank stock. So you go into those sectors on the capital markets and do your analysis to pick out the best stock that is there for me. So also you do the same thing in the bonds. So after you have picked it, you construct my portfolio to be able to have the 60-40 that you have decided during the planning stage. That's what you do basically under the execution stage. While in the feedback, what you do now is to monitor my portfolio to see whether you'll be able to achieve my return and risk objective. Now, if for any reason you're not able to achieve it, you go back to the drawing board to find out what the problem is, and then you try to tweak the weights of my assets. And also, even if you're able to surpass what my return objective, you still need to find out what exactly happened so that you'll be able to better control my portfolio in the future. Then we have two major types of investors. We have institutional investors and we have individual investors. So basically, we're going to ask how and what determines what these people invest in. We're going to look at them under 4 different subtopics. We'll look at their risk tolerance level, look at their horizon, their investment horizon. We look at their liquidity needs, look at their income needs. Now, under the individuals, we cannot categorize people based on this because individuals are different. Even twins from their mother's womb are different. So all this for individuals are going to vary by individuals. But we're going to focus on the institutional investors because we have been able to classify some kind of institutions into kind of what they need, their risk and their return objective. So under institutionals, you have the banks, you have the endowment funds, you have the insurance, you have the mutual funds, and you have the defined benefits. So we look at the 5 different ones, vis-a-vis the risk tolerance, the horizon, and the liquidity needs. Sorry, I don't know what happened. Okay, vis-a-vis the liquidity needs. Can you still see my slide? Hello?
Yes, we can see your slide.
Okay, thank you. So for the banks, we say that their risk tolerance level is very low because we all know that banks, the money that they have are not theirs, they're for other people. So they have to be very careful about what they do with the money. So they have a very low risk tolerance level, that their investment horizon is also very short because most banks are demand deposit banks, which means you can pay your money in the morning and go back in the afternoon to go receive your money back. So their investment horizon is very short, and they usually have high liquidity needs so that they can meet their clients' withdrawal instructions. And then for income, all the income they need basically is able to pay interest on the funds they've collected and also be able to pay for their overhead costs and make, income, no matter how small it is. For the endowments, you say endowments are usually held by schools, and foundations. So we say that the risk tolerance level is very high because they've been there for years. Endowment, they said, doesn't have a lifespan. It's, it cuts across. Sometimes some of them are over 100 years, whether over 200 years. So they have a high risk tolerance level. That investment horizon is very long. The liquidity needs is also very low. And then that income basically is dependent on their spending needs. Some would say all we want to do is, let's look at the CFA Nigeria Women in Management Endowment Funds. We say, okay, we want to sponsor 3 or 4 women every year to write the CFA exam. That is all we need the money for. That's all the income that we need. So we don't erode into the capital. So we look at how much that's going to cost us, and they'll say, okay, that's a percentage of what our funds are, maybe 10% or 20% on an annual basis. Then for insurance, for insurance, we have the life insurance and the property and casualty insurance people. So there are 2 different companies in one. So their risk tolerance generally is low because also, they deal with premiums. But when we talk about the investment horizon, for the life insurance is long, and then for the property and casualty is low because it can come for claims at any time. Liquidity needs is also very high because they need to be able to pay claims as I went due, and their income needs is usually very, very low. So they're also, so all this will now let you know the kind of assets that you can, invest in. So for a bank that has low risk tolerance, high liquidity needs, and short investment horizon, you already know that most of their investments just have to be in what? Near cash instruments. So they can't go start buying houses or start buying commodities. That will negate the purpose, because you cannot exit commodity and houses at a short notice, and they need to pay their clients as I went to. They also have the defined benefits contribution. So let's actually just talk about defined benefits pension and defined contribution pension. Now, defined contribution pension is usually classified under the individuals because the risk and the return of such belongs to you, the employee, because what you are assured of under defined contribution is how much you pay into the pool and how much your employer's contribution is going to be. What your portfolio will be at the end of your service year is not determined. It's dependent on what assets you've invested in and how the market operated, which is what we operate in Nigeria right now. But before now, we had defined benefits, which means I don't know, I'm not involved in how much is invested. I don't know how much my employer is invested. But what I know is that by the time I was being employed, my employer told me if I spend 20 years in their employment, they will give me XYZ amount as my retirement benefit. So that is why that is classified under institutional, because the risk and the return objective lies solely with the employer. Then we'll go on to talk about different kind of pooled investment. Sorry, we are fast because we really don't have so much time. Talking about pooled investments, we'll talk about mutual funds, exchange traded funds, separately managed funds, hedge funds, buyout, and venture capital. I'll just pick out the major characteristics of each of these pooled investments. Under mutual fund is just a pool of investments from the general public. So you can have 1,000, 2,000, 3,000 pooled together to make billions of naira, and then it's invested as a portfolio. So everyone that subscribes into that mutual fund have a portion of that portfolio as their own investment. So a mutual fund can be invested in diverse assets. It could be money markets, it could be bonds, it could be stocks, it can even be hybrid. Okay, but basically what you need to know that there are two major kinds of mutual funds. We have the open-ended mutual funds and the closed-ended mutual funds. Under the open-ended mutual funds, you are dealing directly with the promoter of the mutual fund, the manager. So the amount of shares that are outstanding at the end of every day moves as people are buying and people are selling. That is why it's open-ended and will always trade close to its NAV. Now, for the closed-ended mutual funds, there's a particular number of shares that want to be issued, which is issued. And the trading now occurs on the secondary markets, which means that the number of shares outstanding in a closed mutual fund is static, but people are buying and selling, but it doesn't change at the end of the day. That can trade at any amount because the amount that is traded on is dependent on the secondary market. So usually it doesn't trade close to its NAV. NAV means net asset value. So go to the exchange traded funds. It's similar to the mutual funds, but this has a lower fee on management, but trading on the ETF actually attracts brokerage fees. Separately managed funds are funds that are held by the extremely rich people, because there's some people that their assets is like 100 billion naira, so it cannot be matched with other people. So that asset, that portfolio is basically, you know, managed solely for them. So they have, you know, personal advice from their managers and all. So for hedge funds are available to accredited investors and are exempt from reporting. Mutual funds have to be reported to the Securities and Exchange Commission because of the population of investors that are there is open to general public, while hedge funds are only open to accredited investors. And usually the fees on this are very high, and the typical fee on the hedge fund, you hear a 20 and 2. 20% based on based on performance, and 2% is the fee on assets under management. Then we have the buyout and the venture capital. They are similar, but at the same time different. A buyout will take a previously publicly traded company back into a privately held company. And usually this is done by issuance of debt. So when the company goes back to being private, the company is structured to ensure that it generates healthy cash flows, and they might decide to now go back again to the public. An example of that is what happened to Access Bank. Then for venture capital, it's similar to buyouts, but the difference is that when buyouts are talking about already established companies, venture capitals are talking about startups. So venture capital invests in startups, while buyouts invest in already established companies. That's basically what this topic is all about. So just look about 2 or 3 questions that will go on to portfolio risk and return, part 1 and 2. So quickly, please, in the chat, drop what you think the answer should be, and then we can move on because we already spent 20 minutes out of our 1 hour. All right, it said, an investor adopting the portfolio approach to investment approach to investing to reduce risk will most likely have to accept A, B, or C. Yes, thank you. Majority carries a vote. Yes, it's going to have to accept more diversification. That's actually the purpose of portfolio approach. It doesn't necessarily mean somebody picks lower return. Because you have a portfolio does not mean that you have a lower return to a standalone investment. What it means is that you might be able to achieve the same return with a standalone investment with a reduced risk. So you do not have to accept, you don't have to accept lower return, but what you have to accept is more diversification. Thank you all. Question 2. In using the portfolio approach to investing, the investor will least likely eliminate A, B, C. Now, the word least likely means what you would not be able to eliminate. So I'm waiting for more. I'm seeing conflicting answers. What you will not be able to eliminate in your portfolio is the risk of loss. Because no matter how much, no matter how good your diversification is, you can still experience a loss in your portfolio. But definitely, because you have a portfolio, you will not have concentration in one security, and you will definitely have the opportunity to achieve excess return on the market, but you cannot 100% guarantee that you will not lose your portfolio. So the answer is A. Number 3, that we'll go on to the next topic. Which of the following institutional investors is most likely to have a low risk tolerance for investment risk and relatively high liquidity needs? Yes, from my explanation, you will see that an insurance company have high liquidity needs and low risk tolerance. So the answer is A. So let's quickly move on to, I say almost more questions, but let's just quickly move on to the next topic so that it can cover some ground. Now, under this, the LOS stage will be able to calculate and interpret major returns, compare the money-weighted and time-weighted rates of return, talk about the major asset classes when you're forming a portfolio, calculate and interpret the mean variance and covariance of assets, calculate and interpret portfolio standard deviation, describe and interpret the minimum variance. And so I'm going to try and just quickly run through this before our time is up. So we already know the kind of different kind of holding there's a way that we actually calculate return. We have the arithmetic return, we have the geometric, we have the money weighted, and we have the time weighted. Arithmetic, that we all know, is just the average of the returns over the period. Now, they'll say that if you want to be able to decide between two managers, use the geometric return, because that geometric return is the one that actually puts into consideration the compounding effects of your return. And if you are trying to find out what return an investor has been able to achieve for himself or herself, then you what we call the money weighted return. It's also otherwise known as the internal rate of return. So for investment managers, we use the time weighted return, and for the investors' return, we talk about the money market return. I already talked about the different kind of investors that we have as regards risk, talking about the risk seeker, the risk neutral, and the risk adverse humans. But generally, we believe that human beings are risk adverse, which means you feel the pain of the loss more than you feel the gain in your portfolio of equal proportion. Now, under this, for your level, is assumed that we have a portfolio that have two assets, bonds and stock. I will tell that the return of your portfolio, is equal to, the return of your portfolio is equal to the weight of your asset. Let's say you have A and B of assets, weight of the asset A, return of the asset A, plus the weight of asset B, return of asset B. When we say the two weights must always be equal to what? 100%. While the standard deviation of a portfolio will be equal to the weight squared of A times the variance of A, plus the weight squared of B times the variance of B, plus 2 weight of A, weight of B, correlation between A and B, standard deviation of A, standard deviation of B. Now, there are some pitfalls I just need you to actually note when you're doing this. Some questions will always sometimes give you the variance of the portfolio. Don't go ahead because you're in a haste and you're trying to make up time. Go back to square the variance that the question has given you already. If you do that, you find your answer waiting for you, but you'll still be wrong. And then you don't need to first go and find the squares of the variance that you are given and then come back and score it in your calculation. Just pick, this is variance. Just pick the variance you are giving and then you move on. Now, some question will also give you the correlation, and some question will give you what we call the covariance. Now, the correlation of both assets multiplied by the standard deviation of each asset is known as the covariance. So in other words, this whole part of the equation is the covariance that they're giving to you. So don't go again by multiplying it with the standard deviation of the assets, because that will be wrong, but you find your answer in the mistake. So those are the common pitfalls that people do when they try to calculate the standard deviation of a portfolio. And also note that the variance of a portfolio is just the standard deviation without the square root. And you can see that when we talk about looking for assets that have a negative correlation, that means this part of the old equation will become negative, which will in turn reduce the standard deviation of the portfolio as against holding a single asset. Before we leave this topic, there's something else I need to just point out, talking about when you are told to find an analyzed return on an holding period. Now, they can give you an holding period that is less than 1 year, or it can give you an holding period that is over 1 year. And they're asking you to analyze the return, which means how much return would you have gotten in 1 year. So all you need to do is to get the return 1 plus R of the holding, this is the holding period return, raised to power 1 over Y minus 1. Now, this Y in question is a generic way of the formula, but I'll just explain further. When you're using 1 over Y, you're using 1 over Y when you have return that are above 1 year. So that means your annualized return will be a fraction of what you're looking for. When you're looking for returns, when your holding period is in weeks, we use 52 weeks in a year, so you have 52 divided by Y minus 1. If it's a month, you'll be 12 over Y minus 1. And if it's in days, you have 365 over Y minus 1. So please, let's take notes of that. Is there another thing I have not touched in this? Then we'll talk about, okay, here they introduce the capital allocation line, but when we go to the second reading, we'll talk about the capital allocation line, the capital market line, and security market line. Tell us how we achieve it and the basic difference between the 3 lines. I think we should be able to do that before our time is up. So let's just look at 2 or 3 questions, then we'll move on to the second reading. So this says that as investors become less risk averse, what happens to the market price of risk? Thank you, Luatobi and Kabir. Yes, the answer is C. Because remember, because you are risk adverse, you are afraid of loss. What will induce you to invest in an asset? You will ask for a premium, which increases. I remember we talked about, not me anyway, the price of an asset is discounting the cash flow divided by the return. So because they are becoming less risk adverse, it means that the premium you'll be asking to invest in assets will be lower, which means your R will decrease. And because you are discounting, the stock value would rise. So the answer is C. Number 7. The demand for increasing yields on bonds as credit risk increases is evidence of what? The demand for increasing yields on bonds as credit risk increases is an evidence of an investor's what? I just explained this question when I was trying to explain the other question. Thank you, Toyin. The answer is C, because it's risk adverse. As credit risk increases, you'll be asking for a higher return. So the answer, this is a typical behavior of a risk adverse investor. Okay, I'm not speaking about the Macroeconomics theory, but let's just try this question. So maybe I've just used this opportunity to talk about the CAL line. According to Macroeconomics portfolio theory, each investment will have a single expected return. Risk is measured by the volatility of expected returns. Investors experience increasing marginal utility of wealth. Thank you. Risk is measured by volatility, otherwise known as what? Standard deviation. So let's talk about the Macroeconomics theory and then the CAL line. Now, the Macroeconomics efficient frontier is a line that runs from the right of the global variance portfolio to the right. So this is your minimum variance portfolio. Sorry, let me try to erase that. I'm not a good artist, but I'll just try my best. So the line of investment goes something like this. Now this part, let's say there's an asset here, A. This is the asset that has the lowest variance, or let's say the lowest standard deviation. So the efficient frontier, according to Macroeconomics, starts from the minimum frontier to the right. So on this line would lie all assets that have the maximum risk for a given, sorry, the maximum return for a given level of risk, or the lowest risk for a given level of return. I think it's again. On the efficient frontier will lie all assets that have a maximum return for a given level of risk, or a low risk for a given level of return. That is the reason why any asset here is not lying on the efficient frontier, that even though its risk is Y, is return is O, you can see that there's another asset X, that have the same risk with B, but has a higher return. So B would never be on the efficient frontier. So your efficient frontier starts from the global minimum variance portfolio to the right. Now, for you to understand how to draw up your client's assets, like I said, this level will talk about 2 asset portfolios, and we believe that you have 1 risky asset and 1 risk-free asset. And the risk-free assets will probably be, let's say, the treasury bills. Now, for you to know what risky assets will be good for your clients, we introduce what we call the CAL line. The CAL line is a line that starts from the risk-free rates and lies tangent to the efficient frontier. Your optimal risky asset is the portfolio or the assets that lies at the point where the CAL line lies tangent to the efficient frontier. Now, using the CAL line is unique to individuals because it's gotten from your indifference curve. Your indifference curve is a curve of your utility of risk and return for each individual. And your indifference curve usually are upward sloping. The more risk adverse you are, the steeper your curve will be. And then you would now introduce a line that comes from the risk-free rate that lies tangent. So it's that line that is called the CAL line. Now, because we already know in statistics that every straight line we have their returns equals to A plus BX, while A is called the intercept and while B is called the slope. Now for the CAL line, because it starts from the risk-free rate, which is the risk-free rate, which is the lowest that your portfolio will ever get if everything goes south. So the intercept of your CAL line is the risk-free rate, while your slope is what we call the Sharpe ratio. So the Sharpe ratio is the slope of the CAL line, while the risk-free rate is the intercept of the CAL line. Remember, the CAL line is unique to individuals. So which means that the optimal risky assets for me will be different from your own optimal risky assets because our individual indifference curve must be brought into play. Now, there's another sister of the CAL line that's called the CML line. The only difference between the CAL and the CML is this. The CAL is unique to everyone, but the CML is the same for everyone. And the CML is the same for everyone because it is assumed that we all have an homogeneous expectation of the market, which means we are all thinking alike. So because we are all thinking alike, we'll all go into the market and pick the same risky assets. So the optimal risky assets for people under the CML line is now the market portfolio. So what will differ between me and someone else is the percentage we would hold in the market portfolio and the percentage we will hold in the risk-free assets. The intercepts and the slope of the CML line is the same thing as the intercepts and the slope of the CAL line. But the difference, like I said, between the two of them is that one is unique, which is CAL line, and the second one is the same for everyone. Now there's another third line that's called the SML line. The SML line is just a graphical representation of our CAPM formula, which says the return of an asset is equal to the risk-free return plus beta into RM minus RF. This is the SML is the pictorial representation of the CAPM formula. So from here also, you can see that the intercept of the SML line is the risk-free rate, while The slope is what? Your market risk premium. Now, note something. Because beta, price assets, is what is used. Because the CAPM believes that they are holding what? A diversified portfolio. So the SML line is only applicable to fully diversified portfolios. But under the CAL and the CML graph, they are using total risk, which is standard deviation. So when you have your SML line, also like the straight line from the risk-free rate that goes up, any asset that lies on the SML line is said to be a rightly priced asset. Any asset that lies above the line are said to be undervalued, while any asset that lies below the line are said to be overvalued. So naturally in investments, we say sell the overvalued assets and buy the undervalued assets. So that's basically the difference between the CAL and the CML on one side, and the SML on the other hand. The CAL is unique to individuals, I'll take it again, while the CML is the same for everyone. The intercept for the two of them is your risk-free rate, while the slope is your what? Your Sharpe ratio. And it uses total risk, standard deviation, as the form of risk. So it is not a good measure of a fully diversified portfolio. While the SML line is just a graphical presentation of the CAPM formula that uses beta as a measure of risk. Remember, you are only compensated for price to risk, beta. We are not compensated for diversifiable risk. So from there, go ahead to some questions. We have about 15 more minutes. Let's get 2 questions. Then we'll just talk about the behavioral biases that have been introduced into your curriculum from level 3, and then we'll move on. And let's do one calculation. So you will not say you came to portfolio class and you did not solve any question. So let's do this question and then we'll move on. Let's solve this question and then we'll move on to just briefly talking about the behavioral biases, cognitive and emotional, and then we'll call it a day. So quickly. Anybody? Or you want us to solve it together because of want of time? Okay, let's look at it together. They said, following the decision to divest its non-core assets, analysts expect HCL standard deviation to rise to 30% and its correlation with the market portfolio to remain unchanged at 0.8. The risk-free rates and the market risk premium are expected to remain unchanged at 6% and 8% respectively. However, it's expected the market portfolio standard deviation is expected to decrease to 15%. So what is the return after restructure? Remember, we already said that the return using the CFA formula, since they are fully diversified, the return of the portfolio is RF plus beta into RM minus RF. Now the question gave us our RF to be 6%. They've given us our market risk to be 8%. But what we don't have is our beta. And the formula for getting beta, they said, is equal to the covariance of the assets with the market divided by the variance of the market, or the correlation of the assets and the market divided by standard deviation of the market. We already have the correlation to be given to us at 0.8. We have the standard deviation of the market to be 0.15 divided by 0.3. That will give us your beta, and then you solve to get your answer. So we have about 12 more minutes. So let's just quickly just run to personal behavioral biases that was added to your curriculum. Like I said, the slides are available. I'm going to send it to the society. Okay, sorry. So let's go back to, let's talk about behavioral biases. Now, what I'm just going to focus on here is just to be able to know the difference between the cognitive errors and the emotional biases. Now, sometimes the two of them can be included in one bias. But what you should know, first off, is that cognitive is the one that you can remove, because it's probably due to what? A faulty reasoning, or maybe an action that is based on incomplete information. So it can be reduced by proper training, or you increase your investors' awareness. But emotional has a feeling, it's from impulses, so you cannot remove that. So don't waste your time to try to educate people when you have emotional biases. All you just do is, you have to accommodate the emotional bias, but try to reduce or remove the cognitive. So I'm just going to just run through them, and then we'll call it a day, because that's just like 10 more minutes. The first one, talk about conservatism bias. That one is that means that you have formed an initial view. You have checked and you formed an initial view. But now you now have new information. You are failing to change your initial view with the new information that has become available to you. So you are still holding on to your old forecast. You don't want anything that would, upset you or stress you. Under confirmation bias, what that means is that you have taken a decision, but what you're now doing is now going to look for information to confirm what you have taken. For instance, if you buy an Honda car today, you are going around reading articles on Hondas talking about how Hondas are good, ignoring any article that says that Hondas are bad, just to confirm to yourself that you have taken a very good decision. Representative bias is when you use some certain characteristics to put an investment in a particular category, and then you assume that every asset in that category will behave in the same way. Or sometimes you take a small sample of a particular class of assets and use that characteristic to generalize on the other classes of assets. Under the control bias, you have an illusion of control. You believe that you have control over the outcome, which you do not, but you believe that you have control. For instance, it comes up when you are investing in a stock in a company that you are working with. You believe that you can foresee what's going on in future. This is associated with another emotional bias that is called illusion of knowledge, self-attribution, or overconfidence. So talking about hindsight means that you are saying now that I already knew from the past that this was what's going to happen to me, but I just didn't take it. I knew it all along that it was going to happen. So that is what happens under the hindsight bias. Then under anchoring and adjustment, what you are doing is you are basing your expectation with something that have happened in the past. You are overweighing a past information more than is important. So you have to now, making adjustments to that of the new information that received becomes very, very slow. Mental accounting means that you put your investment in different pockets. Vis-a-vis how you make the money. So your savings from your salary is put in one bucket. Your insurance is put in one bucket. What you get from inheritance put in one bucket. You are now isolating them investing. You're not looking at them in totality. That's what we call mental accounting. Framing bias. Your decisions are affected by the way in which the question or the data is framed. Sometimes when we ask a loss question in a gain manner, the answers are usually different. So you frame a decision based on how the question is asked. Elasticity bias means that you believe that if you can recall an information, that means that it is very, very important. You now put undue importance on that. For instance, maybe you have been watching adverts on the TV and advertising a particular product. You now need something that product does. The first that comes to your mind is that advert and that product. So you feel that, oh, that's good. So any information that comes to you readily is, you think is better. Not knowing that it's just because it has been in your subconscious for a very long time. So from that's all about the emotional cognitive. So just quickly go on to emotional biases. Then under the first one, we have the loss aversion bias, which means you, like I said, when you talk about risk adverse, you feel more pain when you are losing than joy that you derive when you are gaining the same amount of money. Overconfidence, that means you are overestimating your ability. You believe that you can do much more than you can do. Self-control, you lack discipline. And then you are more interested in having short-term satisfaction over achieving your long-term goals. Status quo means that you are okay with the way things are, and you believe that things will continue to go like that in future, so you are not ready to tamper with it. Endowment bias. It feels more special because you've already bought an asset. So what you own feels more special than what you have not bought. So you feel that because you have it, that means it's more valuable. And then regret aversion is that you don't do anything out of fear that something can go wrong. So in this case, you now have what we call the urgent behavior. You want every other person to have done something before you do that thing. So basically, you need to know under this, because there is a new reading that was brought in from level 3 to level 1. You need to know what these biases are and be able to say categorically which one is emotional and which ones are cognitive. I remember, like I said when I started, cognitive are based on rational decisions, but just because the information is incorrect or is based on that you cannot understand statistical analysis, you have illogical reasonings, or you have information processing error. Those ones, it can be reduced by proper training and increased awareness for the investor. But for emotional biases, they are just feelings that what you have. You cannot, reduce that. So you might have to accept that as an investment manager. We have 4 more minutes. Let's see, maybe we can just do 1 or 2 questions before Busayo tells me to go. So let's just look at 2 questions that we'll call it today. So which of the following would most likely be classified as an emotional bias? Thank you. And what example of bias is that? The answer is C. So what example of bias is that? That is what? An endowment bias. Okay. The next one. Which of the following would likely indicate that an investor is subject to an emotional bias? Let's have the answer. Emotional. Thank you. You react spontaneously to a negative earnings announcement by quickly selling a stock. That falls under the loss aversion bias. So the answer is B. And the last question, let's see, 328. The last questions I can give time for the next presenter to come up. 20 years ago, Jane set her initial asset allocation in a defined contribution plan by placing an equal amount. Then over time, she increased everyone by 1% and she reached the maximum. Which of the following biases does Ivy most likely exhibit? Thank you, Oluwatobi. Status quo. She doesn't want to change anything. She believes that things will continue to happen in the future. And the last one. Abilene has investments scattered across many different accounts, from bank savings to before and after tax to taxable non-retirement. And she has multiple investment goals. And she looks at her financial assets and views each holding as designed to meet specific goals. What is Lane most likely exhibiting? And then we'll call it a date here. Thank you. What she is exhibiting is mental accounting. She's compartmentalizing each investment for each goal. So she's not looking at her investment in a portfolio view, like we said. So thank you very much, everyone. I wish you success in your exams. My time is up. I wish you all the best. See you on the next level. Thank you and have a wonderful day. Thank you, Busayo.
Thank you so much, Nicola, for your time. The next topic now is going to be derivatives, which will be taken by Fola. Fola, you can go ahead.
Yes, good evening, everyone. Just a few seconds so I can share my screen. Please, can anyone confirm that you can see my screen and you can hear me?
Yes, we can see your screen and we can hear you.
Perfect. Just a second. Right, so this is going to be more of a high-level presentation because for the sake of time. So I'll just run through the important points in derivatives and would take some questions if time permits. But I'm sure you've heard from everyone else. Just the main important thing is to practice as much questions as you can. So let me start with the introduction to derivatives. So the first thing is I would focus on this slide, which kind of summarizes the whole, or gives an overview of the whole derivatives market. And derivatives are classified into forward commitments and contingent claims. And the major difference between them is those that are classified as forward commitments are obligations, meaning that the buyer and the seller have an obligation to do something. So for instance, a forward contract gives you is a contract to buy an asset or to sell an asset. So at the end of the contract, both the buyer and the seller have to engage in this transaction at a fixed or a predetermined price. And it's the same thing with futures and swaps. But then for a contingent claim, and that is why it's called a contingent claim, is a right. You pay for that right. So for options, for instance, you buy an option. For credit derivatives as well, you buy credit derivatives. So let's dive into forward commitments. The major types of forward commitments are forward contracts, and don't be confused by the name. Just remember that forward contracts are a part of forward commitments, and futures contracts as well, and swaps. So forward contracts are over the counter, are traded over the counter. So when I say over the counter, I mean they are not traded on an exchange, they are traded outside of an exchange. So two parties can come together and write a contract, and the contract is binding, meaning that at the end of a specified period, they have to buy or sell an asset. It's an obligation from the two of them, like I mentioned. The prices are predetermined, the transaction is done at maturity. Futures contracts, exchange traded. So you have the Chicago Board of Exchange, which is like the largest futures exchange in the world. And what they do is they eliminate the risk, or they bring down the risk of default significantly. So that's the advantage of trading contracts on an exchange over forwards or over OTCs. Now, what this means is that you have to abide by the terms of the exchange. The terms are standardized. So a futures contract of maize, for instance, can consist of 50,000 units, and that's a standard. Whereas if you want to, if you do it outside of an exchange, you define your terms. Like I said, it's zero default risk, but it's also an obligation because it's a forward commitment. The next one is a swap. A swap is simply the exchange of a series of cash flows. So the most common example is a fixed for floating swap. So you are in a jurisdiction where you can only borrow money and the rate you have to use has to be a floating rate. What does this mean? It means that your exposure is a function of how rates move. So if interest rates move up significantly, it means that the interest rate you would pay for that period will be high. So to minimize this risk, what you would then do is to enter into a swap, meaning that you would exchange the cash flows, especially if you expect interest rates to either go up or go down. You can use a swap to minimize that risk. The next set of derivatives are contingent claims. You have the options. I'm sure a lot of you have heard of them. Is the right to the buyer and is an obligation to the seller. Why is it a right to the buyer? Because they are paying for it, and there's an upfront payment required, like I said, which is called a premium, and it can either be a call or a put. And remember this point, it's not always exercised. Why is it not always exercised? Because the market may not move in the direction that you desire. So you might not have to exercise it, but you would have parted with some money at the beginning of the contract, but that money will be small compared to the size of the transaction. And in reality, more than 80% of contracts in option markets are not exercised. And one point, options are either exchange traded or OTC. Remember that point. The last one is credit derivatives. And the most common type of credit derivative is a credit default swap. And what this means is that you have a corporate bond, for instance, and you fear that the company that issued the corporate bond would default. What do? You go and meet a CDS, a credit default swap seller, like an investment bank, and then you pay a premium or you pay some money to this investment bank, and the investment bank will guarantee you that if this company or if this issuer that issued the bonds default, then we will stand in and will compensate you. So that's just what it is, like insurance. But the difference between credit default swaps and insurance is that credit default swaps, for insurance, you have to have insurable interest, but for credit default swaps, you don't have to have insurable interest. So for the bond in particular, for the bond in question, you don't have to own the bonds. You can go and meet an investment bank and just tell them to issue a CDS on a company, and if the company defaults, they would reimburse you a certain predetermined amount. Right. The next point is, we all know that there are two types of options. There are American style and European style. The major difference between these two options is that an American option can be exercised at any time, whereas an European style option can only be exercised at maturity. So let me ask the first question to you guys. Which one do you think is going to be more expensive, an American or a European? Quickly, please. American, thank you. It will be more expensive because you can exercise at any time. Meaning tomorrow, if I buy Apple, if I buy a call on Apple, and remember a call is an option to buy, and tomorrow, if I buy the call for if I buy the call and the exercise price is $1,000, and tomorrow the price of Apple shoots up to $2,000, I can exercise that call immediately and make my money. However, if it's a European call, that price movement will not matter up until maturity. So the price can move in any direction, but if it can go to 1,500, it can go to 2,000, can go to 10,000. But if before maturity, or by maturity, the price comes down to 1,000, that means that is the price you are going to use to determine whether your option is in the money, out of the money, or at the money. Now and I'm not going to dwell on the values of a call or a put. If you want this slide, you can request for it later. I'll send it over. But yeah, so I'm not going to dwell on so many points. But just remember that the value of a call is the maximum of 0 and ST minus X. ST is the price of the underlying and X is the strike price. And the value of the put is the other way around, is the maximum of 0 and X minus ST, where X is the strike price and ST is the price of the underlying at time T. So purposes of derivatives: risk allocation, transfer, management. This is self-explanatory, meaning that you want to transfer risk. You have an asset, but then you fear that there's a risk of holding the asset. You want to transfer the asset. You want to transfer the risk of the asset. You want to manage the risk of the asset. Derivatives serves that purpose. Information discovery. So, for instance, a lot of people use the future price of oil to determine what the market bias is for the spot price of oil today. So they look at the futures price to determine a direction to take. They look at it as an indication of where oil prices is going. So that information discovery is important. Operational advantages. The most important advantage from this point of view is that your transaction cost is minimized. So the cost of engaging in a derivative is typically low compared to if you are in the spot market. If I want to buy, for instance, shares of Nestle, I would have to bring out the whole amount that I need for capital. Whereas all I can do is just buy an option where I'll just pay a small premium, which is a fraction of that capital I would have used to buy the shares. And that means that my cost has been brought down. Market efficiency as well. Criticisms of derivatives market: they can be too risky. they involve high leverage. So when I say high leverage, meaning that you use a little to gain more. Meaning that, so for instance, if I wanted to buy, if I enter a forward contract, I'm paying 0, but then the size of the transaction can be so huge. So that means that you're taking a very high leverage, and sometimes some people liken them to gambling, especially if you don't know what you are doing. And it's been seen, especially in options, where a lot of people, they start to sell options and they don't think about the risk of selling the options. Now you can be a buyer and you can be a seller of the option. So imagine if you sell an option and, for instance, the market becomes very volatile and then you have to deliver on that option. The amount that you'd have to deliver compared to the premium that you would have earned would be so significant. So that risk is something that everyone needs to take into consideration before entering into a derivatives contract. Right. I will try and round up before 4 o'clock so that we can have time for questions. Now, the next point you need to know is arbitrage. I'm sure you've heard of arbitrage in the other readings. You've read about it. It's explained in details in other subjects. But in this for the purpose of derivatives, we would call arbitrage, we would refer to it as the law of one price. What this means is that there are different formulas in coming up with the forward price, not the futures, but the forward price, for instance, or the value of an option. There's an equation for all those things. Now, if those equations don't balance, then arbitrage opportunities exist. So what do we say? The equations in derivatives, or most equations that you are coming across in derivatives or even other subjects, is a no arbitrage equation, meaning that if the equations don't balance, if your forward price is not equal to that formula, then an arbitrage opportunity exists. And what is arbitrage? Arbitrage is simply riskless profit. So there are two exchanges. The two exchanges, they both hold Microsoft shares. In one exchange, you have Microsoft selling at $5. In the other exchange, you have Microsoft selling at $10. What do? You buy Microsoft from the first exchange and you sell at the other exchange. So that is one of the simple examples of arbitrage, but there are other ways that arbitrage can be used. Now we are moving on to reading 49. I'll quickly run through it. Now, in derivatives, we always assume risk neutrality. Remember, in equities, when you are trying to value a stock, the discount rate you used includes a risk premium. But in derivatives, we use the risk-free rate. Remember that we use the risk-free rate in coming up with our equations. Why is that? Because in derivatives, we assume risk neutrality. Why do we assume risk neutrality? Because we assume that our risk has been eliminated by engaging in a derivative. If I have a stock, for instance, and I am afraid that the value of the stock will come down, what do? I can enter into a forward contract to sell the stock at a particular price, meaning I have locked in a price, and if the price comes down, then I have eliminated the risk of losing. But then I have also eliminated the opportunity of gaining if the price goes up. But that is not a risk. You are not losing money in that sense if the price goes up. You are just losing that opportunity of making more money. But if you lock in a price, you are eliminating a risk. So let's look at this equation. An asset position at time 0 plus a short position in a forward contract equals to a risk-free return. Meaning, what do? I have an asset, I have shares. I then enter into a forward contract to sell those shares at a particular time. The combination is supposed to give me a risk-free return. Why? Because I have eliminated the risk. So, in other words, a long asset and a short derivative on the asset can be combined to produce a position equivalent to a risk-free bond. Now, what does this mean? This is also called replication. What I have done here, where I have bought an asset and I have gone short a forward contract on the asset, I have replicated a risk-free return. So rather than going into the market to buy bonds that will give me a risk-free return, I can do this combination and get the risk-free return, and that's called replication. So you might get a question in the exam that comes and says, under the replication approach, a long asset and a short derivative, the combination of a long asset and a short derivative is the same as what? You will have to then come up with the option. You will have to come up with the answer from the option. So now, using this first equation that is here, hold on, let me try and annotate. Oops. Okay, so using this first equation that is here, you can then rearrange the equation and get these other equations. So you can take the short derivative, move it to this side, take the long risk-free asset, move it to this side. When you take minus long risk-free asset, it becomes plus short. So minus long is short. Just remember that minus long is short, minus short is long. You move this here, you get short. You move to take your short derivative to the other side, it becomes minus short derivative. Minus short is long. So that's why you have long instead of short here. And then you can rearrange it to get this one as well. Right. We've talked about risk aversion, risk neutrality. We've talked about risk neutrality in particular. And I think in portfolio management, we've talked about risk aversion. Risk aversion means that you want more returns or potential returns for the risk that you are taking. However, we are saying that in derivatives, we assume risk neutrality. That's the important point to note there. What's the time? Right. So risk-seeking investors, risk-neutral, risk-averse investors. Okay, I'm just going to skip those ones. Now, we're going to look at the pricing and valuation of forwards. We all know that we've all read. I'm assuming we now understand the formula for a forward contract, which is the spot price of the underlying compounded by the risk-free. Remember, this R is a risk-free rate, and risk per time T. That's the formula. Now, in some situations, you will be given some costs. You'll be given either your dividend, you would incur some costs, either dividends or either insurance or storage costs. All those things need to be applied to the formula for your forwards to get the actual forward price. Now, for instance, you have dividends. A dividend or or interest or convenience yield. All those things are things that will come to the seller of the forward. Why does it come to the seller of the forward? Because for you as the seller of the forward, you are assumed to own the underlying assets. So for instance, if I own shares of a company and the shares are paying dividends, if I own shares of Coca-Cola and the shares of Coca-Cola pay dividends every quarter, and I enter a contract, a 1-year forward contract that allows me to sell in a year's time, between now and a year's time, what happens? The dividend comes into my pocket as the seller of the forward contract. Now, what do I have to do in this instance? I have to take out the anticipated dividends from the forward equation, the forward price equation. So I take out this, hold on. So I take out my dividend from the spot price to give me my forward. And in some cases as well, there are costs that come with owning the asset. So for instance, if I am a maize farmer and I enter into a contract to sell maize, I would have to incur storage costs between now and when the contract expires. Now I have to add that storage cost to the price because that cost is coming out of my pocket as the seller, and I have to I have to recoup that money back. Now, we've said that this is our benefits, this is our cost. Now, what we are saying is, if our benefits exist our cost, then the forward transaction would return less than the spot transaction. So if this benefit here is greater than our cost here, because you are taking this one out from the equation, then what happens? Your forward price comes down, and vice versa. So that's that. Oops, I mistakenly. Right. Before we, okay, so let me quickly talk through the pricing and valuation of futures contracts. For futures contracts, your contracts are marked to market on a daily basis. So both the buyer and the seller that enter into the contract are expected to bring two types of margins: the initial margin and the maintenance margin. Remember that the initial margin and the maintenance margin. The initial margin is the initial amount you would bring in into the exchange. What happens is the exchange opens two accounts, one for the buyer and one for the seller. So you're supposed to deposit some margins there. And then the maintenance margin is that point at which, if the margins falls below that maintenance margin, you will get a margin call, and you would have to pay some money back to bring your margin back to the initial margin level. And we'll look at a question to better understand this. Now, another point we need to remember is that if futures prices are positively correlated with interest rates, what happens? Futures contracts are more desirable to hold to holders of long positions than are forwards. Why is this? Because there's a positive correlation. Your futures prices are going up. At the same time, your interest rates are going up. Your money in the money in your margin account is not just sitting in your margin account. It is being invested at the least at risk-free rates. So what happens? As more money is coming into your account, what happens? That money that is in your account is, because as the futures prices are going up, your margin account is going up as well. So as that money is going up, you are also investing and you are earning more interest rates. So they said, so that's why the reason is because rising prices lead to future profits that are reinvested in periods of rising interest rates and falling prices. So your prices are falling, but then you are not losing out too much. Your margin account is declining. You're not losing out too much on falling interest rates because interest rates are becoming lower. So a negative correlation between futures prices and interest rates leads to the opposite interpretation. So people would prefer forwards than futures in this situation. So pricing and valuation of swaps. I'm not going to spend time on this because this is more of level 2. You spend more time on this in level 2. But the price of a forward commitment is such that there is no value to the contract at time 0. So any forward contract, the value of a forward commitment is 0 at time 0. So you look at forward contracts, you look at swaps, the values are always 0. The value can arise later as price changes, but when initiated, the contract has 0 value. Neither party pays anything to the other at the start. So we can have, like I said, we can have fixed for floating swaps, and what happens is that depending on how interest rates move, the cash flow varies. So what does this mean? It means that you are not just exchanging 2 cash flows at the same time. What happens is the difference between the cash flow. So one person is going to lose and one person is going to win, and the loser would have to pay some money to the winner. So if you have, let me quickly give an example. What's the time? So if you have if you have a fixed for floating swaps and your fixed rate is 5%, why does this keep erasing? How do I make it stop erasing? How does it keep vanishing? Sorry, vanishing pen. Sorry, 1 second. I'm just trying to figure this out. So if you have 5%, for instance, and that's the fixed rate, then you have a floating rate, which you don't know what it will be. So what happens in X months' time if you are the fixed rate receiver? So you are the fixed rate receiver. What does this mean? It means you are going to be receiving 5% through the term of the swap. And then you don't know the floating rate today, but in the next quarter, the floating rate, the interest rate, the floating rate, which is based on LIBOR, is 3%. What happens? So it's not like you pay 5%, you would receive 5% and pay 3%. What happens is the floating rate payer will pay you 5 minus 3. So the floating rate payer will pay you 2% of some notional value. So that's how it works. Right, let's move on. Okay, thanks, Big Ben. I'll try that. Okay. Now, some high-level information. Let's quickly look at the relationships in European option pricing. So let's look at this. We're looking at different variables for European calls and European puts. There is a direct relationship between the value of a European call and the value of the underlying. And I mean, if you want to even remember, all you need to do is just, where's my text? All you need to do is remember that formula for a call, for instance, max into 0 ST minus X. So what does this mean? It means that as your ST goes up, the value of your so ST is the value of the underlying. As your ST goes up, what happens? The value of your European call goes up. And then it's an inverse relationship for a put. So max 0 X minus ST. As the value of the underlying goes down, this goes up. So that's what you need to remember. The next one is your exercise price. The higher the exercise price, what happens? The lower the European call. And the higher the exercise price, the higher the European put. So all this can be remembered just by looking at that value, the equation for the value of a call or the value of a put. Right, time. Oh, jeez. Okay. Okay, so time, there is a direct relationship with the European call, and there is a direct or inverse relationship for the European put. And why is this? Because put option holders are waiting are awaiting the sale of the underlying for which they will receive the exercise price, the longer they would have to wait, the lower the present value of the payoff. So what does this mean? It means that for a European call, the relationship is direct, meaning that as the time is longer, it means that the value of your European call is better, is higher. Why? Because the chances of your call being in the money increases as time increases. And then that is also the same with a European put. There is a direct relationship, but there is also that side, that inverse side of it. Because what happens, because it's a European put and you own the underlying asset, and it gives the option to sell. At the end of the contract, if the option is in the money, you would sell the assets. That means that you have to wait for a longer period to make that money. So that's why the value then, that's why there is that inverse relationship as well. Now, for risk-free rates, there is a direct relationship with the value, meaning that as the risk-free rate increases, what happens? The value of the call increases. For a call or a put, the present value of the outlay of the calls or put exercise price is lower when the time is longer or when the risk-free rate is higher. So what does this mean? The present value of your exercise price is so let's look at a put, for instance. Now, your interest rates, we have rising interest rates. As interest rates are rising, what happens? For your put, because it's an option to sell, you can sell the underlying and you can sell the underlying and invest it in what's it called? You can invest it in the risk-free rate. But then for a call, your risk-free rate is a direct relationship, because as your interest rates are going up, what happens? The value of the call, or the value of the present value of the exercise price that you are paying is lower. So remember, a call is an option to buy. So that exercise price, if you take the present value of that exercise price, as the risk-free rate is going up, your exercise price, the present value of your exercise price is falling. But then for a put, as the risk-free rate is going up, your exercise price is falling as well, meaning that the amount that you would receive, is lower. So that's why there's that inverse relationship. But for risk-free, for call, the amount that you would pay is lower. So there's that direct relationship. So the value of your call goes up. Now, for volatility, there is a direct relationship for the two of them. And that's a no-brainer, because as there are strong swings in the prices, the value of the option goes up. Now, just a few points before we go into questions. Remember that there's something called the minimum value of an option. The minimum value of an option is the fact that the value of a call is greater than or equal to the maximum of 0 and S minus X divided by 1 plus R. What's the difference between this and the value of a call? The value of a call is not the same as the minimum value of a call. The minimum value of a call also includes the present value of the exercise price. And the same with a put, is similar with a put. Is for the value of a put, it is X minus S0. However, for this, you have to take the present value of the exercise price and take out the price of the underlying. And the curriculum explains how they got to it. But I just think if you can remember this, that the minimum value of an option takes into account the time value of money, and that's why they discount the exercise price. So the lowest value of an European put is the greater of 0, or the present value of the exercise price minus the value of the underlying. And the lowest value of an European call is the greater of 0, or the value of the underlying minus the present value of the exercise. Okay, let's quickly look at put call parity. What's the time? put call parity. So put call parity is simply you have a protective put, which is the combination of a long put and a long stock. You have a fiduciary call, which is the combination of the present value of some amount that you would invest and the value of a call. Put call parity states that a protective put must be equal to a fiduciary call. So SO plus PO is equal to X divided by this plus CO. So you can be asked for a put call parity to hold, what happens? And then you see different options. Now, if put call parity does not hold, what opportunity arises? Arbitrage. Now, I have arranged look at this equation. SO plus PO is equal to X into 1 plus R plus CO. I have rearranged it here. So under the put call relationship, put call parity relationship, your PO is equal to this. So your long, so you can get a question like this. Under the put call parity, your long put is equal to what? So you have to rearrange the equation, the put call parity, the original put call parity relationship, and then you have to get what they are asking. You have to equate this with what they are asking. Binomial valuation of options, you would see more of this in level 2, but then it's a model of valuing options as well. You have your U factor, you have your D factor, and there's a formula for the value of a call using binomial option pricing model. And then there's something called the risk neutral probability. Now, this risk neutral probability is not the same as an actual probability. Remember that it is a pseudo or synthetic probability. Now, to get your value of a call, you have to get the value of the risk neutral probability and then equate it with this, and the same thing with a put as well. Right, I think there's a point I wanted to talk about. Okay. Right, let's quickly go to questions before we call it a day. So I would switch over to some questions that, okay, let's start with the afternoon. Please, can you see, let me see if I can share my screen again. Okay, please confirm that you can see the screen, please. Anyone? Can you see my screen now? Yes, thank you, Big Ben. Right, so this is going to be interactive. I want everybody to participate. So the first question, in comparison to underlying spot markets, derivative markets tend to be what? A, less liquid. B, entail higher transaction costs, offer easier access to leverage and short positions. Anyone? Let me see. So someone says C. C. Thank you. So derivatives markets offer easier access to leverages and short position. 99. I'm not going to do 99 because 99 is actually level 2 material. If you start to focus on things like this, you will just waste time, that your precious time. So let's move. And besides, just to state that derivatives in level 1 is not really calculation intensive. And you would worry about that in level 2, but in level 1 is just for you to grasp the concept. Now let's look at the next question. BWC is the fixed rate payer on a plain vanilla interest rate swap. Since the swap commencement, interest rates have fallen considerably. Which of the following statements is most accurate? So the swap can be an asset or can be a liability. Why can it be an asset or a liability? Because you can be the one that will pay or you can be the one that will receive, depending on how interest rates have moved and depending on whether you're a fixed interest payer or a floating or a receiver. Now, what are we saying? BWC is a fixed rate payer, so pays fixed rate and receives floating rates. Now, interest rates have fallen considerably. So what does that mean? It means that BWC is going to pay the other party the loss that BWC has made, because interest rates have fallen. And the interest rates we are looking at that have fallen is the floating side of the transaction. So let's look at the options. Or can anyone attempt to give an answer? C. Joy says C. Dr. Aminu says C. Okay, so everyone is in agreement that the answer is C. The present value of the floating rate payments will be lower than the present value of the fixed rate payments. Why do we use present value? We use present value because the way swaps work is that when you have seen that you've discovered the floating rate and you've seen whether it went up or went down, the payment is not made immediately. The payment is typically made 90 days from the period when you discover that difference. So to get the actual value, you discount it by some rate and you prorate it by that 90 over 360. But you would see more of this in level 3. But just remember that there is a difference between how the payments will be made when interest rates go up or go down. Now, the next question. The price for an underlying security is currently 520. A put option with an exercise price of 528 has a premium of 0.08. The put option is currently trading what? What do we think? 101. 101. 101 is what? A. Someone said B. A, B. Okay, let me see if I can get more answers before we talk about it. B. A, B. Okay, so Big Ben says A, Toby says B, Joy says B. Can anyone also attempt? Just a few more people, please. Let's try and make this interactive, please. Anyone? Let me look at your names. B. Okay, so let's look at this. Now, when you are considering whether an option is in the money or out of the money or at the money, you ignore the premium. So you just forget about the premium. Don't worry about the premium, because I see that most people are saying B. Now, you ignore the premium. You are looking at, so if you want to bring in the premium, consider the premium. It is when you are calculating your profits that you will bring in the premium. But at the moment, right now, the option is in the money. Why is it in the money? Because you are ignoring your premium and you are looking at only the value of the option. So you are looking at only the value of the underlying against the exercise price. So A is the answer. Let's try and remember this because it's very important. These are the kind of easy questions that they would ask, but you would think it's easy, but then it's a very tricky question, because what they've done is they've included this 0.08 so that when you then do your calculation, you get 0. But meanwhile, you have to ignore the premium. So I think it was just Big Ben. Okay, thanks. 15 minutes left. It was just Big Ben that got this. Now, which of the following statements is most accurate? We talk about this. The lowest value of a European put option is the greater of what? Anyone, please? Answers. I need answers. Remember, we said there's the value of an option and there is the lowest value or the minimum value of an option. So Big Ben says C. That is 0 and the present value of exercise price less the underlying spot price. Thank you. So C is the answer. And the reason why A, okay, actually none of them None of them have just value. All of them are present value. Okay, so C is the answer. And the difference between the value and the minimum value is that present value that we use to qualify the exercise price. So, hold on, I think I've moved it. Okay. 102. Which of the following is, okay, we've done 102. 103. Right. This was what I wanted to talk about, but for the sake of time, I couldn't dwell on it. So early exercise of an American option immediately before a dividend would most likely be warranted. So let's think about this. Before I ask for answers, let's think about this. An American option is not a European option. An American option can be exercised anytime. So what happens? We know that an option is going to pay dividends in a week's time. And we are saying that if we exercise this dividend, if we exercise this option on time, especially if it is in the money, we also get dividends as well. So what happens? You exercise, you earn dividends. So what they are asking is early exercise of an option immediately before a dividend would most likely, when would be the best time to exercise early? So what they are saying is the options for a stock call option, when the carry costs are significant, for a put option well in the money. What do we think the answer is? Someone says B. Someone says B. Anyone else? Can anyone else attempt? Anyone else? Big Ben, Monsurat, Adeni, Gina, Tolu, Joy. Can anyone just attempt? Okay, C, not sure. That's fine. I just need to be sure that people are participating. Can anyone else attempt? Okay, so let's think about this. Let's think about this again. We said you have an option. Now, you want to get the benefits of the dividend. If you are long an option, and if you are long a call option, it means that you have the right to buy an underlying when you exercise. When you buy the underlying, you now own that underlying. Now, if that underlying pays dividends, you earn the dividends. If it's a put, if you are long a put, it means you own the underlying already. And then when you sell, when you exercise the put, you sell the underlying, which you already own. But then you don't get dividends out of it. And why? Because you've already sold it, so you don't own it again. But for a call, so it's just, you just have to think about it. So some of these things, you don't even need to memorize or cram. You just have to think about it in very, very simple terms. You know that a call is an option to buy. You are buying, you are long a call option on a particular stock. That stock is going to pay dividends. When will be the best time to exercise your call? The best time to exercise your call would be before it pays dividends. Why? Because you will get more money from dividends. If you wait till after the stock goes ex-div, that after dividend has been paid, you will lose that dividend benefit. So what we are saying is early exercise of an option immediately before a dividend would most likely be warranted for a stock call option. Now, A is the answer. Why is A the answer? Because when you exercise a call option, you pay the money, you pay the exercise price, you receive the underlying, and when they pay the dividend, guess what? The dividend goes to you. When carrying costs are significant, it is irrelevant whether they pay dividend or not. It is irrelevant. So B is not the answer. For a put option well in the money, C is not the answer, because if it's a put option, when you hold a put option, it is assumed that you own the underlying already. So what happens when you exercise the put option? You do not get the underlying, you sell the underlying, and then you receive what? You receive cash. So you don't own the underlying anymore. So A is the answer. I hope I've been able to convince but not confuse everyone that A is the answer. Right, let's quickly look at some more questions. So let's look at this mark to market. Now, this is very important. This question is very important, and I think we'll spend some time on it. We might not have time to go through all the questions. So let's look at this. Colin Farrell sells 4,000 equity index futures. Thanks, Dr. Aminu. At a price of 224. She's required to provide an initial margin of 20 euros per contract and meet her margin calls when balance falls below the maintenance margin of $12. Now, the reason why I raise my voice here is that normally when you are meeting your maintenance margin, so when your margin falls below your maintenance margin, what happens is that the exchange requires you to increase your margin back to your initial margin of 20. But why I'm raising my voice is because you need to read the question very well. Now, this question is saying that this exchange is a different exchange. It's saying that instead of you increasing your margin back to 20, you are increasing your margin. What it said? It says increase your margin back to 12. So in the event of a margin call, the exchange requires additional margin to be contributed up to the maintenance margin level. So normally it should be back to the initial margin level. But in this case, we are saying up to this 12. Instead of 20, you have to increase your margin only up to this 12. The price of the contract over the first, second, and third day is as follows. So let's look at this. I'm not really, the problem is that this annotation thing, I don't know how I'm going to do it, but let me try. I hope it's not going to mess me up. Let's see. Okay, let me use text. So what happens? So what do you have? Yeah, okay, I have 8 minutes more. You have day one. What happens? You are the seller of a contract. So what does this mean? It means that your margin, so what happens? The price has gone up to 224. So you are on the losing side because you are the seller, and you actually want the price to come down instead of up because you are the seller. If you are the buyer, then you will have been a gainer, but you're a loser here. So what happens? 234 minus 224 is equal to 12. So what happens? Your margin account becomes 12 minus 12 equals to 0. How much are you required to bring back up? How much are you required to bring back to take your margin back to your maintenance margin? Can anyone help? Oh, sorry. Is that? Oh, sorry. I said 12. It's supposed to be 10. Sorry about that. Thanks, Big Ben. Okay, so your margin reduces to 2. So how much are you required to bring back to your 12? So for the sake of time, I'll quickly answer. So you are required to bring to, yes, 10. So now what happens? You bring 10, you add it to your 2, your margin account is back to 12, which is the requirement that from the exchange. Day 2, what happens? The price still goes up. So what do? You take your 234 minus 238. Please correct me if I'm wrong, Big Ben. So that's 14. So what happens to your margin? You take this, your 12 minus 14. So what happens? Your account becomes in the negative 2 minus 2 because you've taken this 14 from your account. So how much do you need to bring back your account to 12? Can anyone help? How much do you need to bring back your account to the maintenance margin level? 14. So you pay back 14 into your margin account. So what do you then have? So you have plus 14 minus 2, that's equal to 12. Now on the next day, you get lucky. The price falls. So the price falls to 248. The price falls to 230. So what do you have? Equals to 18. Now that 18 is added to your margin account. So you have 30. So the amount in your margin account per contract is 30. So what happens? They're asking, what are they asking? Based on the information, the balance of O'Farrell's margin account at day 3 is 30 times 4,000, which is 120. So C should be the answer. Right, C. Now, the next question. I have 4 minutes. I'm not going to go through any calculation question anymore. So let's just move on to which of the following statements is least correct? A credit default swap is a what? What is a credit default swap? Please, I need somebody to answer. We've talked about this already. Credit default swap is what? Which one is least correct? So which one is least correct among these three options? Someone says B. Someone says C. So the answer should be C. Why is it C? We know that a credit default swap is a credit derivative, and they're asking which is least correct. This is correct. So A is not the answer. We know that a credit default swap is a contingent claim. We classified contingent claims. We mentioned two most popular contingent claims, options and credit derivatives. And we said a credit default swap is a credit derivative. So these two are correct. But then C is least correct. It is not a forward commitment. Forward commitments are futures, forwards, and swaps. Remember that. Which of the following is least likely to be the reason for an arbitrage opportunity to remain exploited? So what is the reason? Can anyone help here? What's the reason? What's the answer for 102? C. Yes, ethical objections in taking advantages of mispricing. There's nothing unethical about taking advantage of mispricing. It's the market. So, right, wow, the others are calculation questions. Let me see which one should I. Okay, I'm not going to do 105 because 105 is binomial, and for this you just have to key in the variables into the formula. So you key in what the price is and all these things into the formula. So it's just a formula calculation. Let me see if I can quickly do 103. So number 103. Where is my annotation device? So 103, we are told that somebody is long a 9-month forward equity contract with a forward price of 1684. So what we have our forward price of 1684. We know that, so what's the question asking? What's the value of the forward contract? We know that the value of our forward contract is ST minus, oops, I have only 1 minute left. F divided by, I might have to go over time by about 2 or 3 minutes if you guys permit, please. Minus F divided by 1 plus R raised power T minus T. So raised power T minus T. So what do? We are asked to, sorry, I didn't read through the question because of time, but I know that we're asked to calculate the value. So what do? We key in the value. So what do we have? We have, because he's long a contract, we have 2087.54 minus, what is our F? 1684.2 divided by 1.014, that's the rate, raised to power. So what did we say? It's a 9-month contract, but we are valuing it in 4 months' time. So we have to take out that 9 minus 4. So the answer, if anyone can calculate this, you should get the answer. I don't know what the answer is here. If anyone can quickly calculate this, that would help. So that's 2087. So you first find the value of this, and then you would take it from this. Let me see if I can quickly. Sorry, 9 minus raised power 9 minus 4 divided by 12. So it should be the raised power 9 minus 4 divided by 12. So it should be raised power 5 over 12. 5 over 12. Let's see. 5 over 12. So can anyone help me with the calculation? I think the answer should be B. No, I'm not sure. 413.06. C. Someone says C. C. Okay, B. The answer should be B. 413 point something. But anyway, that's the idea. So I don't need to, this is the idea. So I think we are done. So like I said, if you if you just permit me, give me about 1 minute more. Let me see if we can do this last question. Because this is what I should have actually done. Right, let's quickly look at the next question. Company XYZ has 40 million 3-year debt on which it pays a fixed rate of interest at 7.6%. As it is expecting rates to drop significantly over the few coming years, it enters into a swap contract with a fixed leg of 4% and a floating leg of 90 LIBOR plus 1.8. The notional value of the contract is 40,000 and it is based on 360-day year. If LIBOR on the day 360 is 1.3% per annum, which of these following statements is least correct? The 90-day LIBOR rate corresponds on day 360 corresponds with a swap payment of what? So let's look at this. Now, we have a 3-year debt. We've entered a swap. Because we are expecting interest rates to drop, what does this mean? It means that we would likely be the fixed rates. We will be the fixed rate receiver. Because we expect interest rates to drop, we would want to be receiving fixed rates and paying floating rates. Why? Because if floating rates drop, we will be receiving more than we are paying out. So what do we then do? They are telling us that at a particular point, at day 360, our LIBOR is 1.3. So what do we have? We have So what do we have? We have 4%. This is the amount we are receiving minus 1.8% because we said plus LIBOR and we said 1.8% plus LIBOR. So what does this mean? We are going to pay 1.8% plus 1.3%, right? And because it is a 90-day LIBOR, because it is based on 90 days, we have to prorate it. So where is it here? A floating rate leg at 90-day LIBOR. So 90-day LIBOR, we have to prorate it. Oops. How do I do this now? How do I go back to this? Anyway. So we prorate it by 90 over 360. And then what do? We multiply by 40 million. So this is the amount. So what happens? We are supposed to receive 4%, and pay 1.8 plus 1.3%, and we'll prorate it by 90 over 360 times 40 million. So all of this multiplied by 40 million. So all of this. Jeez, this is okay, multiplied by 40 million. Now, what do we have? So if you calculate this, you should get 90,000. So remember, we said for swaps, you do not pay or receive that money. What happens is you either receive the net value or you pay the net value. So company XYZ receives the net value of $90,000. Now let's look at the options. The 90-day LIBOR rate on day 360 corresponds with a swap payment of what? They are saying of 690. No, the swap payment is supposed to be 90,000 made on, it's supposed to be, sorry, the swap payments will be made on day 450. Remember, we said for swaps, the swap payment is not made on that day. It is made 90 days. It's made after 90 days after. So if it was a 180-day LIBOR, for instance, it will be made 180 days after, and you will learn this in level 2. So it's supposed to be made. So this is day 360. On this day 360, we don't receive this 90. We have to wait till day 450, which is 360 plus 90, to earn this $90,000. So we'll wait till day 90. So we'll wait till day 450 to earn that money. And the third one is company XYZ earns that amount. So the answer is A, because they're asking for which is least correct. We do not receive 690, we receive 90,000. So sorry for taking more time than I should have, than the scheduled time. I wish you best of luck. And if you want the slides, you can always ask them and they'll provide to you. Thank you very much and good luck. Good night. And I'll hand over back to Busayo for the closing remarks. Thank you.
Thank you, Fola, for that. So with that, we've come to the end of this session of this edition of our candidates bootcamp. We'd like to thank, we at the CFA Society Nigeria, would like to thank all our facilitators for their time and their resources, which they've lent to us to be able to have this event as successful as it has been. We also like to thank our sponsors who have supported us in our goals of delivering this session. We also like to thank the candidates, because without you guys, we wouldn't be able to have gotten any headway, because we can't come and start speaking to ourselves. You are the people that we are designed this event for. We say a very big thank you to you for your time and allowing us to be able to deliver this kind of event to you. And we wish you all the best in your upcoming exams. Thank you very much.
If you've made a decision to aim for a long-term and successful finance career, taking the Chartered Financial Analyst CFA exam and studying the curriculum is an excellent way to ensure you have a strong knowledge base and top-notch skills. Are you ready to take the bold step to invest in yourself? CFA Society Nigeria is at your disposal, promoting the highest standards of investment practice in Nigeria. As an affiliate of CFA Institute, CFA Society Nigeria seeks to promote the highest standards of investment practice in Nigeria and to provide a vibrant community in which its members and other key players in the investment industry can interact and grow. When you have the CFA charter, you're globally recognized. Take advantage today by writing the CFA exam and joining us at CFA Society Nigeria. For more information, visit us at cfasocietyn.org. CFA Society Nigeria, making finance a force for good.
New Frontiers Learning is the #1 tuition center for the CFA exams in Nigeria. Our founders went through their CFA journey with little or no support of any kind. However, they vowed to turn into reality the dream of every CFA candidate earning the CFA charter, irrespective of their backgrounds, finance and non-finance alike. It is this commitment to support our candidates that influences our engagement of a world-class faculty, partnerships, scholarship and discount offers, our online learning management system, and so much more. Our clients' outstanding results across all levels of the exams every year attest to the quality of our top-notch physical and online program in the last 10 years. That's right, we have been impacting the industry for 10 years and have supported about 2,500 professionals in that time space. Register with New Frontiers Learning today.
Pure Factor Learning Center is a CFA tuition provider in Lagos, Nigeria. We have a wide range of resources that support you to pass your exams. We have a team of qualified tutors with extensive experience in teaching CFA. The main focus at our lecture center is to provide you with the necessary support to make sure you attain your goal. Our unique features include a conducive learning environment, uninterrupted power supply, highly experienced lecturers, easy accessibility, and spacious parking facilities. We offer 2 prep classes, in-person classes and online live classes. For our in-person classes, lectures are solely on weekends. You have 24/7 access to all our tutors. All classes are completed a month to your exams. For our online classes, you have access to our live classes, 24/7 access to our tutors, and access to our online learning management system with recorded videos. Pure Factor Learning. Come to us today and let us make your dreams a reality.
Hello, are you looking for a CFA preparatory school? A tuition to help with your pursuit of the highly prestigious CFA charter? If yes, then First Quartile Professionals is perfect for you. You can join us from any part of the world. We offer online and physical classes. Our pass rate have been higher than the global pass rate in all but one of the last 18 run of classes we have had over the years. At First Quartile, we also adopt a mentoring system to guide candidates through their journey to earn the CFA charter. At First Quartile, you get a chance to network with many industry experts. Visit our website or call 0817-607-4526 for further inquiries.
Of a CFA prep provider where you can get high quality tuition that will be delivered by some of the very best investment and finance professionals? Think no further. Ivy League is the place for you. At Ivy League, we have a consistent history of delivering and surpassing on our students' expectations across several finance qualifications. At Ivy League, our tutors share a unique characteristic of being very skillful, very passionate, committed, and above all are dedicated to the success of our students. Our CFA lectures holds weekends from 9 a.m. to 6 p.m. on Saturdays and 11 a.m. to 6 p.m. on Sundays. Each class will run for 2 hours with a 15 minutes break in between classes. The classes will be delivered via our virtual learning management system. Why not join us at Ivy League? Simply visit our website on www.ivyleaguenigeria.com/CFA.